Electronic market. Modern financial markets are predominantly electronic, a fundamental shift from the traditional floor-based trading scene in movies and historical accounts. This evolution has profoundly impacted how financial instruments are traded, the speed of transactions, and the types of participants involved. The evolution of trading, from open outcry to digital networks. Historically, trading occurred in pits or on trading floors where human traders used vocal shouts and hand signals, known as open outcry, to execute trades. While colorful and dynamic, this system had inherent limitations in terms of speed, transparency, and scalability. The advent of computer technology and global communication networks paved the way for electronic markets. This transition began gradually in the late 20th century, with exchanges progressively automating their processes. Key milestones included the National Association of Securities Dealers Automated Quotations, NASDAQ, exchange, founded in 1971 as the world's first electronic stock market, and the subsequent electronic transformation of older exchanges like the New York Stock Exchange, NYSE, which now operates NYSE Arca as a fully electronic exchange alongside its hybrid floor-based trading. Other major global electronic exchanges include the London Stock Exchange, LSE, and Euronext. Benefits of electronic markets. Speed and efficiency. Trades can be executed in milliseconds, significantly reducing latency and increasing throughput. Transparency. All participants typically have access to the same real-time price data and order book information. Accessibility. Geographic barriers are removed, allowing global participation. Reduced costs. Automation can lower transaction costs compared to manual processes. Increased capacity. Electronic systems can handle a much larger volume of trades than human-driven floors. A significant historical development that accelerated the shift to electronic trading and increased market liquidity was decimalization. Prior to 2001, stock prices in the U.S. were quoted in fractions, e.g., 1/8, 1/16, 1/32. Decimalization switched to quoting prices in cents, e.g., 1-cent increments. This dramatically reduced the minimum price increment, leading to tighter bid-ask spreads and encouraging more frequent, smaller trades, which are ideal for automated systems. Key market participants. Beyond individual investors and large institutions, several specialized entities play crucial roles in the electronic market ecosystem. Brokers act as intermediaries, executing trades on behalf of their clients. They connect individual and institutional traders to the exchanges. Market makers. These are firms or individuals who stand ready to buy and sell a particular asset, providing continuous bid and ask quotes. By doing so, they provide liquidity to the market and profit from the bid-ask spread, the difference between their buy and sell prices. Clearing houses, independent entities that facilitate the exchange of payments and securities between buyers and sellers, ensuring the integrity of the trade. They act as a counterparty to both sides of a trade, guaranteeing that the buyer receives the security and the seller receives the payment, thereby mitigating counterparty risk. Anatomy of an electronic trading system. Modern electronic trading systems are complex architectures designed for speed, reliability, and security. While the specific components vary, a high-level view includes order management systems, OMS software applications used by traders to enter, manage, and route orders. An OMS tracks the status of orders, e.g., pending, filled, canceled, and ensures compliance with internal rules. Execution management systems, EMS, often integrated with or layered on top of an OMS. An EMS focuses on the optimal execution of orders. This includes features like smart order routing, sending orders to the exchange with the best price. Algorithmic execution strategies, e.g., VWAP, TWAP, and real-time market data analysis. Matching engine, the core of any electronic exchange. This is a sophisticated piece of software that receives buy and sell orders and matches them according to predefined rules, forming trades. The matching engine, how orders meet. The matching engine is the heart of an electronic market. Its primary function is to pair compatible buy and sell orders. The most common matching algorithm used by exchanges is price-time priority. Here's how price-time priority works. 1. Price priority. Buy orders with higher prices are prioritized over lower price buy orders. Similarly, sell orders with lower prices are prioritized over higher price sell orders. The goal is to give priority to orders that offer the best deal to the opposing side. 2. Time priority. Among orders at the same price level, the order that arrived first, earliest timestamp, is prioritized. This rewards participants who commit their capital earlier. Let's illustrate this with a simple conceptual order book. An order book is a list of buy and sell orders for a particular financial instrument, organized by price level. Buy orders are called bids, and sell orders are called asks or offers. Conceptual order book representation. We can represent a simplified order book using Python dictionaries. The bid side will store buy orders, price, quantity, and the ask side will store sell orders. Download the code on OnePageCode Substack. This code snippet class provides a basic structure to store buy and sell orders at different price levels. The code snippet method ensures that new orders are placed correctly and the book remains sorted by price, implicitly demonstrating price priority. The code snippet method helps visualize the current state of the market. Let's populate our order book with some initial orders. Download the code on OnePageCode Substack. After running this code, you'll see the order book with bids and asks. Notice how orders at the same price are listed in the order they were added, representing time priority within that price level. The best bid, highest by price, and best ask, lowest sell price, define the current market spread. Fundamental order types and their execution. Understanding different order types is crucial for both manual and automated trading. Each type serves a specific purpose regarding price control, execution speed, and risk management. 1. Market orders. A code snippet is an instruction to buy or sell a security immediately at the best available current price. Characteristics. Guaranteed execution. If liquidity exists, market orders are designed to execute quickly, as they prioritize speed over price. No price control. You do not specify a price. You accept whatever price is available in the market. Use cases. When you need to enter or exit a position urgently, and certainty of execution is more important than the exact price. Pitfall. Slippage. The most significant risk with market orders is slippage. This occurs when the actual execution price is different from the price you saw at the moment you placed the order. Slippage is more pronounced in fast-moving markets or for illiquid assets where there might not be enough volume at the desired price level to fill your entire order. Your order will walk up or walk down the order book, filling at progressively worse prices until it's completely filled. Let's simulate a market order executing against our order book. Download the code on OnePageCode Substack. This enhanced code snippet class, or a new function if not inheriting, now includes code snippet. It iterates through the best available prices on the opposite side of the book, lowest asks for a buy order, highest bids for a sell order, and fills the order until the requested quantity is met or liquidity runs out. Let's see it in action. Download the code on OnePageCode Substack. Observe the output. The market buy order for 120 units first takes all 100 units at $100.50, then takes 20 units from the 50 available at $100.60. The average price paid will be higher than the initial best ask, demonstrating slippage. 2. Limit orders. A code snippet is an instruction to buy or sell a security at a specific price or better. Characteristics. Price control. You set the maximum price you're willing to pay for a buy order or the minimum price you're willing to accept for a sell order. No guaranteed execution. Your order will only be filled if the market price reaches your specified limit price or better. If it doesn't, your order will remain in the order book, waiting. Liquidity provision. Limit orders add liquidity to the market because they provide standing offers to buy or sell at a certain price. Use cases when you prioritize getting a specific price over immediate execution. Useful for setting target entry/exit points or for providing liquidity. Trade-offs. While they prevent slippage, they carry the risk of non-execution. In a fast-moving market, your limit order might be left behind if the price moves past your limit quickly without touching it. Let's simulate placing limit orders and their potential execution. We'll add a method to our code snippet to try and match new limit orders. Download the code on OnePageCode Substack. The code snippet method first attempts to match the order against existing orders in the book that meet its price criteria. If the order is not fully filled, the remaining quantity is then added to the order book at the specified limit price, waiting for an opposing order to match it. Let's test this. Download the code on OnePageCode Substack. In Scenario 1 and 2, the limit orders are immediately matched because there's sufficient liquidity at or better than the specified price. In Scenario 3, the limit by order at $100.30 doesn't find any sellers at $100.30 or below, so it's placed onto the bid side of the order book, waiting for a matching sell order. 3. Stop orders. A code snippet or code snippet is an order to buy or sell a security once its price reaches a specified code snippet. Once the stop price is triggered, the stop order becomes a code snippet. Characteristics. Trigger price. You set a stop price. When the market price reaches or crosses this price, the order is activated. Conversion to market order. Once triggered, it behaves like a market order, executing at the best available price. Risk management. Primarily used to limit potential losses, stop loss, or to lock in profits. Can also be used to initiate new trades, e.g., a buy-stop order above current price to enter a breakout. Use cases. Protecting positions, automating trade entry/exit based on price thresholds. Pitfall. Slippage. Since a stop order becomes a market order upon trigger, it is susceptible to slippage, especially in volatile markets. The execution price might be significantly worse than your stop price. To simulate stop orders, we need to track pending stop orders and have a way to update the last traded price to check for triggers. Download the code on OnePageCode Substack. This updated code snippet includes code snippet and code snippet. The code snippet method simply stores the stop order. The code snippet method is crucial. It simulates a market price movement and then calls code snippet to see if any pending stop orders have been triggered. If triggered, they are immediately converted into market orders and executed. Let's demonstrate a stop loss scenario. Download the code on OnePageCode Substack. You will observe that when the code snippet crosses the code snippet, the stop order is triggered and then executed as a market order, consuming liquidity from the opposite side of the book. Advanced order types. Beyond the fundamental three, exchanges offer various specialized order types or modifiers to provide more granular control over execution. Stop limit orders. A hybrid order that combines features of a stop order and a limit order. Once the code snippet is reached, it triggers a code snippet instead of a market order. This mitigates slippage risk, but introduces the risk of non-execution if the market moves past the limit price too quickly. Time and force, TIF, modifiers. These dictate how long an order remains active. Good till canceled, GTC, the order remains active until it is executed or explicitly canceled by the trader. Day order. The order is active only for the current trading day. Any unexecuted portion is canceled at the end of the day. Fill or kill. FOK, the entire order must be executed immediately and completely. If not, the entire order is canceled. Immediate or cancel. IOC, any portion of the order that can be executed immediately is filled, and the remaining unexecuted portion is canceled. All or none. AON, the entire order quantity must be executed, but not necessarily immediately. It can wait until the full quantity is available at the specified price. These advanced types offer greater precision for sophisticated trading strategies, but also introduce more complex execution logic and potential pitfalls. Liquidity and its implications. Liquidity refers to the ease with which an asset can be bought or sold in the market without significantly affecting its price. A highly liquid market has many buyers and sellers, allowing large orders to be executed quickly at stable prices. And a liquid market, conversely, has few participants, leading to wider bid-ask spreads and Potential for large price swings, even with small orders. Electronic markets generally enhance liquidity due to their speed, accessibility, and the presence of market makers. However, different order types impact liquidity. Limit orders generally add liquidity by providing standing bids and offers to the market. They wait for someone else to take their price. Market orders generally consume liquidity because they demand immediate execution and take existing bids or offers from the order book. Understanding liquidity is critical for traders. Trading in illiquid markets can lead to higher transaction costs due to wider spreads and significant slippage. Regulatory landscape. Electronic markets operate within a complex regulatory framework designed to ensure fairness, transparency, and stability. Regulatory bodies, such as the Securities and Exchange Commission, SEC, in the U.S. or the Financial Conduct Authority, FCA, in the U.K., establish rules regarding order handling, market data dissemination, trading practices, and participant conduct. These regulations are vital for protecting investors and maintaining public confidence in the financial system. High-frequency trading, HFT. The rise of electronic markets has enabled high-frequency trading, HFT, a type of algorithmic trading characterized by extremely short holding periods and high trade volumes. HFT firms use sophisticated algorithms and high-speed data connections to execute millions of trades per second. Implications of HFT. Increased liquidity. HFT firms often act as market makers, providing continuous quotes and narrowing bid-ask spreads, which benefits other market participants. Price discovery. Their rapid reactions to new information can lead to more efficient price discovery. Market stability concerns. While generally beneficial, HFT has also raised concerns about market stability. Events like the flash crash of 2010, where the Dow Jones Industrial Average plunged hundreds of points in minutes before recovering, highlighted how rapid algorithmic trading could exacerbate volatility if not properly managed. Understanding the mechanics of electronic markets, from basic order types to the underlying matching engines and the impact of advanced strategies like HFT, provides a crucial foundation for anyone looking to engage with financial markets, especially through automated or quantitative trading. Discrete price grids and minimum tick sizes. In electronic markets, prices do not move continuously. Instead, they're constrained to a discrete grid, meaning they can only change by specific, predefined increments. This increment is known as the minimum tick size or simply tick size. Understanding tick sizes is fundamental because it dictates the smallest possible price movement for a financial instrument. The concept of a discrete price grid. Imagine a ruler where you can only mark measurements at specific intervals, say every millimeter. Similarly, a discrete price grid means that a stock price, for instance, cannot be $100.0001 or $100.00005. If its tick size is 1 cent, its price can only be $100, $100.01, $100.02, and so on. This quantization of prices is a core feature of modern electronic exchanges. Practical examples of tick sizes. Tick sizes vary significantly across different asset classes and even within the same asset class, depending on the price level or exchange rules. Stocks. For most stocks trading above $1 in the U.S., the standard tick size is 1 cent, 1 cent. Below $1, it might be $0.0001 or $0.001. Forex, FX major currency pairs typically trade in increments of 0.0001, 1 pip. For Japanese yen pairs, it's often 0.01. Some brokers offer micro pips, which are 0.00001. Futures. Tick sizes for futures contracts are highly specific to each contract. For example, the E-mini S&P 500 futures contract, ES, has a tick size of 0.25 index points, which translates to $12.50 per contract per tick. Crude oil futures, CL, might have a tick size of 1 cent per barrel. Cryptocurrencies. While some very liquid cryptocurrencies on major exchanges might follow a somewhat discrete grid, many can appear to trade with much finer granularity, sometimes up to 8 decimal places or more, depending on the exchange's internal precision. However, for practical trading, effective tick sizes often emerge from liquidity patterns. The tick size is crucial for traders as it directly impacts profitability. It determines the minimum profit or loss per share/contract. Risk management. Stop loss and take profit levels must align with the tick grid. Market maker incentives. A wider tick size, less granular, can provide more incentive for market makers as their spread can cover more risk. Representing tick sizes in code. In programming, we often need to ensure that prices adhere to the defined tick size. This typically involves rounding prices to the nearest valid tick increment. Let's define a function to round a price to the nearest tick. Download the code on OnePageCode Substack. This code snippet function takes a code snippet and a code snippet as input. It uses Python's code snippet module to ensure high precision, which is critical in financial calculations to avoid floating point inaccuracies. It calculates how many tick increments the price represents, rounds that number to the nearest integer, and then multiplies it by the code snip. Pet to get the valid price on a grid. Let's test this with some examples. Download the code on OnePageCode Substack. Running this code demonstrates how prices are adjusted to fit the discrete grid. Code snippet rounds up. Code snippet rounds down to the nearest 0.25 multiple. Code snippet round to the nearest 0.0001 multiple. Price ladders and order books. The price ladder, often referred to as the depth of market, DOM, is a critical tool for active traders. It visually represents the order book, showing pending buy and sell orders at various price levels. The order book is essentially a real-time list of all outstanding limit orders for a particular financial instrument. Understanding the order book. An order book comprises two main sides. Bid side contains all outstanding limit buy orders, indicating prices at which traders are willing to purchase the instrument and the corresponding quantities. Ask offer side contains all outstanding limit sell orders, indicating prices at which traders are willing to sell the instrument and the corresponding quantities. Orders are typically displayed in price priority. The highest bid price and the lowest ask price are at the top, closest to the current market price. Structure of a price ladder. A typical price ladder or DOM display shows bid prices and quantities, listed in descending order, highest bid at the top. Ask prices and quantities, listed in ascending order, lowest ask at the top. Current price/last. Traded price, often displayed in the middle or highlighted. Visually, it might look like this conceptual representation. Bid quantity, bid price, ask quantity. $199.98, $259.99, $100.01, $300, $100.02, $150, $100.03, $400. Simulating a simplified order book. We can represent a simplified order book using Python dictionaries, where keys or prices and values are the total quantities at that price level. Download the code on OnePageCode Substack. This sets up a basic structure. Now let's add some orders to it. When adding orders, it's crucial to aggregate quantities at the same price level. Download the code on OnePageCode Substack. The code snippet function handles adding quantities to existing price levels or creating new ones. It also includes a basic check to remove price levels if their quantity becomes 0 or negative, simulating order cancellation or execution. Best bid, best ask, and bid-ask spread. These are fundamental concepts for understanding immediate market conditions. Best bid. The highest price a buyer is currently willing to pay for an instrument. This is the top of the bid side of the order book. Best ask, or best offer, the lowest price a seller is currently willing to accept for an instrument. This is the top of the ask side of the order book. Bid-ask spread. The difference between the best ask price and the best bid price. See. Ode snippet. It represents the cost of immediate execution and is a key indicator of market liquidity. A narrow spread indicates high liquidity and efficient pricing, while a wide spread suggests lower liquidity and potentially higher trading costs. Calculating best bid, best ask, and spread in code. From our simulated order book, we can easily extract these values. Download the code on OnePageCode Substack. This function finds the maximum price in the code snippet dictionary, highest bid, and the minimum price in the code snippet dictionary, lowest ask. It then calculates the spread. If either side is empty, it returns code snippet for the respective values. For our current order book, the output would be code snippet, code snippet, code snippet, order book depth, level 1, level 2, and level 3. The level of detail provided by an exchange regarding its order book is often categorized into different levels. Level 1 data. This is the most basic level and typically includes only the best bid and best ask prices and their corresponding aggregate quantities. This is what most retail trading platforms display as the current quote. It provides a snapshot of the immediate supply and demand. Level 2 data. This expands on level 1 by showing multiple price levels beyond the best bid and ask, along with the aggregated quantities at each of those levels. It essentially provides a view of the full price ladder. Level 2 data is invaluable for understanding market depth, IFAing potential support/resistance levels, and assessing liquidity beyond the immediate best prices. Level 3 data. This is the most granular level, typically reserved for institutional traders and market makers. It includes individual order IDs, allowing traders to see the size, and sometimes even the firm placing each specific order at each price level. This level of detail enables market makers to manage their own orders precisely and identify potential spoofing or legitimate large orders. For most quantitative strategies, level 2 data is sufficient, though HFD firms might leverage level 3, representing order book depth in code. Our current code snippet structure already captures level 2 data implicitly, as it stores quantities for multiple price levels. We just need to present it in a sorted manner. Download the code on OnePageCode Substack. This code snippet function sorts the bids in descending order of price and asks in ascending order. It then prints them in a format resembling a price ladder, showing the specified code snippet. The output for code snippet would be, download the code on OnePageCode Substack. This output clearly shows the level 2 data, providing more context than just the best bid/ask. Interpreting order book data from market insights. The order book is a goldmine of real-time market information. By analyzing the quantities at different price levels, traders can gain insights into 1. Market liquidity and depth. Liquidity refers to how easily an asset can be bought or sold without significantly impacting its price. In the context of the order book, high liquidity is indicated by large quantities of orders, high depth, near the best bid and ask. This means there are many buyers and sellers willing to trade close to the current market price, making it easy to execute large orders without causing significant price slippage. A thin order book, few orders or small quantities at various price levels, indicates low liquidity. This scenario makes the market susceptible to large price swings from even relatively small trades. Practical example: thin order book and volatility. Consider an order book where the best ask is $100.01 for 50 shares, and the next ask is $100.10 for 100 shares. If a market buy order for 60 shares comes in, it will consume all 50 shares at $100.01, and then 10 shares from the $100.10 level. This single trade causes the price to jump significantly from $100.01 to $100.10, demonstrating high volatility due to low depth. Detecting thinness programmatically. We can write a function to assess the depth or thinness of the order book by summing up quantities within a certain range or at specific levels. Download the code on OnePageCode Substack. Comparing the code snippet and code snippet values gives a quantitative measure of liquidity. A significantly lower value indicates a thin book. 2. Supply and demand dynamics. The relative size of quantities on the bid and ask sides can reveal imbalances in supply and demand. More quantity on the bid side, a buy wall, indicates stronger demand or potential support. More quantity on the ask side, a sell wall or offer wall, indicates stronger supply or potential resistance. Practical example: buy wall as a support level. If there's a large cluster of buy orders, e.g. 5,000 shares, at a specific price, say $99.50, this price level can act as a support level. It suggests that many buyers are willing to step in at that price, making it harder for the price to fall below it. If the price does fall to that level, these orders might absorb selling pressure, causing the price to bounce. Identifying imbalances programmatically. We can extend our depth calculation or create a function to compare the total quantities on each side within a certain range of the best bid/ask. Download the code on one page code Substack. And code snippet significantly above 0.5 suggests more buying pressure, while one below 0.5 suggests more selling pressure. The buy wall example shows a ratio close to 1, and the sell wall example shows a ratio close to 0. Market order interaction and order book updates. Understanding how different order types interact with the order book is crucial. A market order is an instruction to buy or sell immediately at the best available price. Unlike limit orders, market orders do not reside on the order book. They execute against existing limit orders. Step-by-step market order execution. Let's trace a market buy order for 400 shares against our initial order book. Initial order book. Bids: 99.99, 250, 99.98, 100, 99.97, 50. Asks: 100.01, 300, 100.02, 150, 100.03, 400. 1. Market buy order for 400 shares arrives. 2. The order will look for the lowest available ask price. It first consumes 300 shares at $100.01. Remaining quantity to fill: 400 minus 300 is equal to 100 shares. 3. The 100 shares are then filled from the next lowest ask price, which is $100.02, 150 shares available. It consumes 100 shares at $100.02. Remaining quantity at $100.02 becomes 150 minus 100 is equal to 50 shares. 4. The market order is now fully filled. 5. Order book update. The quantities at $100.01 become 0, so the price level is removed, and the quantity at $100.02 is reduced to 50. Simulating market order execution in code. Download the code on one page code Substack. This simulation function demonstrates the cascading effect of a market order on the order book, consuming liquidity from successive price levels until the order is filled or the book is exhausted. The code snippet list provides a record of the actual prices and quantities at which the market order was executed, which is crucial for calculating the average execution price and slippage. After the market buy for 400 shares, the ask at code snippet 300 shares is fully consumed. The ask at code snippet 150 shares is partially consumed by 100 shares, leaving 50. The order book reflects these changes, with the code snippet ask removed and code snippet quantity reduced. To the market sell for 200 shares. The bid at code snippet 250 shares is partially consumed by 200 shares, leaving 50. The order book reflects this change. This hands-on approach to simulating order book mechanics provides a deeper understanding of how market orders impact prices and liquidity, which is vital for developing robust trading strategies and understanding execution costs. Electronic order. What is an electronic order? At its core, an electronic order is a digital instruction sent by a market participant to a financial exchange, typically through an intermediary like a broker, to buy or sell a specific financial instrument. Unlike traditional floor-based trading, where verbal cues and hand signals were used, electronic orders are precise, structured data messages that can be processed at immense speeds. They are the fundamental building blocks of modern electronic markets, enabling rapid price discovery and efficient execution. The primary purpose of an electronic order is to translate a trader's intent into an actionable instruction that the market's infrastructure can understand and process. This process is fully automated, relying on sophisticated software systems and high-speed networks to ensure near-instantaneous communication between market participants and the exchange. Essential components of a trading order. Every electronic order, regardless of its complexity, must contain a set of fundamental instructions for the exchange to understand what action is desired. These core components define the what, how, and how much of a trade. The absolute minimum parameters typically include 1. Contract/instrument. The specific financial product being traded, e.g., Apple Incorporated stock, euro to US dollar currency pair, a specific bond future. This is often represented by a unique identifier, such as a ticker symbol, code snippet, code snippet. Dos actini. Tie-in/side. Whether the order is a code snippet to acquire the instrument or a code snippet to dispose of the instrument. 3. Quantity/size. The number of units of the instrument to be traded, e.g., 100 shares, 1 lot, 5 contracts. To illustrate how these basic components can be represented programmatically, we could define a simple Python class. This class will serve as a blueprint for creating order objects within a trading system. Download the code on OnePageCode Substack. This code snippet class provides a structured way to hold the core information of a trading instruction. The code snippet method ensures that when a code snippet object is created, it contains the necessary code snippet, and code snippet. The code snippet method helps in displaying the order details clearly, which is useful for debugging and logging. We can now create an instance of this code snippet class, conceptually representing a trader's intent to buy shares of Apple. Download the code on OnePageCode Substack. The output code snippet confirms that our order object correctly encapsulates the desired instruction. This simple programmatic representation is the first step in building more complex trading systems. Additional order parameters. Beyond the basic 3, real-world electronic orders often include a variety of additional parameters that provide more granular control over how and when an order is executed. These parameters allow traders to specify their intent with greater precision, especially concerning price and time. Common additional parameters include price, for orders that are not executed immediately at the prevailing market price, e.g., code snippet orders or code snippet orders. This specifies the maximum price a buyer is willing to pay or the minimum price a seller is willing to accept. Order type defines how the order interacts with the market. Common types include code snippet, execute immediately at best available price. Code snippet, execute as specified price or better. Code snippet, trigger a market or limit order when a certain price is reached, among others. Time and force. TIF specifies how long an order remains active in the market, if not fully executed. Code snippet. The order is active only for the current trading day. Any unexecuted portion is canceled at the end of the day. Code snippet. Good till canceled, the order remains active until it is fully executed or explicitly canceled by the trader. Code snippet. Immediate or cancel, any portion of the order that cannot be executed immediately is canceled. Code snippet. Fill or kill, the entire order must be executed immediately and completely, or it is entirely canceled. Special instructions, additional flags or conditions, such as code snippet. AON, which requires the entire quantity to be filled in a single transaction, or code snippet, specifying the smallest partial fill acceptable. Let's enhance our code snippet class to accommodate some of this. Crucial additional parameters. This demonstrates how a trading system progressively builds complexity into its order objects. Download the code on OnePageCode Substack. This updated code snippet class now includes code snippet, and code snippet, along with more robust validation. The code snippet attribute is added as a placeholder. In a real system, this would be assigned by the broker or exchange upon successful receipt of the order. This progressive building approach mirrors how real-world systems evolve to handle increasing complexity in order specifications. Here's how we might create different types of orders using this enhanced class. Download the code on OnePageCode Substack. These examples demonstrate the flexibility of the code snippet class in representing various trading intentions. The electronic order life cycle, from trader to settlement. Understanding the flow of an electronic order is crucial for grasping how modern markets operate. It's a journey involving multiple specialized systems and entities, all working in concert to ensure rapid and accurate trade execution and settlement. High-level order flow and system interactions. When a trader places an order through their trading terminal or an algorithmic system, it embarks on a complex, high-speed journey. 1. Trader's system. The order originates from the trader's desktop application, web platform, or an automated trading algorithm. This system constructs the electronic message represent, ing the order. 2. Brokerage system. The order is transmitted to the trader's broker. Brokers act as intermediaries, providing market access and managing client accounts. Their systems typically include order management system, OMS responsible for routing, validating, and lifecycle management of orders, e.g., tracking status, managing partial fills, cancellations. Execution management system, EMS often integrated with or part of the OMS. The EMS focuses on optimizing order execution, potentially breaking down large orders or routing them to specific venues. Connectivity. Brokers use standardized messaging protocols like FIX, Financial Information Exchange, to communicate orders and market data with exchanges. FIX messages are highly structured text-based messages designed for high-speed, reliable financial information exchange. 3. Exchange's matching engine. The broker's system routes the order to the relevant exchange. The exchange's core component is its code snippet, a sophisticated computer system that matches buy and sell orders based on predefined rules, e.g., price time priority. This is where trades are actually executed. It's distinct from the overall exchange entity, serving as the central processing unit for order pairing. 4. Clearinghouse, central counterparty, CCP. Once a trade is executed by the matching engine, details are sent to a clearinghouse or central counterparty, CCP. The CCP guarantees the trade, becoming the buyer to every seller and the seller to every buyer. This significantly reduces counterparty risk. An example is SGX's CDP, the Central Depository, PT, Ltd., which acts as the clearing and settlement arm for the Singapore Exchange. 5. Settlement. After clearing, the actual transfer of securities and funds occurs between the parties, typically facilitated by the CCP and custodian banks. This entire process, from order submission to execution, often takes mere milliseconds or even microseconds, especially in high-frequency trading, HFT, environments. Let's conceptually simulate sending an order using our code snippet class and a simplified code snippet class. This pseudocode illustrates the interaction without detailing the complex network communication. Download the code on OnePageCode Substack. The code snippet function demonstrates how a code snippet object might be converted into a dictionary and then a JSON string, which is a common intermediate format for data exchange, e.g., for APIs, or conceptually similar to a fixed message. The code snippet class simulates the initial steps of order processing, assigning an ID, and preparing the order for transmission. Download the code on OnePageCode Substack. This example ties together the code snippet object creation with its conceptual submission through a code snippet. The code snippet being populated on the code snippet object illustrates an important part of the order lifecycle. Once acknowledged by the broker/exchange, the order receives a unique identifier for tracking, latency, and its impact. The speed at which an order travels from a trader's system to the exchange and back is known as code snippet. In modern electronic markets, especially in high-frequency trading, HFT, latency is a critical factor. Even a few microseconds can make a significant difference. Network latency, time taken for data to travel across physical networks. Proximity to exchange servers, code snippet, is a major advantage for HFT firms as it minimizes the physical distance data has to travel. Processing latency, time taken by various systems, brokers OMS/EMS, exchanges matching engine, to process the order. Efficient algorithms, optimized software, and specialized hardware, like FPGAs, are used to minimize this. Lower latency allows traders to react faster to market changes, capture fleeting arbitrage opportunities, and ensure their orders are among the first to arrive at the exchange, increasing their chances of execution at favorable prices. Order modification and cancellation. Once an order has been submitted and acknowledged, it may still be modified or canceled as long as it has not been fully executed. These are critical functionalities for traders to manage their positions and risk. Modification. A trader might want to change the code snippet of a limit order or adjust the code snippet of an unexecuted order. This involves sending a code snippet instruction to the broker/exchange, referencing the original order's unique code. The exchange's matching engine will then update the order in its order book, potentially changing its priority. Cancellation. If a trader no longer wishes for an order to be active, they send a code snippet instruction. Again, the code snippet is essential. The exchange removes the order from its order book, preventing any further executions. The immediate impact of a cancellation or modification is that the order is either removed from the market or its parameters are updated, affecting its priority or eligibility for matching. Let's extend our conceptual code snippet to include code snippet and code snippet functionalities. Download the code on OnePatchCode Substack. This extended code snippet class now manages a simple code snippet dictionary, demonstrating how a system might track orders and perform code snippet and code snippet operations. Download the code on OnePatchCode Substack. This sequence clearly illustrates the practical application of order modification and cancellation, showing how the state of an order changes within the system. Advantages of electronic trading. The shift from manual, floor-based trading to fully electronic systems has revolutionized financial markets, bringing forth numerous benefits. Reduced transaction costs. Electronic systems automate processes that previously required human intervention, leading to lower operational costs for exchanges and brokers. These savings are often passed on to traders in the form of tighter bid-ask spreads and lower commissions. Increased speed and efficiency. Orders are processed in milliseconds or microseconds, allowing for rapid execution and real-time price discovery. This efficiency minimizes the risk of price slippage and ensures trades are executed at the best available prices. Enhanced transparency. Electronic order books provide real-time visibility into market depth and liquidity. Traders can see the exact prices and quantities of outstanding buy and sell orders, fostering a more transparent trading environment compared to opaque floor-based systems. Democratized market access. Electronic platforms have lowered the barriers to entry for individual traders and smaller institutions. Anyone with an internet connection and a brokerage account can access global financial markets, previously reserved for large institutional players. Improved liquidity. The speed and accessibility of electronic markets attract more participants, leading to higher trading volumes and deeper liquidity. This makes it easier to buy or sell instruments without significantly impacting prices. Greater accuracy and reduced errors. Automated systems significantly reduce the potential for human error inherent in manual trading processes, leading to more reliable and accurate trade execution and record keeping. Facilitation of algorithmic trading. The digital nature of electronic orders is the bedrock for sophisticated algorithmic trading strategies, including high-frequency trading. HFT, which rely on rapid data processing and automated decision-making at speeds impossible for humans. These advantages collectively contribute to more robust, efficient, and accessible financial markets, benefiting a wide range of participants from individual investors to large institutional funds. Proprietary and agency trading. Understanding the fundamental distinctions between proprietary trading and agency trading is crucial for anyone engaging with electronic markets, whether as a trader, a system designer, or a market analyst. These two distinct approaches define the motivations, risk profiles, and operational structures of various market participants. Proprietary trading. Proprietary trading, often shortened to prop trading, involve a financial institution or individual trading financial instruments with their own capital for the direct purpose of generating profits for themselves or their firm. The term proprietary emphasizes that the capital used belongs to the trading entity and any profits or losses directly accrue to that entity. Objectives and revenue model. The primary objective of proprietary trading is to maximize direct profit from market movements. Unlike agency trading, which earns commissions, prop trading desks generate revenue by successfully predicting price movements, exploiting market inefficiencies, or providing liquidity. Their revenue model is entirely dependent on trading performance. Profitable trades contribute directly to the firm's bottom line, while losing trades directly deplete its capital. Risk profile and management. Proprietary trading inherently carries a high degree of market risk. Since the firm is trading its own capital, it bears full responsibility for any potential losses. This direct exposure to market fluctuations necessitates robust risk management frameworks. Key aspects of risk management in proprietary trading. Capital allocation limits. Firms set strict limits on how much capital can be deployed in specific strategies, instruments, or markets. Position limits. Maximum allowable sizes for open positions are defined to prevent overexposure to any single asset or market. Loss limits. Stop losses, automated or manual triggers are put in place to cut losses when a position moves unfavorably beyond a predefined threshold. This is a critical component of daily risk management. Value at risk, VAR, and stress testing. Sophisticated quantitative models are used to estimate potential losses over a specific time frame and under extreme market conditions, often simulating historical or hypothetical market shocks. Real-time monitoring. Continuous oversight of trading activity, P&L, profit and loss, and risk metrics is critical. Trading systems are designed to provide immediate feedback on exposure and performance. Consider a simple example of how a proprietary trading firm might manage its risk by defining its exposure and setting limits. While a full-fledged risk engine is complex, we can illustrate the concept of a code snippet tracking its P&L and applying a simple loss limit. Download the code on OnePageCode Substack. This initial class sets up a basic code snippet with an initial capital and a predefined daily loss limit, expressed as a percentage of the initial capital. The code snippet method updates the portfolio's code snippet and, crucially, checks if the code snippet has fallen below the set loss limit. If it has, it prints a warning and returns code snippet, indicating that trading should cease. Download the code on OnePageCode Substack. This example execution demonstrates how the code snippet class would track P&L and trigger a halt when a predefined daily loss limit is breached. This simple mechanism is a foundational element of more complex risk management systems used by proprietary trading firms, ensuring that capital is protected from excessive losses. Examples of firms and strategies. Proprietary trading is conducted by a variety of entities. High-frequency trading, HFT, firms like Citadel Securities, Hudson River Trading, and Jump Trading are prominent examples. They use sophisticated algorithms and ultra-low latency infrastructure to execute a vast number of trades, often focusing on market making, arbitrage, and statistical arbitrage strategies. Their success hinges on speed and the ability to capture minuscule profits repeatedly. Hedge funds. Many hedge funds engage in proprietary trading strategies, deploying their investors' capital, which, from the fund's perspective, is its own capital for trading purposes, to generate absolute returns. Their strategies vary widely, from long/short equity to global macro and quantitative strategies. Investment banks. Pre-Volcker rule historically, large invest, meant banks had significant proprietary trading desks. However, regulations like the Volcker rule, discussed below, have largely curtailed this activity for banks that also take insured deposits, pushing such activities into separate, non-bank entities or hedge funds. Regulatory considerations. In the wake of the 2008 financial crisis, regulations were introduced to limit proprietary trading by institutions that also engage in traditional banking activities, e.g., accepting deposits. The most notable example is the Volcker Rule in the United States, part of the Dodd-Frank Act. The Volcker Rule generally prohibits banks from engaging in short-term proprietary trading for their own accounts and from owning, sponsoring, or having certain relationships with hedge funds or private equity funds. The intent was to reduce systemic risk by preventing banks from using insured deposits to fund speculative trading activities, thereby protecting taxpayers from potential bailouts due to excessive risk-taking. While the rule has seen some modifications over time, its core principle remains. For firms that only engage in proprietary trading, like pure HFT firms or hedge funds, regulation focuses more on market integrity, capital adequacy, and reporting requirements rather than a direct prohibition of the activity itself. Hypothetical scenario: arbitrage strategy. Consider a proprietary trading firm executing a simple two-venue arbitrage strategy. The firm aims to profit from temporary price discrepancies for the same asset on different exchanges. Let's simulate a scenario where a firm identifies an arbitrage opportunity for a stock, say code snippet, trading on exchange A and exchange B. The goal is to buy where it's cheaper and simultaneously sell where it's more expensive, locking in a risk-free profit. Download the code on OnePageCode Substack. This code defines the code snippet and code snippet classes. The code snippet method within the code snippet class checks for price discrepancies between two simulated exchanges. If a profitable opportunity above a minimum margin is found, it simulates the simultaneous buy and sell, directly updating the firm's capital with a net profit. This highlights the direct, profit-seeking nature of proprietary trading. Download the code on OnePageCode Substack. This main execution block simulates market price updates and calls the code snippet method. It artificially introduces profitable opportunities to demonstrate the strategy. This simplified model highlights how a proprietary firm uses its capital to directly exploit market inefficiencies for profit, bearing all the associated risks. Agency trading. Agency trading involves a broker or financial institution executing trades on behalf of its clients. In this model, the firm acts as an agent for the client, facilitating the transaction without taking on the market risk of the underlying position itself. Objectives and revenue model. The primary objective of an NCY broker is to provide efficient and cost-effective execution services to its clients. Their revenue model is based on commissions or fees charged for each executed trade, regardless of whether the trade itself is profitable or unprofitable for the client. The broker's incentive is to maximize trade volume and client satisfaction to earn more commissions and retain clients. Risk profile. Agency trading carries significantly less market risk for the broker compared to proprietary trading. The broker does not hold the principal position and is not exposed to price fluctuations. However, agency brokers face other types of risks. Operational risk. Risks associated with errors in order execution, system failures, or fraudulent activities. This includes ensuring robust technology infrastructure and back-office processes. Reputational risk. Failure to achieve best execution or mishandling client orders can damage the broker's reputation, leading to loss of clients and potential legal liabilities. Compliance risk. Failing to adhere to regulatory requirements, especially those related to best execution and client protection. Credit risk. Limited in some cases if a client defaults on settlement, e.g., fails to deliver shares or cash after a trade. The broker might temporarily face exposure, though this is usually mitigated by pre-funding requirements, margin calls, or robust clearing mechanisms. Examples of firms and clients. Agency trading is the core business model for retail brokerages. Firms like Charles Schwab, Fidelity, E-Trade, and Robinhood primarily act as agents for individual investors, executing their buy and sell orders. They often provide user-friendly platforms and educational resources. Institutional brokerages, divisions within large investment banks, e.g., Goldman Sachs, Morgan Stanley, or specialized firms that cater specifically to institutional clients like mutual funds, pension funds, hedge funds, and sovereign wealth funds. These clients often place large block orders that require sophisticated, low-impact execution strategies. Electronic communication networks, ECNs/alternative trading systems, ATSs, while not brokers themselves, These platforms facilitate agency trading by matching buy and sell orders from various participants, often providing transparent and efficient execution. Regulatory considerations. Best execution. A cornerstone principle in agency trading, particularly for institutional clients, is best execution. This is a regulatory and fiduciary obligation for brokers to execute client orders in a manner that is most advantageous to the client, considering all relevant factors. It's not simply about getting the lowest price for a buy order or highest for a sell order, but a holistic assessment of trade quality. Achieving best execution involves considering price, the actual execution price relative to the prevailing market. Speed, how quickly the order is executed. Likelihood of execution, the probability of the order being filled, especially for large or illiquid orders. Likelihood of settlement, ensuring the trade will successfully clear and settle. Size and nature of the order. Small, liquid orders might prioritize speed, while large block orders prioritize minimizing market impact. Overall cost, including commissions, fees, and implicit costs like market impact. Practical aspects of best execution. Smart order routing. SOR brokers use sophisticated algorithms to route orders to multiple exchanges, dark pools, and other trading venues to find the best available price and liquidity at any given moment. Algorithmic execution strategies. For large institutional orders, brokers deploy algorithms, e.g., VWAP, TWAP, POV, to slice orders into smaller pieces and execute them over time, minimizing market impact and achieving optimal average prices. Venue analysis, continuous quantitative analysis of execution quality across different venues to inform and optimize routing decisions. Transparency and reporting, providing clients with clear and detailed reports on how their orders were executed, including venue, price, and timestamps, to demonstrate compliance with best execution obligations. In Europe, the MiFID II, Markets and Financial Instruments Directive II, regulation places a strong emphasis on best execution, requiring investment firms to take all sufficient steps to obtain the best possible result for their clients. It mandates detailed disclosure, requirements for execution venues and order routing practices, increasing transparency and accountability. Order types in agency trading. Held versus market not held orders. The level of discretion given to an agency broker by a client is critical and defines different order types. Held orders. Definition. These are orders where the client gives the broker strict instructions regarding price and time. The broker is held accountable for executing the order precisely according to these parameters. If the market conditions do not meet the specified price and time, the order may not be executed. Examples include specific limit orders, code snippet, market on open, code snippet, or fill or kill, code snippet orders. Broker's discretion, very limited. The broker's role is primarily to route the order to the market as instructed. They are not expected to use discretion to achieve a better price if it means deviating from the explicit instructions. Risk. The risk of non-execution or partial execution due to strict constraints lies largely with the client. The broker is responsible for attempting to fill the order as specified. Market not held orders. Definition. These orders give the broker discretion over the time and price of execution, as long as they strive for best execution. The client does not hold the broker to a specific price or time, but rather trusts the broker to work the order to achieve the best overall outcome. These are common for large institutions. L-block orders where immediate, full execution might cause significant market impact, i.e., moving the price against the client. Broker's discretion, significant. The broker can choose when and how to slice the order, which venues to use, and what algorithmic strategies to employ to minimize market impact and achieve the best average price for the client. Risk. The broker assumes more responsibility for the execution strategy and its outcome, subject to the best execution principle. The client implicitly accepts that the final execution price might deviate from the current market price at the time of order placement due to the working of the order over time. Practical scenario. Working a market-not-held order. Imagine an institutional client wants to sell 100,000 shares of a stock, code snippet, that typically trades 500,000 shares a day. A direct market order for such a large quantity would likely cause significant price impact, pushing the price down against the client. Instead, the client places a market-not-held order with their agency broker. The broker's task is to work this large order throughout the day using an algorithmic strategy, aiming to sell the shares without moving the market against the client. Let's simulate a simplified VWAP, volume-weighted average price, strategy, which aims to execute an order in line with the market's historical volume profile. Download the code on OnePageCode Substack. This initial code block sets up the code snippet code, snippet, and code snippet classes. The code snippet provides fluctuating prices and liquidity. The code snippet has a code snippet method, which conceptually represents the broker's smart order router finding the best price across venues for a small order chunk. This is the core mechanism by which best execution is attempted. Download the code on OnePageCode Substack. The code snippet method simulates the core logic of an algorithmic execution strategy, breaking a large order into smaller slices and executing them over time. The code snippet method, though simplified, represents the broker's responsibility to find the best available price for each slice. This demonstrates how an agency broker minimizes market impact for large client orders and highlights the best execution principle and a commission-based revenue model. The example also briefly contrasts this with a held order, where the broker's discretion is limited by the client's explicit instructions. Conflicts of interest in hybrid models. Some large financial institutions, particularly investment banks, historically engaged in both proprietary trading and agency trading, though the Volcker rule has significantly curtailed the former for deposit-taking institutions. This can create potential conflicts of interest. For example, a bank's proprietary desk might gain knowledge of a large client order agency business that is about to hit the market. This non-public information could be used by the prop desk to trade ahead of the client order, a practice known as front-running, profiting from the anticipated price movement that the client's order might cause. This is illegal, unethical, and a clear breach of fiduciary duty to the client. To mitigate such conflicts, institutions employ strict information barriers, often called Chinese walls, between different departments. These barriers prevent the flow of sensitive, non-public information from one desk to another. Additionally, robust compliance frameworks, surveillance systems, and internal policies are put in place to monitor and prevent such abuses, ensuring that client interests are prioritized. Comparative analysis, proprietary versus agency trading. Here's a summary comparing the key characteristics of proprietary and agency trading. Feature proprietary trading, agency trading. Capital source, firm's own capital, client's capital. Primary objective, direct profit generation for the firm, efficient and best execution for clients. Revenue model, trading profits, P&L, commissions, and fees from execution. Risk bearer, the trading firm, bears market risk. The client bears market risk. Brokers risk, high market risk, operational risk, counterparty risk, operational risk, reputational risk, compliance risk, limited credit risk. Client relationship, none, trading for S. ELF, fiduciary duty to client, strong client relationship. Regulatory focus, capital adequacy, systemic risk, e.g., Volcker rule, market integrity, anti-manipulation, best execution, e.g., MiFID2, transparency, fair dealing, anti-front-running. Order discretion, full discretion over trades client-defined, held orders, or broker discretion, market-not-held orders. Typical firms, high-frequency trading, HFD, firms, hedge funds, specialized proprietary trading shops, retail brokerages, institutional brokerages, prime brokers. Example strategy, arbitrage, market making, statistical arbitrage, directional bets, high-frequency trading, VWAP/TWAP execution, smart order routing, block trading facilitation. Understanding these distinctions is fundamental to comprehending the diverse roles and incentives of participants within electronic markets. It also provides critical context for designing and implementing trading systems, as the requirements for an order management system, OMS, or execution management system, EMS, handling proprietary trades differ significantly from one managing client orders with best execution obligations and varying levels of broker discretion. Order matching systems. Electronic markets rely on sophisticated systems to efficiently pair buyers and sellers. At the heart of every electronic exchange lies the matching engine, a high-speed, rule-based system responsible for processing incoming orders and executing trades. Understanding how these systems operate is fundamental for anyone involved in electronic trading, from market participants to system developers. The matching engine and the order book. The core function of an order matching system is to maintain an accurate and up-to-date record of all outstanding buy and sell orders for a given instrument, known as the order book, and to automatically match compatible orders for execution. The role of the matching engine. The matching engine is a complex piece of software designed for speed, reliability, and fairness. Its primary responsibilities include order validation, ensuring incoming orders adhere to market rules, e.g., valid price, quantity, instrument. Order book management, adding new limit orders to the appropriate price levels on the order book. Order matching, identifying and executing trades when an incoming order can be matched against existing orders on the book. Trade confirmation, generating trade confirmations for executed orders. Order cancellation/modification, processing requests to cancel or modify existing orders. The order book, the heart of the exchange. The order book is a real-time ledger of all unexecuted limit orders. It is typical LLY structured into two sides. Bids by orders to buy a security at a specified price or better. These are sorted in descending order by price, highest bid first. Asks, sell orders to sell a security at a specified price or better. These are sorted in ascending order by price, lowest ask first. The difference between the highest bid and the lowest ask is known as the bid-ask spread, which represents the cost of immediate execution. From a programming perspective, an order book requires data structures that allow for extremely fast insertions, deletions, and lookups. Data structures for an order book. A simplified order book can be conceptualized using nested data structures. At a high level, we need to quickly access orders at specific price levels, and within each price level, maintain the order of orders based on time priority. A common approach involves using dictionaries, hash maps, where keys are price levels and values are lists or queues of orders at that price. For efficiency, these lists should ideally be sorted or behave like priority queues to maintain time priority. Let's start with a basic structure for an order. Download the code on one patch code Substack. The code snippet class encapsulates all necessary details for an individual order, including its unique ID, the trader who placed it, its side by sell, price, quantity, and a timestamp for time priority. We also introduce code snippet to track original size and code snippet for ending iceberg orders later. Now, let's define the core code snippet structure. Download the code on one patch code Substack. The code snippet class stores code snippet and code snippet as dictionaries mapping prices to lists of code snippet objects. The code snippet dictionary provides a fast lookup by code snippet for cancellations. The code snippet method demonstrates how to present the order book, sorting prices appropriately for each side. Note that for simplicity, the lists within price levels are assumed to maintain time priority as orders are appended. In a high-performance system, these would be more complex data structures like linked lists or specialized queues that efficiently handle insertions and deletions while preserving order. Unlinked partial fees. A partial fill occurs when an order is executed for only a portion of its total quantity. This is common, especially for large orders, where there might not be enough opposing liquidity at a single price level to fill the entire order. When a partial fill occurs, 1. The executed quantity is removed from the matched orders on the book. 2. The incoming order's remaining quantity is updated. 3. A trade confirmation is generated for the executed quantity. 4. If the incoming order still has remaining quantity, it might continue to seek matches at the same or worse price for market orders. Be placed on the order book at its specified limit price for limit orders. The code snippet attribute in our code snip. T-class will be dynamically updated as partial fills occur, while code snippet will preserve the original size for reporting or analysis. Order precedence rules. Electronic exchanges use a defined set of precedence rules to determine which orders on the book get matched first when a new order arrives. These rules ensure fairness and predictability in trade execution. 1. Price precedence, price time priority. This is the most fundamental rule. Orders with a better price always take precedence over orders with a worse price. For buy orders, bids, a higher price is better. A buy order at $10.05 will be matched before a buy order at $10. For sell orders, asks, a lower price is better. A sell order at $10.10 will be matched before a sell order at $10.15. 2. Time precedence, price time priority. Among orders at the same price level, the order that arrived first, earliest timestamp, takes precedence. This is why it's often called price time priority. This rule rewards traders who are willing to commit liquidity earlier. 3. Display precedence, lit versus unlit orders. Some exchanges introduce a display precedence rule. Orders that are fully displayed, lit, on the order book may take precedence over hidden, unlit, or iceberg orders at the same price and time. This incentivizes market participants to provide transparency and liquidity to the market. Lit orders, fully visible on the order book, showing their full quantity. Unlit/hidden orders, orders where some or all of the quantity is not displayed. Iceberg orders are a common type of unlit order, where only a small tip is displayed, and the rest remains hidden until the displayed portion is filled. This allows large traders to place significant orders without revealing their full interest and potentially moving the market against them. 4. Size precedence. Less common than price and time, but present in some markets, e.g., some futures exchanges or dark pools. Size precedence means that among orders at the same price and time, larger orders might be given priority. This rule encourages the placement of larger blocks of liquidity. In markets using pro rata matching, size often plays a role, where available quantity is allocated proportionally to order size. Combining precedence rules. The typical hierarchy for matching in a continuous double auction market, the most common type, is 1. Price. Best price always wins. 2. Time. First in, first out FIFO at a given price. 3. Display. If applicable lit orders before hidden orders at the same price and time. 4. Size. If applicable larger orders before smaller orders or pro rata allocation. Code simulation. Applying precedence rules. Let's enhance our code snippet with a code snippet method that simulates the core matching logic, applying price and time precedence. We'll also handle partial fills. Download the code on OnePageCode Substack. The code snippet method is the core of our simplified matching engine. It iterates through the opposing side of the order book, prioritizing by price and then by time. It handles partial fills by updating quantities and generates trade records. It also includes a basic implementation of display precedence, prioritizing code snippet before code snippet at the same price level. If a limit order isn't fully filled, its remaining quantity is placed onto the order book. Common order types and their interaction with the matching engine. Traders use various order types to express their intent and manage risk. The matching engine processes each type according to specific rules. 1. Limit orders. A limit order is an order to buy or sell a security at a specific price or better. A buy limit order can only be executed at the specified limit price or lower. A sell limit order can only be executed at the specified limit price or higher. If a limit order cannot be immediately matched at its specified price, it rests on the order book until a compatible opposing order arrives, or it is canceled. Limit orders provide liquidity to the market. 2. Market orders. A market order is an order to buy or sell a security immediately at the best available current price. Market orders prioritize immediate execution over price certainty. When a market order arrives, a buy market order will aggressively consume the lowest available sell orders, asks, on the book, moving up in price until fully filled. A sell market order will aggressively consume the highest available buy orders, bids, on book, moving down in price until fully filled. Market orders are guaranteed to execute if liquidity exists, but the execution price is not guaranteed and can be significantly worse than the current quoted best price, especially in volatile or illiquid markets, known as market impact or slippage. Market orders consume liquidity. 3. Cancellation orders. A cancellation order, or simply cancel, is a request to remove a previously placed order from the order book. If the order has already been fully or partially filled, only the remaining unexecuted portion can be canceled. Code simulation, handling various order types. Let's integrate these order types into our simulation. Download the code on OnePageCode Substack. The code snippet function demonstrates how different order types interact with the code snippet and code snippet logic. Limit orders, code snippet, code snippet, code snippet, code snippet are added to the book and rest there until matched. Market orders, code snippet, code snippet, code snippet aggressively consume liquidity from a book. Notice how code snippet first fills against code snippet, 50 units at 100.50, then code snippet, 70 units at 100.00, exhausting code snippet and partially filling code snippet. Partial fills are evident when code snippet and code snippet execute against existing orders, leaving remaining quantities on the book. Cancellation, code snippet, demonstrates removing an order. Iceberg orders, code snippet, show how code snippet works, revealing only a portion of the total quantity and refreshing it as trades occur. Advanced order types. Beyond the common order types, exchanges offer more sophisticated options that allow traders to implement complex strategies or manage risk more effectively. These are typically handled by the exchange's order management system, OMS, or pre-matching engine logic before interacting with the core matching engine. 1. Stop orders. A stop order is an order that becomes a market order or a limit order once a specified stop price is reached or passed. They are commonly used for risk management, to limit potential losses, or to protect profits. Stop loss order. An order to sell a security when it reaches a certain price, the stop price. Once the stop price is hit, it converts into a market order to sell immediately. Example, you own stock at $100. You place a stop loss at $95. If the price drops to $95, your order becomes a market order to sell. Stop limit order, similar to a stop loss, but once the stop price is hit, it converts into a limit order rather than a market order. This provides more price control, but risks the order not being filled if the market moves too quickly past the limit price. Example, you own stock at $100. You place a stop limit at $95 with a limit price of $94. If the price drops to $95, your order becomes a limit order to sell at $94 or better. 2. Trailing stop orders. A trailing stop order is a more dynamic stop order where the stop price adjusts as the market price of a security moves favorably. This allows traders to lock in profits while still protecting against downside risk. Example, you buy a stock at $100 and set a trailing stop of $5. The initial stop price is $95. If the stock rises to $110, your stop price automatically moves up to $105, $110 to $5. If the stock then drops to $105, the order is triggered. 3. Iceberg orders revisited. As discussed under display precedence, iceberg orders allow traders to place large orders without revealing their full size. Only a small portion, the tip, is displayed on the order book, while the rest remains hidden. As the displayed portion is filled, a new tip from the hidden quantity is automatically submitted until the entire order is filled or canceled. This minimizes market impact for large trades. Matching algorithms and market structures. while the continuous double auction with price-time priority is dominant. Other matching algorithms and market structures exist. Continuous double auction. This is the most common matching mechanism used in modern electronic exchanges. Buyers and sellers continuously submit orders, and the matching engine attempts to find immediate matches based on precedence rules. If no immediate match is found, limit orders are placed on the order book, contributing to market depth. Call auctions. In a call auction, orders are collected over a period without immediate matching. At a specific time, the matching engine determines a single clearing price that maximizes the number of trades or volume and executes all eligible orders at that price. Call auctions are often used for market open/close to discover an opening or closing price and consolidate liquidity. Less liquid securities to concentrate orders and improve the chances of execution. Volatility auctions to pause trading during extreme price movements and allow for price discovery. Pro rata matching. In some markets, particularly futures, pro rata matching is used. After price and potentially time priority, if multiple orders remain at the best price level, the available quantity is allocated proportionally to the size of the orders at that level. This incentivizes large orders. Impact of latency on order matching. Latency, the delay in transmitting and processing information, plays a critical role in electronic trading and order matching. Even milliseconds of difference can determine whether an order is filled, partially filled, or missed entirely. Order submission latency. The time it takes for an order to travel from a trader system to the exchange's matching engine. Market data latency. The time it takes for market data, like new best bid/offer prices, to travel from the exchange to traders. High-frequency trading, HFT, firms invest heavily in reducing latency through colocation, placing servers physically close to the exchange's matching engine. Optimized network paths, and ultra-low latency hardware and software. A slight latency advantage can mean an HFT firm's order arrives and gets priority due to time precedence over a slower competitor's order, even if both were submitted almost simultaneously. This highlights the practical importance of understanding time precedence in real-world trading. Market order. A market order is a fundamental instruction given to a broker or an exchange to buy or sell a financial instrument immediately at the best available current price. Unlike other order types, a market order prioritizes speed and certainty of execution over price certainty. Its core directive is to fill the order as quickly as possible by consuming liquidity present in the market's order book. Guaranteed execution, not price. The primary characteristic of a market order is its guarantee of execution. When a market order is placed, it is virtually guaranteed to be filled, provided there is sufficient opposing liquidity in the market. This makes market orders ideal for situations where immediate action is paramount, such as reacting to breaking news or exiting a rapidly deteriorating position. However, this guarantee of execution comes at the cost of price certainty. A market order does not specify a price limit. Instead, it instructs the system to accept whatever prices are necessary to fill the order. This can lead to the order being filled at a price, or an average of prices, that deviates from the last traded price or the current best bid/ask, a phenomenon known as price slippage. Market order mechanics. Interacting with the order book. To understand how a market order works, it's essential to visualize its interaction with the exchange's order book. The order book is a real-time ledger of all outstanding limit orders for a specific financial instrument, organized by price level. It consists of two sides. Bids, orders from buyers willing to purchase at specific prices, sorted from highest price down. Asks, offers orders from sellers willing to sell at specific prices, sorted from lowest price up. When a market order is placed, it sweeps through the order book, consuming available liquidity from the best prices inward until the entire order quantity is filled. A market buy order consumes available sell, ask, orders starting from the lowest ask price. Conversely, a market sell order consumes available buy bid orders starting from the highest bid price. Let's simulate a simplified order book and demonstrate this mechanism with code. Simulating an order book. We'll represent our order book as a dictionary, where keys are price levels and values are the quantities available at those prices. Download the code on one patch code Substack. This code snippet sets up two dictionaries representing the ask, sell, and bid by sides of an order book. Each entry maps a price to the quantity of shares available at that price. For asks, the prices are typically sorted in ascending order, lowest offer first, and for bids, they're sorted in descending order, highest bid first. This structure is crucial for understanding how market orders will interact with the available liquidity. Executing a market buy order. A market buy order consumes liquidity from the ask side of the order book, starting from the lowest available ask price. Download the code on one patch code Substack. This code snippet function simulates the core logic of a market order. It iterates through the code snippet, sell orders, from the lowest price upwards, filling the order quantity at each price level until the entire order is consumed or liquidity runs out. It calculates the code snippet and code snippet, allowing for the computation of the code snippet. The code snippet is updated in real time to reflect the consumed liquidity. The output clearly shows how the order sweeps through different price levels. Executing a market sell order. A market sell order consumes liquidity from the bid side of the order book, starting from the highest available bid price. Download the code on one patch code Substack. The code snippet function operates symmetrically to the buy function. It targets the code snippet by orders, iterating from the highest price downwards. It calculates the code snippet and code snippet, leading to the code snippet. Both simulation functions highlight a critical aspect of market orders. If the requested quantity exceeds the available liquidity at all price levels, the order will be partially filled up to the available quantity, and the remaining portion will not be executed. This is an important distinction, as some might assume market orders are always entirely filled. They are, but only up to the available liquidity. The critical risk, price slippage. As demonstrated by the simulations, a market order can be fill at an average price that is different from the best available price at the moment the order was placed. This difference is known as price slippage. Slippage occurs because a market order, by its nature, consumes liquidity across multiple price levels, especially for larger quantities or in thinner markets. Defining slippage. Slippage is the difference between the expected price of a trade and the price at which the trade actually executes. For market orders, the expected price is often considered the best available bid for a market sell or ask for market buy at the moment of order submission. Positive slippage, or favorable slippage, occurs when the execution price is better than expected. For a buy, this means buying at a lower price. For a sell, selling at a higher price. This is rare for market orders and usually happens due to rapid market movements in your favor between order submission and execution. Negative slippage, or unfavorable slippage, occurs when the execution price is worse than expected. For a buy, this means buying at a higher price. For a sell, selling at a lower price. This is the common form of slippage for market orders, especially for large orders. Calculating slippage. Let's use our previous market buy example to calculate slippage. Suppose the best ask price when we placed the order was $100.05. Download the code on one patch code Substack. This code calculates the per unit slippage and the total slippage cost. For the buy order, the effective price, $100.06, was higher than the initial best ask, $100.05, resulting in a negative slippage of 1 cent per unit. For the sell order, the effective price, $100.0367, was lower than the initial best bid, $100.04, also resulting in a negative slippage of approximately $0.0033 per unit. This demonstrates how market orders can eat into less favorable prices when consuming deeper liquidity. Factors influencing slippage. The magnitude of slippage depends primarily on two factors. 1. Order size. Larger market orders require consuming more liquidity levels, increasing the likelihood of reaching less favorable prices deeper in the order book. 2. Market liquidity/depth. In highly liquid markets with many orders at each price level, deep order book, slippage tends to be minimal even for larger orders. In illiquid markets with sparse orders, even small market orders can cause significant slippage due to the rapid exhaustion of available liquidity at favorable prices. Market orders in low liquidity scenarios. The risks associated with market orders are significantly amplified in low liquidity environments. Exacerbated slippage and price impact. When an order book is thin, meaning there are few orders or small quantities at each price level, a market order can quickly consume all available liquidity at the best prices and move the market price significantly. This is known as price impact. A large market buy order in a thin market might not only experience high slippage but also push the ask price much higher for subsequent trades, potentially moving the market against the trader. Conversely, a large market sell order could drastically push the bid price lower. Thin order books. Consider a scenario where the ask book only has 10 units at $100.05 and then jumps to 500 units at $100.50. A market buy order for 50 units would consume the 10 units at $100.05 and then immediately jump to consuming 40 units at $100.50, leading to very high average slippage. This scenario highlights why market orders are generally discouraged for large quantities in thinly traded instruments. Market orders versus limit orders, a comparative analysis. Understanding the trade-offs between market orders and limit orders is crucial for effective trading. While market orders prioritize speed and certainty of execution, limit orders prioritize price control. Feature market order, limit order. Execution guarantee high, virtually guaranteed if liquidity exists, low. Only executes if market reaches specified price. Price control none, executes at best available price. High, executes at or better than specified price. Speed immediate can be immediate or take time, or never execute. Slippage risk high none, introduces liquidity, doesn't consume. Liquidity impact consumes liquidity. Taker provides liquidity. Acre. Cost implications often higher due to slippage. Sometimes higher exchange fees, taker fees, often lower due to no slippage. Sometimes lower exchange fees, maker rebates. Use case urgency, rapid entry/exit, high conviction price sensitivity, adding liquidity, avoiding slippage. Choosing the right order type. The choice between a market order and a limit order depends entirely on a trader's priorities for a given trade. Use a market order when urgency is paramount. You need to enter or exit a position immediately, regardless of minor price deviations. High liquidity is present. In very active markets where the bid-ask spread is tight and depth is significant, slippage for reasonable order sizes is minimal. Conviction is high. You believe the price will move significantly and quickly, and getting in a slash out of the trade is more important than optimizing a few basis points on price. Avoid a market order when price is paramount. You have a specific price target and are unwilling to deviate. Low liquidity is present. To prevent significant slippage and price impact, you want to earn maker rebates. Some exchanges reward traders who add liquidity, limit orders. Practical applications and algorithmic considerations. Market orders, despite their risks, are indispensable tools in quantitative trading strategies, particularly those requiring rapid responses to market events. Urgency and portfolio rebalancing. Imagine a sudden news announcement that DRA slightly impacts the fair value of an asset in your portfolio. To quickly rebalance or exit the position, a market order might be the most efficient way to ensure immediate execution, even if it incurs some slippage. The cost of delay could outweigh the cost of slippage. Exiting deteriorating positions. If a trade is rapidly moving against a predefined stop-loss level, an algorithmic trading system might be programmed to use a market order to exit the position immediately, preventing further losses. In such a scenario, the certainty of exiting is prioritized over the exact exit price. Hypothetical API interaction. In a real-world trading system, placing a market order through an API would typically involve a function call that specifies the instrument, quantity, and direction, but importantly, no price. Download the code on OnePageCode Substack. This pseudocode demonstrates a typical API interface for market orders. Notice the absence of a price parameter, which is characteristic of market orders. The function returns a dictionary representing an order confirmation, which would then be updated by the system as the order progresses through execution states. Algorithmic decision-making. Sophisticated algorithms might dynamically decide whether to use a market order or a limit order based on real-time market conditions. Download the code on OnePageCode Substack. This code snippet function provides a simplified example of how an algorithm might choose between a market and limit order. It considers factors like code snippet, and code snippet. High volatility might push toward a market order for speed, while wide spreads or shallow depth would favor a limit order to mitigate slippage. For large orders, the algorithm might also assess if the top of the order book can absorb a significant portion of the trade before resorting to a limit order. This dynamic decision-making is a cornerstone of advanced algorithmic trading strategies. Limit order. A limit order is a fundamental order type in electronic trading that allows a trader to specify the maximum price they are willing to pay for an asset for a buy order, or the minimum price they are willing to accept for an asset for a sell order. Unlike a market order, which prioritizes immediate execution at the best available price, a limit order prioritizes price certainty. Defining limit orders. At its core, a limit order is a conditional instruction. It instructs the exchange to execute a trade only if the market price reaches or improves upon the specified limit price. By limit order, placed at or below the current ask price. The order will only execute at the limit price or lower. For example, if a stock is trading at $100 bid $100.05 ask, a buy limit order placed at $99.50 will wait until the ask price drops to $99.50 or below. Sell limit order, placed at or above the current bid price. The order will only execute at the limit price or higher. For example, if the same stock is trading at $100 bid $100.05 ask, a sell limit order placed at $100.50 will wait until the bid price rises to $100.50 or above. The defining characteristic of a limit order is the trade-off between price certainty and execution certainty. Price certainty. When you place a limit order, you're guaranteed that if your order executes, it will do so at your specified limit price or a better price. You will not pay more than your limit price for a buy, nor receive less than your limit price for a sell. Execution certainty. The major drawback of a limit order is that there is no guarantee of execution. If the market never reaches your specified limit price, or if it moves past it too quickly without filling your order may remain unfilled, partially filled, or expire without ever trading. This is in stark contrast to a market order, which guarantees execution, but not price. Comparison. Limit order versus market order. Understanding the nuances of limit orders is best achieved by contrasting them with market orders, which were discussed in a previous section. Feature market order, limit order. Execution priority, immediate execution price priority, then time, then size. Price certainty, no guarantee. Executes at best available price, guaranteed execution at or better than limit price. Execution certainty, guaranteed execution. If liquidity exists, no guarantee. May not execute if price isn't met. Impact on market, takes liquidity, consumes standing orders, provides liquidity, adds standing orders to the order book. Placement executes against existing orders, immediately resides on the order book until matched or canceled. Use case, urgent trades, highly liquid markets, price-sensitive trades, illiquid/volatile markets, setting price. Targets, risk price slippage, unfavorable execution price, non-execution, missed opportunity. The limit order book, LOB. Limit orders are the building blocks of an exchange's limit order book, LOB. The LOB is a dynamic, real-time electronic ledger that lists all outstanding limit buy, bids, and limit sell, asks, orders for a particular financial instrument, organized by price level. Structure of the LOB. The LOB is typically divided into two sides. Bids, limit buy orders, sorted from highest price to lowest price. The highest bid price represents the maximum price a buyer is currently willing to pay. Asks, limit sell orders, sorted from lowest price to highest price. The lowest ask price represents the minimum price a seller is currently willing to accept. The difference between the highest bid and the lowest ask is known as the bid-ask spread. This spread represents the cost of immediate execution. Consider a simplified view of an order book for a stock, XYZ. Price, bid, quantity, bid, price, ask, quantity, ask. Backslash dollar 100.00 250 backslash dollar 100.05 100 backslash dollar 99.95 150 backslash dollar 100.10 300 backslash dollar 99.9400 backslash dollar 100.15 200. In this example, the best bid is backslash dollar 100.00 for 250 shares, and the best ask is backslash dollar 100.05 for 100 shares. The bid-ask spread is backslash dollar 0.05. Order precedence rules. When a new limit order is placed, or when an incoming order, like a market order, interacts with the LOB, the exchange's matching engine follows strict precedence rules to determine which orders get filled first. 1. Price priority. The most critical rule. Buy orders at higher prices have priority over buy orders at lower prices. Sell orders at lower prices have priority over sell orders at higher prices. In our example, a buy order at backslash dollar 100.00 will be matched before a buy order at backslash dollar 99.95. Similarly, a sell order at backslash dollar 100.05 will be matched before a sell order at backslash dollar 100.10. 2. Time priority, FIFO, first in, first out 4 orders at the same price level. The order that arrived earliest at the exchange has priority. If 2 buy limit orders 4 backslash dollar 100.00 arrive, the one submitted first will be filled first. 3. Size priority, less common. Exchange-specific. Some exchanges may introduce a secondary priority based on order size, e.g., larger orders get priority, but price and time are universally dominant. A limit order, once submitted, does not execute immediately unless its limit price crosses the current best opposing price on the book, e.g., a buy limit order is placed at or above the current best ask, where a sell limit order is placed at or below the current best bid. If it doesn't cross, it is added to the LOB, waiting for a suitable counterorder to arrive. Life cycle of a limit order, a code simulation. To truly understand how limit orders function within an electronic market, let's build a simplified simulation of a code snippet and a code snip. This will allow us to visualize how orders are placed, how they reside on the book, and how they interact with incoming market orders. First, we need a basic code snippet class to represent individual trading instructions. Download the code on OnePageCode Substack. The code snippet class encapsulates all necessary details for a trade instruction. Its unique ID, the instrument, whether it's a code snippet or code snippet order, its code snippet or code snippet, the total code snippet, and crucially, the code snippet for limit orders. We also include a code snippet for time priority and code snippet to manage partial fills. The code snippet attribute helps track the order's current state. Next, we define the code snippet class. This class will manage the collection of outstanding limit orders and handle the logic for adding new orders and matching them against existing ones. Download the code on OnePageCode Substack. The code snippet uses code snippet from the code snippet library. This is crucial because it automatically keeps the prices sorted, ensuring that the best bid, highest price, and best ask, lowest price, are always easily accessible. For each price level, a code snippet is used to store code snippet objects, preserving time priority, FIFO. The code snippet method correctly places limit orders on the bid or ask side. Now, let's implement the core matching logic. This method will simulate an incoming order, either a market order or an aggressive limit order that crosses the spread, interacting with the standing orders in the book. Download the code on OnePageCode Substack. The code snippet method is the heart of our LOB simulation. 1. Directional matching. It checks if the incoming order is a code snippet or code snippet. A code snippet order tries to match with code snippet orders, asks, from the code snippet side of the book, starting with the lowest price. A code snippet order tries to match with code snippet orders, bids, from the code snippet side, starting with the highest price. 2. Limit order crossing. If the code snippet is a code snippet order, the method first checks if it crosses the spread. For a code snippet limit order, if its code snippet is less than the code snippet, it does not cross and is simply added to the code snippet side of the book. Similar logic applies to code snippet limit orders. If it does cross, it behaves like a market order for the matching part. 3. Iterative consumption. It enters a code snippet loop, consuming orders from the best available price level until the code snippet is fully filled or the relevant side of the book is exhausted. 4. Time priority, FIFO. Within each price level, code snippet, orders are processed in the order they were received, code snippet, ensuring FIFO. 5. Partial fills. If the code snippet or a code snippet has more quantity than can be matched in a single step, code snippet is used to determine the code snippet. The code snippet of both orders is updated, and the code snippet is reduced. 6. Price improvement. The code snippet is always the price of the standing order on the book. This means if an incoming code snippet limit order has a limit of $100.00, but the best available code snippet order is at $99.95, the trade will occur at $99.95, providing a better price than the limit. 7. Book maintenance. Fully filled standing orders are removed from the code snippet structure. If a price level becomes empty, it is also removed. 8. Status update. The code snippet of the code snippet is updated to code snippet, or code snippet, if it was a limit order that didn't cross. Example usage. Let's put our code snippet and code snippet classes into action with a step-by-step scenario. Download the code on OnePageCode Substack. We begin by creating an empty code snippet for APL. Then, we add several code snippet orders. Notice how code snippet and code snippet are both sell orders at $150.00. Due to time priority, code snippet will have precedence over code snippet when matching. The code snippet method provides a clean view of the current LOB. Initial order book state. Download the code on OnePageCode Substack. The best bid is $149.60, order 4. And the best ask is $150.00, orders 1, then 5. Now let's simulate an incoming market order. Download the code on OnePageCode Substack. A code snippet order for 180 shares arrives. This order will attempt to consume the cheapest available code snip. Pet orders. 1. It first matches with code snippet. Sell 100 at $150.00. 100 shares are traded at $150.00. Code snippet now needs 80 shares. Code snippet is fully filled and removed. 2. It then matches with code snippet. Sell 75 at $150.00. 75 shares are traded at $150.00. Code snippet now needs 5 shares. Code snippet is fully filled and removed. 3. The code snippet still needs 5 shares. The next best ask is code snippet. Sell 200 at $150.10. It matches with 5 shares from code snippet at $150.10. Code snippet is now fully filled. Code snippet is partially filled and remains on the book with 195 shares. Order book state after market buy. Download the code on OnePageCode Substack. The market order successfully consumed liquidity and was fully filled. The best ask has moved up to $150.10. Next, consider an aggressive limit order. This is a limit order whose price crosses the spread, making it behave like a market order until its quantity is exhausted or it no longer crosses. Download the code on OnePageCode Substack. A code snippet order for 100 shares at $149.70 arrives. The current best bid is $149.60. This order's limit price, $149.70, is higher than the best bid, meaning it is not immediately executable against the best bid. However, if there were a bid at $149.70 or higher, it would match. In our current simplified code snippet logic, a limit order that does not cross the best opposing price is placed on the book. If it crosses the best price, it matches. Let's reevaluate the previous example with the current code snippet logic. The code snippet order at $149.70 is higher than the best bid of $149.60. Therefore, it does not cross the best bid. Instead, it will be added to the code snippet side of the book. This scenario demonstrates a limit order that provides liquidity rather than taking it. Order book state after aggressive limit sell. Incorrect naming, actually non-crossing in this example. Download the code on OnePageCode Substack. In this case, the code snippet was not aggressive enough to cross the best bid. It was placed on the ask side, improving the best ask from $150.10 down to $149.70. Finally, let's simulate a non-crossing limit order, which simply adds liquidity to the book. Download the code on OnePageCode Substack. A code snippet order for 300 shares at $149.00 arrives. The current best ask is $149.70. Since $149.00 is less than $149.70, this order does not cross the spread. It is simply added to the code snippet side of the book below the current best bid of $149.60. Order book state after non-crossing limit buy. Download the code on OnePageCode Substack. This demonstrates how limit orders add depth and liquidity to the order book, waiting for a counterparty to cross the spread and interact with them. Limit order modifiers. Beyond the basic limit order, exchanges often offer various time and force or execution instruction modifiers that dictate how long a limit order remains active and under what conditions it can be filled. These modifiers provide traders with more granular control over their order execution. Et godtid cancelled GTC. Description: a GTC order remains active until it is explicitly canceled by the trader or until the instrument expires, e.g., options contracts. It will not expire at the end of the trading day. Impact: this is the most common default for long-term price targets or passive market making. Traders must remember to cancel GTC orders if their trading plan changes, as they can suddenly fill much later under different market conditions. 2. Immediate or cancel, IOC. Description: an IOC order requires that any portion of the order that can be filled immediately at the limit price or better must be filled. Any remaining, unfilled portion is immediately canceled. Impact: used when a trader wants to take available liquidity now at a specific price, but does not want to leave any remaining quantity on the order book. This is useful for testing liquidity at a price level without adding to the book. 3. Fill or kill, FOK. Description: an FOK order demands that the entire order quantity must be filled immediately and completely at the limit price or better. If the entire quantity cannot be filled, the entire order is canceled. No partial fills are allowed. Impact: this is an extremely strict order type, typically used for very large institutional orders where the trader needs the full position or nothing at all, often to avoid signaling their intent or to ensure a specific trade size. FOK orders are less common for retail traders. These modifiers would typically be an additional attribute on our code snippet class, e.g., code snippet, and would alter the behavior of the code snippet method. For example, if an code snippet has code snippet and code snippet after the matching loop, that code snippet would be immediately canceled instead of being left on the book or causing the order to be partially filled. Practical applications and scenarios. Limit orders are indispensable tools for both manual and automated trading strategies, offering distinct advantages in specific market conditions. 1. Managing risk and preventing unfavorable execution. Scenario. You want to buy shares of a stable company, but are concerned about sudden price spikes if you use a market order. Application. You place a buy limit order at a price slightly below the current market price or at a specific support level. This ensures you won't overpay. If the price momentarily drops to your limit, e.g., due to a flash crash or temporary liquidity imbalance, your order will fill potentially at a much better price than if you had used a market order. Conversely, a sell limit order prevents you from selling at an unexpectedly low price during a sudden market downturn. 2. Buying the dip or selling the rally. Scenario. You believe a stock is temporarily undervalued and expect it to dip to a certain price before rebounding, where you think it's overvalued and will peak at a certain price before falling. Application. You can set a buy limit order at your target dip price or a sell limit order at your target rally price. This allows you to pre-position your trades and potentially capture favorable entry/exit points without constantly monitoring the market. 3. Passive market making. Scenario. You want to profit from the bid-ask spread by simultaneously offering to buy at the bid and sell at the ask. Application. Professional market makers heavily rely on limit orders, placing bids and offers on both sides of the spread. They earn the spread as other participants, using market orders, cross it, filling their limit orders. This provides liquidity to the market and is a sophisticated strategy requiring careful risk management. 4. Trading a liquid or volatile assets. Scenario. You're trading a thinly traded stock or a highly volatile cryptocurrency where the bid-ask spread is wide and prices can jump significantly. Application. Using a market order in such conditions can lead to severe price slippage, where your order executes at a much worse price than anticipated. A limit order is essential here to define your maximum acceptable price for buys or minimum acceptable price for sells, protecting you from extreme adverse price movements. While it risks non-execution, it guarantees price control. Common pitfalls and best practices. While powerful, limit orders come with our own set of challenges. Risk of non-execution. As discussed, the primary risk is that your order may never be filled if the market never reaches your specified price. This can lead to missed opportunities, especially in fast-moving markets where prices might briefly touch your limit and then move away before your order is filled, or if there simply isn't enough opposing liquidity at your price. Stale orders. A GTC limit order placed far from the current market price can become stale if market conditions fundamentally change. For example, a buy limit order at $90 for a stock trading at $100 might be appropriate if you expect a minor dip. However, if the company announces devastating news and the stock plummets to $50, your $90 limit order, if still active, could execute at a price far higher than the new perceived value, leading to significant losses. Monitoring order status. It's crucial to regularly check the status of your limit orders, pending, partially filled, canceled, and the market conditions. Automated systems should have robust order management and monitoring components. Avoid chasing the market. Repeatedly canceling and resubmitting a limit order at an ever-changing price, often called chasing the market, can lead to increased transaction costs if your exchange charges per modification, and can be less efficient than simply using a market order if immediate execution is truly desired. Strategic price placement. Place limit orders at meaningful price levels, e.g., support/resistance levels, previous highs/lows, rather than arbitrary prices. This increases the probability of execution when the market reaches those levels. By understanding the mechanics of limit orders, their interaction with the order book, and their various modifiers, traders and system developers can build sophisticated strategies that balance price control with execution certainty, adapting to diverse market conditions and risk appetites. Limit order book. The limit order book, LOB, stands as the central nervous system of any modern electronic exchange, serving as a real-time ledger of all outstanding limit buy and sell orders for a specific financial instrument. Unlike market orders, which are executed immediately against the best available price, limit orders reside within the LOB, awaiting a counterparty. Understanding the LOB structure, dynamics, and computational representation is paramount for anyone involved in algorithmic trading, market making, or exchange system design. Structure and core components. At its essence, the LOB is a dynamic, sorted collection of limit orders. It is conceptually divided into two distinct sides. Bid side, by orders, contains limit by orders, sorted in descending order of price. The highest price on the bid side is known as the best bid or bid price. These orders represent the maximum price buyers are willing to pay. Ask side, sell orders, contains limit sell orders, sorted in ascending order of price. The lowest price on the ask side is known as the best ask or offer price. These orders represent the minimum price sellers are willing to accept. The LOB maintains orders at various price levels, each level aggregating the total quantity of shares available at that specific price. For example, the bid side might show buyers willing to pay $100, $99.99, $99.98, and so on, each with a corresponding volume. Similarly, the ask side shows sellers willing to accept $100.01, $100.02, $100.03, etc. Best bid and best offer, BBO. The code snippet is the highest price a buyer is currently willing to pay. The code snippet, or code snippet, is the lowest price a seller is currently willing to accept. These two prices form the bid/ask spread. Bid/ask spread. The code snippet is the difference between the best ask price and the best bid price, code snippet. This spread is a critical indicator of market liquidity and transaction costs. Narrow spread indicates high liquidity. There are many buyers and sellers close to each other, making it easy to execute trades without significantly moving the price. Transaction costs for market orders are lower. Wide spread indicates low liquidity. There's a significant gap between what buyers are willing to pay and what sellers are willing to accept. Executing market orders can incur higher transaction costs, as they might have to cross the spread and take out multiple price levels. The spread represents the implicit cost of immediacy. If you want to buy immediately with a market order, you pay the code snippet. If you want to sell immediately, you sell at the code snippet. The difference is the spread you give up for immediate execution. Marketability of orders and liquidity. Orders within the LOB have varying degrees of marketability based on their price relative to the BBO. Aggressive orders. Marketable, these are orders, either limit or market, that are priced to immediately cross the spread and execute. A buy order at or above the code snippet is aggressive, as is a sell order at or below the code snippet. Passive orders. Non-marketable, these are limit orders placed within the spread or outside it, waiting to be matched. A limit buy order below the code snippet or a limit sell order above the code snippet are examples. These orders add liquidity to the market. Market orders. By definition, market orders are always aggressive and consume liquidity. They execute against the best available prices on the opposite side of the LOB until fully filled. Liquidity, in the context of the LOB, refers to the ease with which an asset can be converted into cash without affecting its market price. A deep LOB, with many orders and large quantities at various price levels near the BBO, signifies high liquidity. Conversely, a shallow LOB with few orders or thin quantities indicates low liquidity, making large trades more impactful on price. Computational representation of the limit order book. Implementing an efficient LOB is a core challenge in building high-performance trading systems. The primary requirements are: 1. Fast price lookups. Quickly find orders at a specific price level. 2. Efficient insertion/deletion. Add or remove orders quickly as they are placed, canceled, or matched. 3. Price time priority. Within each price level, orders must be matched strictly by the time they were placed, first in, first out. 4. Sorted price levels. Maintain the bid and ask. Sides sorted by price to easily identify the BBO and iterate through levels for matching. Given these requirements, a common and effective data structure approach involves a combination of hash maps, dictionaries, and order collections like deques or linked lists. Data structure choices. 4 price levels. A code snippet, hash map, is ideal for mapping a price to a collection of orders at that price. This offers 1. Average time complexity for looking up a specific price level. 4 orders at a price level. Within each price level, orders must be stored in time priority order. A code snippet double-ended queue is excellent here, offering 1 append and pop operations, which is crucial for managing incoming orders and matching them by time priority. For maintaining sorted price levels. To quickly find the code snippet or code snippet and iterate through price levels for matching, we need the prices themselves to be sorted. While Python standard code snippet maintains insertion order from Python 3.7+, it's not designed for efficient retrieval of sorted keys or ranges. For truly efficient sorted access, especially in other languages, a code snippet, Java, or code snippet, Python libraries like code snippet, would be used. For simplicity in our example, we can use a standard code snippet and manually sort keys when needed, acknowledging that this adds overhead but simplifies the initial demonstration. For production system, code snippet is highly recommended. Let's begin by defining a simple code snippet class to represent individual orders within our LOB. This class will encapsulate essential order details. Download the code on OnePageCode Substack. This code snippet class is a fundamental building block. Each order has a unique code snippet, code snippet, code snippet, code snippet by a cell, and a code snippet to ensure price time priority. The code snippet is stored to track partial fills, which is crucial in real-world scenarios. The code snippet method provides a readable string representation for debugging and display. Next, we'll outline the code snippet class. We'll use 2 code snippet to represent the bid and ask sides. To easily get the best bid/ask and iterate through sorted price levels, we'll manually sort the keys. For production system, code snippet would be preferred for its efficient sorted key access. Download the code on OnePageCode Substack. The code snippet class initializes 2 dictionaries, code snippet and code snippet, to hold price levels. Each price level will map to a code snippet of code snippet objects, ensuring time priority. A code snippet dictionary is added to quickly retrieve or modify orders by their unique ID, which is essential for order cancellations or modifications. Helper methods code snippet, and code snippet provide quick access to key LOB metrics. Order placement and interaction with the LOB. Orders interact with the LOB in 2 primary ways. 1. Limit order placement. A new limit order arrives, and if it does not immediately cross the spread, is added to the LOB, waiting for a match. 2. Market order execution. A market order arrives and immediately consumes liquidity from the opposite side of the LOB, matching against existing limit orders from the best price outwards until filled. Let's implement the code snippet method first. This method handles the insertion of new limit orders into the appropriate side of the LOB. It also checks for immediate matches if the incoming limit order is aggressive. Download the code on OnePageCode Substack. The code snippet method processes an incoming limit order. It first checks if the order ID already exists. Then, it attempts to match the order against the opposite side of the book. For by order, it iterates through the code snippet from the lowest price upwards, matching any ask orders whose price is less than or equal to the incoming by limit price. For a sell order, it iterates through code snippet from the highest price downwards, matching any bid orders whose price is greater than or equal to the incoming sell limit price. If the order is not fully filled after matching, its remaining quantity is placed on the appropriate side of the LOB. Orders are removed from the code snippet map once fully filled. Now, let's implement the code snippet method. Market orders are simpler in that they don't rest on the book. They consume liquidity immediately. Download the code on OnePageCode Substack. The code snippet function consumes orders from the opposite side of the LOB. For market buy, it iterates through the code snippet from the lowest price upwards. For market sell, it iterates through code snippet from the highest price downwards. It continues to fill the market order by taking out resting limit orders until the market order's quantity is exhausted or no more matching orders are available. Displaying LOB depth. LOB depth refers to the total volume of orders available at various price levels. Displaying a certain number of levels, e.g., 5 levels deep, gives a quick snapshot of market liquidity. Download the code on OnePageCode Substack. The code snippet method provides a human-readable representation of the LOB, showing the best bid/ask, the spread, and the aggregate quantity at each of the top code snippet for both bids and asks. This allows for quick visualization of market depth. Handling hidden orders, iceberg orders. While not explicitly shown in the LOB display, hidden or iceberg orders are a feature of some exchanges. An iceberg order is a large order that is split into smaller, visible limit orders, the tip of the iceberg, and a larger hidden portion. When the visible portion is filled, a new visible portion is automatically placed from the hidden quantity. Within our LOB structure, an iceberg order would be represented as a regular code snippet object, but with an additional attribute, say code snippet and code snippet. The code snippet method would only show the code snippet attribute, the visible part, while the matching logic would need to account for replenishing the visible quantity from code snippet when the visible part is filled. The code snippet map would still track the single code snippet object representing the entire iceberg. Simulating LOB dynamics. Let's put the components together with a simulation to see how orders interact and modify the LOB. Download the code on OnePageCode Substack. This simulation demonstrates the core functionalities. Initial orders. Placing a mix of buy and sell limit orders creates the initial LOB. Note how code snippet is added at the same price as code snippet, but code snippet will have lower priority due to its later timestamp. Market buy. A market order code snippet comes in and consumes the lowest available code snippet. The code snippet order is partially filled. Another market buy. Code snippet further consumes code snippet, completing it, and then starts on code snippet. Aggressive limit buy. Code snippet is a limit buy, but its price code snippet is high enough to cross the spread and match against existing code snippet. This is a crucial distinction. A limit order can behave like a market order if its price is aggressive enough. Market maker activity. This scenario shows how a market maker might place orders to narrow a wide spread, adding liquidity to the book. Liquidity visualization. The final part contrasts the potentially depleted LOB from previous TR. Aids with a newly created, highly liquid LOB, illustrating the difference in depth and spread. Role of market makers. Market makers are crucial participants in electronic markets, playing a vital role in maintaining the health and efficiency of the limit order book. Their primary function is to provide liquidity by continuously quoting both bid and ask prices for security. They profit from the bid/ask spread, buying at their bid price and selling at their ask price. Liquidity provision. By placing limit orders on both sides of the LOB, market makers ensure there are always orders available for traders who wish to buy or sell immediately, i.e., using market orders. This reduces price volatility and allows for smoother execution. Spread narrowing. Market makers compete with each other to offer the tightest possible spread. This competition benefits all market participants by reducing transaction costs. As shown in the simulation, a market maker might place a new bid slightly below the best ask and a new ask slightly above the best bid to narrow the existing spread. Risk management. Market makers face inventory risk, holding too much of an asset that drops in value, and adverse selection risk, trading with informed traders. They manage these risks through various strategies, including hedging, adjusting their quotes, and dynamically managing their inventory. The LOB is not merely a passive list. It's a dynamic ecosystem where various order types and participants interact. CT, constantly shaping the market's immediate landscape. Understanding its internal mechanisms and computational representation is fundamental for any advanced work in quantitative finance or trading system development. Display versus non-display orders. In electronic financial markets, the visibility of an order on the limit order book, LOB, is a critical attribute that significantly influences its execution priority, strategic utility, and regulatory implications. Orders are broadly categorized into two types based on this visibility: display orders and non-display orders. Understanding this distinction is fundamental for any serious participant in electronic trading, from individual quantitative traders to institutional firms and exchange designers. Understanding order visibility. A display order, or displayed order, is an order that is fully visible on the limit order book. This means its price and size are publicly broadcast to all market participants. Display orders contribute to the quoted bid and offer prices, forming the visible market depth. They're the primary means by which market participants provide liquidity to the market, signaling their willingness to buy or sell at specific prices. Conversely, a non-display order, also known as a hidden order or dark order, is a limit order that is intentionally not shown on the limit order book. While it resides on the exchange's internal order matching engine and is eligible for execution, its price and size are not publicly visible. Non-display orders aim to transact without revealing their presence or influencing the market's perception of supply and demand. The code snippet object, incorporating display status. To model these concepts programmatically, we can extend our basic code snippet object to include an attribute that indicates its display status. This attribute is crucial for the order matching engine to correctly process and prioritize orders. Download the code on one patch code Substack. Here, we define code snippet and code snippet using Python's code snippet for clarity and type safety. Code snippet will represent a visible order, and code snippet will represent a non-display order. Download the code on one patch code Substack. This code snippet class now includes a code snippet attribute initialized during order creation. We also added a code snippet attribute, which will be essential for resolving time priority, and a code snippet to track partial fills. The code snippet method provides a readable string representation for debugging and demonstration. Execution priority, price, display, time. The core difference between display and non-display orders manifests most critically in their execution priority within the order matching engine. While the fundamental rule of price-time priority dictates that orders at a better price are executed first, and then orders at the same price are executed based on their arrival time, non-display orders introduce an additional layer of complexity: display precedence. The full priority rule in most modern electronic markets can be summarized as price display time priority. 1. Price priority. Orders at a more aggressive price, higher for bids, lower for asks, always have precedence. This is the absolute first rule. 2. Display precedence. Among orders at the same price, displayed orders have precedence over non-displayed, hidden orders. This means a visible order will be executed before a hidden order at the identical price point, regardless of which arrived first. 3. Time priority. Only after price and display precedence have been applied, orders within the same price level and display status are prioritized based on their time of arrival, first in, first out, or FIFO. Illustrating price display time priority. Let's consider a simplified order matching scenario to see how this rule plays out. We'll simulate a list of orders waiting to be matched. Download the code on one patch code Substack. This helper function allows us to create code snippet objects easily, optionally overriding the code snippet for specific examples where we want to control the perceived arrival order. Download the code on one patch code Substack. The code snippet function encapsulates the core logic of price display time priority. It constructs a tuple as a sort key, code snippet. Python's code snippet function will sort by the first element, then the second, then the third, effectively implementing the desired precedence. Note the use of negative values for code snippet, for by orders, and code snippet to ensure correct ascending/descending order for sorting. Let's put this into practice with a concrete example. Download the code on one pagecode substa. CK. When you run this code, you'll observe the following. 1. Order ID 2, price 101.00, display, comes first due to superior price. 2. Then, among orders at price 100.00, order ID 3, display, comes before order ID 1, hidden, and order ID 5, hidden, due to display precedence. 3. Between order ID 1 and order ID 5, both price 100.00, hidden, order ID 1 comes first due to its earlier timestamp, created first. 4. Finally, order ID 4, price 99.00, display, comes last due to its inferior price. This clearly demonstrates how display precedence slots into the overall priority scheme, ensuring that publicly visible liquidity is prioritized for execution. Regulatory implications, preventing locked and crossed markets. The concept of display orders is closely tied to market regulations designed to maintain fair and orderly markets. A key aspect of this is preventing locked markets and crossed markets. A locked market occurs when the best bid price is equal to the best offer price, e.g., bid 10.00, ask 10.00. A crossed market occurs when the best bid price is higher than the best offer price, e.g., bid 10.05, ask 10.00. These conditions are generally undesirable as they indicate a failure of the market to immediately match available liquidity, or worse, an arbitrage opportunity that should be instantly resolved by the exchange's matching engine. Regulatory frameworks, such as Regulation NMS, National Market System, in the United States, mandate that display orders cannot create locked or cross markets. If a new display order would result in a locked or crossed market, it is typically either rejected, modified to a market order, or immediately executed against existing contra-side orders. Non-display orders, however, operate under different rules regarding market locks. Since they're not visible, they generally can be placed at prices that would create a locked or crossed market if they were displayed. For instance, a hidden buy order could be placed at the same price as the best displayed offer. Such an order would be eligible for execution, but would not cause a market lock on the public LOB because it's not visible. This allows traders to hide liquidity at potentially aggressive prices without publicly disrupting the market structure. Strategic use cases and trade-offs. The choice between using a display or non-display order is a critical strategic decision for traders, depending on their objectives, the size of their order, and their sensitivity to market impact. Display orders. Liquidity provision and transparency. Advantages. Higher execution priority. At a given price, displayed orders are executed before hidden orders. This means a higher likelihood of execution and faster fills. Liquidity provision. Displaying orders adds depth to the LOB, which is crucial for market efficiency. Market makers, for example, primarily use display orders to provide liquidity and earn the bid-ask spread. Transparency. For smaller orders or active trade, RS looking to signal their presence, transparency can be beneficial. Disadvantages. Market impact. Large display orders can signal intent, potentially moving the market against the trader. If a large bid appears, sellers might raise their prices or vice versa. Vulnerability to front-running. While regulations attempt to mitigate this, large visible orders can sometimes attract predatory trading strategies that try to capitalize on the anticipated price movement. Practical example: the retail investor and the market maker. Consider a retail investor who wants to buy 100 shares of a highly liquid stock. They might place a display limit order at the current bid. Their primary goal is to get their order filled quickly at that price, and the small size means minimal market impact risk. The higher execution priority ensures a quick fill if the price is hit. Similarly, a market maker whose business model relies on providing liquidity would predominantly use display orders. They want their quotes to be visible to attract incoming orders and earn the spread. Their systems are designed to manage the risk associated with being on display. Non-display orders. Anonymity and reduced market impact. Advantages. Anonymity. The order's presence and size are concealed, preventing other market participants from reacting to it. This is invaluable for large institutional orders. Reduced market impact. By not revealing size, non-display orders minimize the risk of adverse price movements caused by the order itself. This is crucial for block trades, where a large quantity needs to be bought or sold without pushing the price significantly. Mitigation of front-running. Because the order is hidden, it's much harder for others to front-run it, as they don't know it exists. Fishing for liquidity. Hidden orders can be placed aggressively, e.g., at the spread or even inside it, to fish for contra-side liquidity without signaling intent. Disadvantages. Lower execution priority. This is the primary trade-off. At the same price, a hidden order will always be executed after all displayed orders. This can lead to significantly increased time to fill the order. Uncertainty of execution. Due to lower priority, there's less certainty that the order will be filled, especially in fast-moving markets or if there's significant displayed liquidity at the same price. No liquidity provision incentives. Hidden orders typically do not earn exchange rebates for providing liquidity, as they don't contribute to the visible market depth. Practical example. The institutional investor and iceberg orders. Imagine an institutional investor needing to buy 500,000 shares of a stock with an average daily volume of 1 million shares. Placing a display order for 500,000 shares would immediately signal massive buying interest, likely driving the price up significantly before the order could be fully filled. Instead, the institution might use a non-display order, often an iceberg order. An iceberg order is a type of non-display order where only a small portion of the total quantity is displayed on the LOB, while the rest remains hidden. As the displayed portion is filled, a new iceberg tip, another small portion, is automatically revealed from the hidden quantity. This allows the institution to acquire a large block over time, minimizing market impact. Download the code on OnePageCode Substack. This updated code snippet class now explicitly includes code snippet. For a fully displayed order, code snippet would equal code snippet. For an iceberg order, code snippet would be a fraction of code snippet. For a purely hidden order, code snippet would be 0. This allows us to model the nuances of order visibility more precisely, simulating the trade-off, lower priority, longer fill time. Let's illustrate the consequence of lower priority for hidden orders. Suppose we have a series of buy orders at the same price, some displayed and some hidden, and a single sell order comes in to match them. Download the code on OnePageCode Substack. In this setup, we create 4 buy orders at the same price, mixing display and hidden status and carefully controlling their arrival times. The code snippet function will then arrange them for execution. Download the code on OnePageCode Substack. The simulation clearly shows how the code snippet of 200 shares interacts with the sorted by orders. The displayed orders, ID 11 and ID 13, are prioritized first, only after all available. The quantities from the displayed orders at the matching price are exhausted, while the hidden orders, ID 10 and ID 12, begin to be filled. This demonstrates that even though code snippet arrived earliest among all buy orders, its hidden status means it is executed after code snippet and code snippet because they are displayed. This is the direct consequence of the display precedence rule and the primary reason why hidden orders experience a longer time to fill and have less certainty of execution. Traders must carefully weigh the benefits of anonymity against this significant drawback in execution speed and certainty. Stop order. A stop order is a conditional order type designed to become a market order once a specified price, known as the stop price, is reached or crossed. Unlike a limit order, which is placed directly on the order book and waits for a specific price, a stop order remains dormant until its trigger condition is met. Its primary purpose is to manage risk, protect profits, or initiate new positions based on specific price movements. Components of a stop order. Every stop order fundamentally consists of two key components. 1. Stop price. Trigger price. This is the price level at which the stop order is activated. Once the market price touches or crosses this level, the stop order transforms into an executable order. 2. Trigger action. Upon activation, the stop order typically becomes a market order, meaning it will execute immediately at the best available price. As we will see later, it can also be configured to become a limit order, a stop limit order. The core idea is that you are instructing your broker or the exchange to monitor the market price for a specific instrument. When that instrument's price hits your predefined stop price, your conditional order is then submitted as an active order. Types of stop orders. Stop orders are broadly categorized based on their intended use. Stop loss orders. A stop loss order is designed to limit an investor's potential loss on an open position. It is placed below the current market price for a long position to sell, or ABO, v. the current market price for a short position to buy. Purpose. Risk management. The most common use is to cap potential losses. If a trade moves against you, the stop loss order ensures that your position is exited once a certain loss threshold is reached. Profit protection. Trailing stops. While not explicitly a stop loss in the traditional sense, stop orders can also be used to protect accumulated profits. A trailing stop is a dynamic stop loss order that adjusts its stop price as the market price moves favorably, effectively locking in gains while allowing for further upside. Example: stop loss for a long position. Imagine you buy 100 shares of company XYZ at $50 per share. To protect against a significant downturn, you might place a sell stop loss order at $48. If the price of XYZ falls to $48 or lower, your sell stop order is triggered. It then becomes a market order to sell 100 shares of XYZ. Your position is closed, limiting your loss to approximately $2 per share, plus commissions and any slippage. Example: stop loss for a short position. Suppose you short sell 100 shares of company ABC at $30 per share. To limit your potential loss, if the stock rises, you place a buy stop loss order at $32. If the price of ABC rises to $32 or higher, your buy stop order is triggered. It then becomes a market order to buy 100 shares of ABC. Your short position is covered, limiting your loss to approximately $2 per share, plus commissions. And any slippage. Stop entry orders. A stop entry order, also known as a buy stop or sell stop when used for entry, is used to initiate a new position once the market price reaches a certain level, often indicating a breakout or a specific trend confirmation. Purpose: breakout trading. To enter a long position when a stock breaks above a resistance level, or a short position when it breaks below a support level. Momentum trading. To capitalize on accelerating price movements. Short covering. A buy-stop order can be used by traders who are short to cover their position if the price starts to move against them rapidly. Example: buy-stop for long entry. You are monitoring company DEF, which has been trading in a range, but you believe it will rally if it breaks above its resistance at $75. You place a buy-stop order at $75.10. If the price of DEF rises to $75.10 or higher, your buy stop order is triggered. It then becomes a market order to buy shares of DEF. You enter a long position as the stock breaks out. Example: sell stop for short entry. You expect company GHI to decline if it breaks below its support level at $25. You place a sell stop order at $24.90. If the price of GHI falls to $24.90 or lower, your sell stop order is triggered. It then becomes a market order to sell shares of GHI. You enter a short position as the stock breaks down. The mechanics of execution. Slippage. When a stop order is triggered, it typically converts into a market order. A market order is designed to execute immediately at the best available price. However, the best available price is not necessarily the stop price itself. This discrepancy is known as slippage. What is slippage? Slippage refers to the difference between the expected execution price of an order, e.g., your stop price, and the actual price at which the order is filled. It commonly occurs in volatile markets or when trading illiquid assets. Why does slippage occur? 1. Lack of liquidity at the stop price. When your stop price is hit, there might not be enough opposing orders, buyers for sell stop, sellers for buy stop, at that exact price to fill your entire order. The market order will then seek out the next best available prices until it is fully filled. 2. Rapid price movements, volatility in fast-moving markets. Prices can gap or move very quickly through multiple price levels in milliseconds. By the time your stop order is triggered and reaches the exchange, the price may have already moved significantly past your stop price. 3. Market gaps, overnight/weekend. If a market opens significantly higher or lower than its previous close, e.g., due to news released overnight, your stop price might be bypassed entirely. Your stop order will then execute at the first available price when the market opens. Impact of slippage. Slippage can lead to an execution price that is less favorable than intended. For stop loss, this means a larger loss than anticipated. FORA stop entry. It could mean entering a position at a higher, for buy stop, or lower, for sell stop, price than desired, potentially impacting the profitability of the strategy. Scenario demonstrating slippage. You bought a stock at $100 and set a stop loss at $98. Normal execution. If the stock gradually falls to $98, your sell market order is triggered and might fill at $97.95 or $98 if there's enough liquidity. Slippage scenario. Volatile market, the stock suddenly drops from $100 to $97.50 due to unexpected news. Your stop at $98 is triggered, but because the price moved so rapidly, the best available bid price when your market order reaches the exchange is $97.40. Your order fills at $97.40, resulting in 60 cents of slippage. Actual fill $97.40 versus expected $98. Stop market versus stop limit orders. While a standard stop order typically implies a stop market order, triggers a market order, there is another crucial variant, the stop limit order. Understanding the distinction is vital for advanced trading. Stop market order, default stop order. Trigger, when the market price reaches or crosses the stop price. Action, a market order is immediately placed. Guaranteed execution, high probability of execution, as market orders prioritize speed of fill over price. Price certainty, no price certainty, susceptible to slippage. Stop limit order. Trigger, when the market price reaches or crosses the stop price. Action, a limit order is immediately placed at SP. Specified limit price. Guaranteed execution, not guaranteed. The limit order will only fill if the market price is at or better than the specified limit price. Price certainty or better if it fills. Risk, may not execute if the market moves past the limit price too quickly. How a stop limit order works. A stop limit order requires two prices. 1. Stop price, the trigger price. 2. Limit price, the price at which the limit order will be placed once triggered. Example, sell stop limit for a long position. You own shares bought at $50. You want to limit losses but avoid severe slippage. You place a sell stop limit order with a stop price of $48 and a limit price of $47.90. If the stop price falls to $48, the stop is triggered. A limit order to sell at $47.90 is placed on the order book. Your shares will only be sold if the market can offer $47.90 or better. If the price drops rapidly past $47.90, e.g., to $47, without touching $47.90, your order might not fill, and you'd still hold the position with potentially larger losses. Comparison. Stop market versus stop limit. Feature stop market order, stop limit order. Trigger market price hits / crosses, stop price market price hits / crosses stop price. Order placed market order limit order. Execution certainty high, prioritizes speed, not guaranteed. Prioritizes price. Price certainty low, susceptible to slippage. High, will execute at limit price or better. Risk larger than expected loss/entry due to slippage order may not fill, leaving position unmanaged. Best use case when execution is paramount, e.g., emergency exit, when price protection is crucial, willing to risk non-execution. Algorithmic logic of stop orders. At its core, a stop order is a conditional instruction that continuously monitors a market price against a predefined trigger. This can be conceptualized as a simple algorithmic loop. Basic stop market order logic. Let's illustrate the fundamental logic for a sell stop-loss order using pseudocode. This algorithm implicitly runs continuously, checking the market. Download the code on one patch code Substack. This code snippet function encapsulates the core conditional logic. It takes the code snippet, and the code snippet as inputs. The critical part is the code snippet statement, which serves as the trigger. If this condition is met, the code snippet function is called. The continuous monitoring aspect is typically handled by an event loop or a polling mechanism in a real-time trading system. Download the code on one patch code Substack. This expanded pseudocode demonstrates the continuous monitoring. The code snippet loop represents the keep checking part. Inside the loop, code snippet is updated, simulating market data, and the code snippet function is called repeatedly until the stop condition is met. Once triggered, code snippet is set to code snippet, ending the monitoring for this specific order. Stop limit order logic. Implementing a stop limit order adds an extra layer of conditional logic. Once the stop price is triggered, a limit order is placed instead of a market order. Download the code on one patch code Substack. The code snippet function is similar to the stop market version, but instead of calling code snippet, it calls code snippet with a specified code snippet. The crucial difference here is that after code snippet is called, the system would then need to monitor that limit order for its fill status, as it's not guaranteed to execute immediately. Broker versus exchange-held stop orders. An important practical consideration for stop orders is where they reside until triggered. Broker-held, off-exchange, stops. Historically, and often still for retail brokers, stop orders are held on the broker servers. The broker continuously monitors the market price. When the stop price is hit, the broker's system sends a market order or limit order for stop limit to the exchange. Pros: simpler for brokers to implement. Cons: latency. There can be a slight delay between the trigger on the broker's server and the order reaching the exchange, potentially increasing slippage. Broker risk. If the broker system goes down or there are connectivity issues, the stop order might not trigger. Stop hunting. Some critics suggest that less scrupulous brokers could theoretically stop hunt by intentionally driving prices to trigger client stops, though this is heavily regulated and generally illegal. Exchange-held, on-exchange, stops. Many modern exchanges allow sophisticated order types, including stop orders, to be placed directly on the exchange's matching engine. The exchange itself monitors the price and triggers the order. Pros: reduced latency. Execution is typically faster and more reliable as the trigger occurs directly on the exchange. Transparency. Less prone to manipulation or stop hunting, as the logic is handled by the neutral exchange. Cons: not all exchanges or all instruments support all complex order types directly on the exchange. For quant traders and algorithmic systems, exchange-held orders are generally preferred due to their reliability and reduced latency. However, understanding that broker-held stops exist is important, especially when using retail brokerage platforms. Best practices and pitfalls. 1. Setting appropriate stop prices. Volatility. Do not place stops too close to the current price in volatile markets, as normal price fluctuations, noise, could trigger them prematurely. Technical levels. Often, stop prices are placed just below support levels for long positions or just above resistance levels for short positions, as these levels represent significant price barriers. Risk tolerance. The stop price should reflect your maximum acceptable loss for a GI. Then trade. 2. Avoid stop hunting. psychological aspect, while direct manipulation is rare, large institutional players might be aware of common stop-loss levels, e.g., just below round numbers or obvious support/resistance. They might push prices to these levels to trigger retail stops, creating liquidity for their own larger orders. This reinforces the need to place stops intelligently, not just at obvious, easily predictable levels. 3. Reviewing stop orders regularly. Market conditions change. A stop order that was appropriate when placed might become too tight or too loose as the trade progresses or as market volatility shifts. Regularly review and adjust your stop orders, especially in active trading. 4. The risk of gapping markets. Stop orders offer no protection against market gaps. If a stock closes at $50 and opens the next day at $40 due to bad news, a stop loss at $48 will be triggered at the opening price of $40, or the first available price, leading to a much larger loss than anticipated. This is an inherent risk of stop market orders. Stop limit orders might prevent execution in such a scenario, but then you'd still hold the position. 5. Consider stop limit orders for price certainty. If controlling the execution price is more important than guaranteeing execution, e.g., for larger positions where slippage can be costly, a stop limit order can be a valuable tool, provided you understand the risk of non-execution. Stop limit order. The stop limit order represents a sophisticated evolution of the basic stop order, designed to offer traders more control over the execution price once a trigger condition is met. While a standard stop order, when triggered, converts into a market order, a stop limit order, upon activation, transforms into a limit order. This fundamental difference introduces both a significant advantage in price protection and a crucial risk of non-execution. Core mechanics of a stop limit order. A stop limit order requires two distinct price points. 1. Stop price. This is the trigger price. When the market price of an asset reaches or crosses this price, the stop limit order becomes active. 2. Limit price. This is the maximum for a buy order or minimum for a sell order, price at which the resulting limit order will be executed. Once the stop price is triggered, a limit order is immediately placed at this specified limit price. Let's break down the logic for both buy and sell stop limit orders. Buy stop limit order. Placement. Typically placed above the current market price. Purpose. To buy an asset once it breaks above a certain resistance level, but only up to a specified maximum price. This is often used for code snippet strategies in an uptrend or to cover a short position if the price unexpectedly rises. Trigger condition. If the market's ask price for a buy rises to or above the stop price. The ask price is used because this is the price at which you wow. LD buy immediately. Action upon trigger. A buy limit order is placed at the specified limit price. This limit price must be equal to or greater than the stop price to ensure it has a chance to fill immediately after triggering if the market is still at or near the stop price. Setting the limit price slightly above the stop price, e.g., code snippet, can increase the chances of execution in a fast-moving market, but at a slightly less favorable price. Sell stop limit order. Placement. Typically placed below the current market price. Purpose. To sell an asset, e.g., to limit losses on a long position or protect profits, once it falls below a certain support level, but only down to a specified minimum price. This is a common code snippet strategy. Trigger condition. If the market's bid price for a sell falls to or below the stop price. The bid price is used because this is the price at which you would sell immediately. Action upon trigger. A sell limit order is placed at the specified limit price. This limit price must be equal to or less than the stop price. Setting the limit price slightly below the stop price, e.g., code snippet, can increase the chances of execution, but at a slightly less favorable price. The primary advantage of a stop limit order is its price control. Unlike a stop order that becomes a market order and guarantees execution, but not price, a stop limit order ensures that if it executes, it will do so at or better than your specified limit price. This protection is particularly valuable in volatile or illiquid markets where slippage with a market order could be substantial. However, This price control comes with a significant trade-off: the risk of non-execution. If the market moves very rapidly past your limit price after the stop is triggered, your limit order may not be filled or only partially filled. This is known as the missed market scenario. This is a critical consideration for traders prioritizing guaranteed exit over price certainty. Algorithmic logic and implementation. Implementing a stop limit order in an automated trading system requires careful consideration of conditional logic, state management, and interaction with market data. The core idea is to continuously monitor market prices and, upon a specific condition being met, transition the order state and submit a new order type to the exchange. Conceptual flow of a stop limit order. 1. Initialization. The stop limit order is submitted to the trading system or exchange's internal order book, if supported, and remains in a code snippet state. It does not immediately impact the limit order book, LOB. 2. Market monitoring. The system continuously monitors the real-time market price, specifically the bid for sell stop limit orders and the ask for buy stop limit orders, as these are the prices you would transact at immediately. 3. Trigger condition check. For a buy stop limit, is code snippet. For a sell stop limit, is code snippet. 4. Activa. Tie-in. If the trigger condition is met, the stop limit order transitions from code snippet to code snippet. 5. Limit order placement. A new limit order is generated with the specified limit price and quantity and then submitted to the exchange. This new limit order will now appear on the LOB, waiting for a fill. 6. Execution/expiration. The newly placed limit order behaves like any other limit order. It will execute if the market reaches its price, or it may remain unexecuted or partially unexecuted. If the market moves away from its limit price, or if its time in force, TIF, condition expires. Python simulation, building the stop limit mechanism, will simulate the core logic of a stop limit order. This will involve defining an order, a simple market environment, and the logic to process the stop limit order based on price movements. First, let's set up a basic code snippet class to encapsulate the details of our stop limit order. Download the code on one patch code Substack. This initial code defines the necessary enumerations for order types, sides, and statuses, and a base code snippet class. Crucially, it introduces the code snippet class, which holds both code snippet and code snippet, and a placeholder for the code snippet that will be created upon activation. This structure helps manage the state of the stop limit order throughout its life cycle. Next, we need a simplified code snippet to provide market price updates and simulate the limit order book, LOB, interaction, where our triggered limit order would eventually reside. For simplicity, our LOB will just hold the best bid and ask, and code snippet will simulate immediate fills if conditions are met. Download the code on one patch code Substack. The code snippet class provides a dynamic market environment. It can simulate price changes and, importantly, includes a code snippet method. This method simplifies the LOB interaction. If the market price is immediately favorable to the triggered limit order, it's filled. Otherwise, it remains active, mimicking its placement on the LOB. Now, let's create the code snippet that will manage our stop limit order. This agent will monitor the market and execute the core logic. Download the code on one patch code Substack. The code snippet is the core logic. Its code snippet method performs the continuous check. 1. It first checks if the order is code snippet. If so, it monitors the code snippet for buy orders and code snippet for sell orders against the code snippet. 2. If the stop price is hit, the order status changes to code snippet, and a new code snippet order object is instantiated with the code snippet. This simulates sending the order to the exchange. 3. In the next iteration, or immediately after, depending on design, if the order is code snippet or code snippet, it attempts to process the actual limit order using the code snippet's code snippet method. This demonstrates how the limit order interacts with the market and the risk of non-execution. On. Simulating market movement and order behavior. Let's put it all together to observe the stop limit order in action, including scenarios where it might not execute. Download the code on one patch code Substack. The code snippet orchestrates the entire process. It initializes the market and the agent, then enters a loop, simulating price updates and allowing the agent to react. The three scenarios demonstrate. 1. A typical sell stop limit for loss protection. 2. A typical buy stop limit for entry. 3. A specific scenario designed to illustrate the missed market risk, where the limit price is too tight relative to rapid market movement, leading to non-execution. This progressive code building allows the reader to understand each component and how they interact. Detailed explanation of tick size and limit price calculation. In real-world trading, prices move in discrete increments called tick sizes. For example, a stock might trade in 1-cent increments, while a futures contract might trade in 25-cent increments. When setting your stop and limit prices, especially the limit price relative to the stop price, understanding and correctly applying the tick size is crucial. The difference between your stop price and your limit price, often called the offset or spread, can be expressed in ticks. This offset directly influences the trade-off between execution certainty and price certainty. For a buy stop limit, the code snippet should be equal to or greater than the code snip. Bait. Setting code snippet, where n is a non-negative integer like 0, 1, or 2. Provide the buffer. A larger code snippet, wider spread between stop and limit, offers more certainty of execution because the limit order is placed more aggressively into the market's offers, but potentially at a worse price. For a sell stop limit, the code snippet should be equal to or less than the code snippet. Setting code snippet provides a buffer. A larger code snippet, wider spread, increases execution certainty, but means accepting a potentially worse price. Consider the missed market scenario again. If your code snippet is set too close to your code snippet, e.g., code snippet for sell order, meaning n equals 0, and the market drops very quickly through your stop price, it might also drop straight through your limit price before your order can be filled. By setting a slightly more aggressive limit price, e.g., code snippet for a sell, meaning n equals 2, you increase the probability of execution, albeit accepting a potentially slightly worse price. Our code snippet implicitly uses code snippet when updating prices to ensure realism. The code snippet class directly takes a code snippet, allowing the user to define this offset. In a more advanced system, you might have functions to calculate the code snippet based on the code snippet and a desired tick offset. Download the code on OnePatchCode Substack. This helper function explicitly shows how to programmatically determine a code snippet based on a code snippet and a desired code snippet, ensuring it aligns with market tick rules and allows for strategic control over the execution probability. Order state transitions. Understanding the precise life cycle of a stop limit order is crucial for robust algorithmic design and debugging. The code snippet enumeration defined earlier helps in tracking these states. Code snippet. This is the initial state of the stop limit order. It exists in the trading system, but has no immediate impact on the public limit order book. It is passively waiting for its stop price condition to be met. Code snippet. The market price has reached or crossed the specified stop price. At this point, the stop limit order transitions from a passive state to an active state. The system internally flags it as code snippet and immediately prepares to submit a new limit order to the exchange. Code snippet. The new limit order, derived from the original stop limit order's parameters, has been successfully submitted to the exchange. It now resides on the exchange's limit order book and behaves like any other limit order, waiting for a matching counterorder to execute. Code snippet/code snippet. The code snippet order has been fully executed, all quantity traded, or partially executed, some quantity traded. If partially filled, it remains code snippet for the remaining quantity until fully filled or canceled. Code snippet. The order was explicitly canceled by the user or the trading system before being fully filled. This can apply to the code snippet stop limit order or the code snippet order after it has been triggered. Code snippet. If a time in force TIF condition, e.g., good till canceled, day, fill or kill, was applied to the triggered limit order, it might expire without being fully filled. This is another form of non-execution. Our code snippet enum and the code snippet demonstrate these transitions, particularly code snippet dash, code snippet dash, code snippet dash, code snippet. Real-world scenarios and strategic considerations. The choice to use a stop limit order is a strategic one, balancing the desire for price certainty against the need for execution certainty. Numerical example. Protecting profits with a sell stop limit. Suppose you bought 100 shares of XYZ stock at $95, and it has since risen to $105. You want to protect your unrealized gains, ensuring you don't lose more than $2 per share from the current price, but you also want to avoid selling into a rapid flash crash below your desired exit level. Current market price, mid-$105. Your position, long 100 shares of XYZ. Your goal, protect profits, exit if price drops, but not below a certain point. Order type, sell stop limit. Stop price, $103, 2.00 below current mid price. Limit price, $102.90, 10 cents below stop price, allowing a small buffer, equivalent to code snippet if code snippet. Scenario 1, gradual decline. 1, initial state. Market is at $105. Your sell stop limit order is code snippet. 2, price movement. Market gradually drops to $103.50, then $103.10. Your order remains code snippet. 3, trigger. Market's bid price reaches $103. Your stop price is triggered. 4, action. Your sell stop limit order transitions to code snippet. A new sell limit order for 100 shares at $102.90 is immediately placed on the exchange's LOB. Status becomes code snippet. 5, execution. Market continues to drop slowly to $102.95 bid. Since your limit order at $102.90 is below the current best bid, $102.95, it is immediately filled at $102.95 or better if a better bid existed. Result, order filled at a price better than your limit, profits protected. Scenario 2, rapid decline, illustrating missed market. 1, initial state. Market is at $105. Your sell stop limit order is code snippet. 2, price movement. Market drops to $103.50, then $103.10. Your order remains code snippet. 3, sudden crash. A sudden news event causes a flash crash. The market's bid price instantly gaps down from $103.10 to $100. 4, trigger. Your stop price, $103, was triggered during this rapid descent. The bid price crossed it. 5, action. Your sell stop limit order transitions to code snippet. A new sell limit order for 100 shares at $102.90 is immediately placed. 6, non-execution. However, the best available bid on the LOB is now $100. Your limit order at $102.90 is above the current best bid. It will not be filled immediately and will sit on the LOB, waiting for the price to rebound to $102.90 or higher. Result, order not filled. You are still holding the position, potentially facing greater losses if the price doesn't recover. This highlights the missed market risk. This example clearly illustrates the trade-off. In Scenario 1, you got the price control you wanted. In Scenario 2, that control led to non-execution, which might be undesirable if guaranteed exit was paramount. Comparison of order types. Execution versus price certainty. Understanding the nuances of each order type is key to selecting the right tool for the job. Order type, execution, certainty price, certainty primary, use case, key risk. Market order, high-low, immediate execution. Taking liquidity, urgency to enter/exit, high slippage, unfavorable price, in volatile/illiquid markets. Limit order, low-high price improvement, providing liquidity, avoiding slippage, setting target price non-execution if market doesn't reach specified price. Stop order high, upon trigger, low, upon trigger, conditional execution for risk management, stop loss, stop entry, guaranteed exit, high slippage if market gaps or moves rapidly past trigger, unfavorable fill. Stop limit order low, upon trigger, high, upon trigger, conditional execution with price control, avoiding excessive slippage on trigger non-execution if market moves rapidly past trigger and limit price. Missed market. When and why to use a stop limit order. In volatile or illiquid markets, when you're concerned about significant slippage if your stop is triggered. A stop limit provides a ceiling for buy or floor for sell for your execution price, preventing fills at extreme, unfavorable prices. Avoiding flash crashes. During extreme, rapid price declines or spikes, a stop limit can prevent your position from being liquidated at an unfavorably low or high price. While it risks not executing at all, for some traders, avoiding a bad fill is more important than guaranteed execution. Precise entry/exit points. For traders who have very specific price levels they are willing to enter or exit at, and are willing to risk non-execution for that price precision. This is common in technical analysis where specific support/resistance levels are critical. Algorithmic trading. When designing algorithms where price control is prioritized over guaranteed execution in certain scenarios, or where the algorithm can manage the non-execution risk, e.g., by re-evaluating the trade, placing a market order as a fallback, or waiting for a price reversal. When a stop limit order might not be preferred, and a stop order might be better. Guaranteed execution is paramount. In situations where you absolutely must exit a position, e.g., strict SK management, highly leveraged positions, regulatory compliance, regardless of the price, a simple stop order, which converts to a market order, might be preferred. The certainty of exit outweighs the potential for a bad price. Rapidly trending markets. If you anticipate a strong, fast move in one direction and want to participate or exit immediately upon a trigger, a stop order ensures you are in/out, even if it's at a slightly worse price. Waiting for a limit fill in a strong trend could mean missing the move entirely. Momentum trading. Traders relying on momentum often prioritize immediate execution to catch a significant price swing, even if it means sacrificing some price precision. High liquidity, low volatility. In very liquid and stable markets, the risk of significant slippage with a market order is minimal. In such environments, the added complexity and non-execution risk of a stop limit order might not be justified. The decision to use a stop limit order is a nuanced one that requires a thorough understanding of market conditions, liquidity, and your personal risk tolerance and trading strategy. It is a powerful tool for those who prioritize price control, but must be used with a clear awareness of its inherent risk of non-execution. Pegged order. A pegged order is a sophisticated type of limit order designed to dynamically adjust its price in response to changes in a specified reference market price. Unlike a static limit order that remains at a fixed price until filled, canceled, or expired, a pegged order continuously pegs itself to a moving target, maintaining a desired price relationship relative to the live market. This dynamic nature makes them invaluable tools for automated trading strategies that require constant adaptation to market conditions. The primary purpose of a pegged order is to enable traders to maintain a specific position within the order book without constant manual intervention. For instance, a trader might want to always have a buy order one tick below the best bid, or sell order one tick above the best offer. As the best bid or offer moves, the pegged order automatically cancels its old price and submits a new one, ensuring it remains at its desired relative position. Key components of a pegged order. Understanding pegged orders requires a grasp of their core components. 1. Reference price. This is the market price that the pegged order tracks and adjusts itself against. Common reference prices include best bid, code snippet, the highest price a buyer is currently willing to pay. A buy pegged order often uses the best bid as its reference, potentially with a negative offset to ensure it's placed within the bid stack. Best offer, code snippet, the lowest price to sell, or is currently willing to accept. A sell pegged order typically uses the best offer as its reference, often with a positive offset to place it within the offer stack. Mid-price code snippet the average of the best bid and best offer. Pegging to the mid-price is common for market-making strategies that aim to quote on both sides of the market, equally distant from the current spread center. Last traded price, LTP, while less common for direct pegging due to its backward-looking nature and potential for large jumps. The LTP can sometimes serve as a reference in specific illiquid markets or for certain execution algorithms. 2. Offset. Differential. This is a fixed price amount, or tick, that is added to or subtracted from the reference price to determine the actual limit price of the pegged order. Positive offset. Added to the reference price. For example, a sell order pegged to the best offer with a +1 tick offset would always be placed 1 tick above the best offer. Negative offset. Subtracted from the reference price. For example, a buy order pegged to the best bid with a -1 tick offset would always be placed 1 tick below the best bid. The offset is typically defined in terms of the instrument's code snippet, which is the minimum price increment for that security. This ensures the order price is always valid and marketable. 3. Side. By I sell, the direction of the order, buy or sell, dictates how the reference price and offset are combined. A peg buy order typically aims to buy at or below the best bid, or around the mid-price. For example, code snippet. A peg sell order typically aims to sell at or above the best offer, or around the mid-price. For example, code snippet. Dynamic adjustment mechanism. The core functionality of a pegged order lies in its dynamic adjustment. This process is typically handled by an automated trading system or an exchange's matching engine for native pegged order types. The mechanism involves 1. Monitoring the reference price. The system continuously monitors the chosen reference price, e.g., best bid, best offer. This monitoring can be done via real-time market data feeds, e.g., WebSocket subscriptions, or by frequently polling the market data. 2. Detecting price changes. When a reference price changes, the system evaluates if the current active pegged order needs adjustment. 3. Cancellation and resubmission. If the new reference price dictates a different order price, the existing pegged order is canceled, and a new limit order is immediately submitted at the newly calculated pegged price. This ensures the order maintains its desired relative position. 4. Fill status check. A crucial part of the logic is checking if the existing order has already been filled before attempting to cancel and resubmit. If the order has been filled, no further action is needed for that specific order. Benefits and practical applications. Pegged orders are powerful tools in various trading strategies. Market making. A classic application is to continuously provide liquidity by placing both a peg buy order, e.g., code snippet, and a peg sell order, e.g., code snippet. As the bid-ask spread shifts, these orders automatically adjust to stay competitive and capture the spread. Spread trading. When trading the price difference between two related instruments, e.g., a stock and its options, or two correlated stocks, pegged orders can help maintain a desired price relationship for one leg of the spread based on the movement of the other. Automated execution in volatile markets. In fast-moving or volatile markets, manually adjusting limit orders is impractical. Pegged orders automate this process, allowing traders to stay in a market at a desired price level without constant manual intervention, potentially reducing execution slippage. Liquidity provision. For traders focused on providing liquidity, pegged orders ensure their resting orders are always competitive and visible on the order book, attracting potential counterparties. Dynamic risk management. By pegging orders away from the immediate market, e.g., a stop-loss order pegged to a moving average, traders can implement dynamic risk management that adapts to market trends. Algorithmic logic for pegged order management. The core of a pegged order's functionality lies in its algorithmic logic. While exchanges might offer native pegged order types, it's common for algorithmic traders to implement this logic themselves, giving them greater control and flexibility. Let's simulate this logic using Python, building a simplified environment to manage orders and market data. Simulation environment setup. To illustrate the logic, we'll create a basic code snippet and encode snippet. The code snippet will provide current market data, best bid, best ask, and the code snippet will handle the submission, cancellation, and status tracking of our simulated orders. Download the code on OnePageCode Substack. This code snippet class allows us to simulate market price movements, which will trigger our pegged order logic. The code snippet is crucial for ensuring our order prices are valid on an exchange. The code snippet function ensures prices adhere to this minimum increment. Order management class. The code snippet class will mimic the functionalities of an exchange API, allowing us to submit, cancel, and check the status of orders. In a real system, these would be API calls to a broker or exchange. Download the code on OnePageCode Substack. The code snippet is central to managing the state of our pegged orders. It assigns unique code snippets and tracks their code snippet, code snippet, code snippet, code snippet. The code snippet method is a simple way for us to manually trigger fills in our simulation. Peg by order logic. Now, let's implement the core logic for a peg by order. The goal is to always have a by order at code snippet. Download the code on OnePageCode Substack. This function, code snippet, encapsulates the core logic. It first checks if there's an existing active order. If not, or if the previous one was filled/canceled, it submits a new one. Crucially, if an active order does exist, it checks if its current price matches the newly calculated code snippet. If they differ, the old order is canceled and a new one is submitted. This is the essence of the pegging mechanism. The professor's pseudocode highlighted two specific scenarios for a buy order. 1. If the bid price increases, cancel old, submit new at code snippet. This is covered by code snippet where code snippet would be higher. 2. If the bid price decreases, first check code snippet. If not filled, cancel and resubmit at code snippet. If filled, no action. This is also covered by code snippet. The code snippet check handles the if fill part. If it's filled, it's no longer active, so a new order is placed. If it's still active, but at the wrong price, it's canceled and resubmitted. The crucial point code snippet when the price moves unfavorably, e.g., bid decreases for a buy order, is to prevent unnecessary order resubmissions. If your buy order has already been filled, meaning you bought at or below its price, you no longer need to adjust it. Attempting to resubmit a filled order would be an error or lead to unintended double execution. Peg sell order logic. The logic for a peg sell order is symmetrical to the buy order, but it reacts to changes in. The best ask code snippet and places orders at code snippet. Download the code on OnePageCode Substack. This code snippet function mirrors the buy logic, ensuring the sell order always maintains its desired offset from the best ask. Putting it together, a simple simulation. Let's simulate a market where prices move and observe how our pegged orders react. We'll track a peg by order and a pegged sell order. Download the code on OnePageCode Substack. This simulation demonstrates the dynamic nature of pegged orders. Each time the market updates, the code snippet and code snippet functions are called. They assess the current market and the state of the existing order, then decide whether to cancel and resubmit or take no action. When an order is filled, the subsequent call to the code snippet function recognizes the filled status and submits a new order to maintain the peg. Operational implications and trade-offs. While powerful, implementing and using pegged orders in a live trading environment comes with important considerations. 1. Order ID management. In a real system, accurately tracking the code snippet of the active pegged order is critical. When an order is canceled, its ID is typically invalidated, and a new ID is assigned to the resubmitted order. Robust error handling for API calls, e.g., failed cancellations or submissions, is also necessary. 2. Keep checking mechanism, market data latency. Polling, continuously querying for market data, e.g., EV. Every 100 milliseconds can be inefficient and introduce latency. It also might hit API rate limits. Event-driven. The preferred method is to subscribe to real-time market data feeds, e.g., WebSockets. This allows your system to react instantly when a new best bid or ask is published, reducing latency significantly. However, even with event-driven systems, Network latency and processing time will introduce a small delay between a market moving and your order adjusting. 3. Time precedence and order churn. Every time a pegged order is canceled and resubmitted, it loses its time precedence on the exchange's order book. This means it goes to the back of the queue at its new price level. In high-frequency markets, this can significantly reduce the likelihood of the order being filled, especially if it's placed inside a crowded price level. This frequent cancellation and resubmission is often referred to as order churn. 4. Exchange rate limits and fees. Exchanges impose rate limits on the number of API requests, order submissions, cancellations, modifications a client can make within a certain time frame. Excessive order churn from pegged orders can quickly hit these limits, leading to temporary suspensions or even account restrictions. Some exchanges also charge fees for excessive order activity, e.g., message fees or fees for a high order-to-trade ratio, making high-churn strategies more expensive. 5. Edge cases and risks. Unmarketable prices. If the offset is too aggressive, or the market becomes very thin, a pegged order might attempt to submit at an unmarketable price, e.g., a buy order above the best offer or a sell order below the best bid. Exchange APIs usually reject such orders, but your system must handle these rejections gracefully. Race conditions. In a high-frequency environment, a race condition can occur where the market data updates. Your system calculates a new price, sends a cancel/submit request, but during that tiny window, the order gets filled at its old price. Robust systems implement mechanisms like idempotent order IDs or state reconciliation to handle these scenarios. Market illiquidity/volatility. In illiquid markets, the spread can be wide, and pegged orders might sit for a long time without being filled. In highly volatile markets, prices can jump significantly between updates, potentially causing your pegged order to be left behind or filled at an undesirable price. Slippage. Even with pegging, large orders or extremely fast markets can still result in slippage, where the actual execution price differs from the intended peg price. Advanced pegging concepts. While our examples focused on simple bid/ask pegging, more advanced variations exist. Mid-price pegging. As mentioned, pegging to the mid-price is ideal for market making, aiming to always be equidistant from the bid and ask. Primary peg, or bid/ask peg, the type we implemented, where the order tracks the best bid for buy or best ask for sell. Offset peg. Some systems allow defining a peg to a specific price level, which then adjusts if that level moves, without necessarily tying directly to the bid/ask. Pegging to another instrument/market. Sophisticated arbitrage or relative value strategies might peg an order in one market to the price of a correlated instrument in another market, enabling cross-market dynamic hedging or trading. Understanding pegged orders is a fundamental step towards building adaptive and automated trading strategies. By carefully considering their mechanics, implementation challenges, and operational implications, traders can leverage their power while mitigating associated risks. Trailing stop order, dynamic risk management. A trailing stop order is an advanced, dynamic risk management tool designed to protect profits on a winning trade or limit losses on a losing one, while allowing the position to continue benefiting from favorable price movements. Unlike a static stop order, which is placed at a fixed price, a trailing stop automatically adjusts its trigger price as the market price moves in a favorable direction. This adaptive nature makes it particularly valuable in trending markets. Core mechanism and components. The fundamental concept behind a trailing stop order is its ability to maintain a predefined distance from the market's most favorable price. This distance is known as the trailing amount or trailing offset. The key components are last traded price, LTP, the current market price of the asset, trailing amount, a fixed value, e.g., 50 cents, 50 basis points, or a percentage, e.g., 2%, 0.5%, that defines the maximum unfavorable price movement before the stop is triggered. Trailing stop price, the dynamic price level at which the stop order will be activated. This price moves only when the market moves favorably, always maintaining the specified trailing amount from the peak favorable price achieved. The dynamic adjustment principle. The core of a trailing stop lies in its dynamic adjustment. Once activated, the trailing stop price will only move in one direction, the direction that locks in more profit or reduces potential loss. It never moves against the trade's favor. If the market price reverses and moves unfavorably by the specified trailing amount from its most favorable point, the trailing stop order triggers, typically submitting a market order to close the position. Trailing sell stop order for long positions. A trailing sell stop order is used to protect a long position, an asset you own, from a significant downturn. Mechanism for long positions. When you hold a long position, you profit when the price goes up. A trailing sell stop is placed below the current market price and moves upwards as the market price increases, always maintaining the trailing amount below the new high. If the price then declines by the trailing amount from its peak, the sell stop is triggered. Let's illustrate the logic. 1. Initial placement. When you initiate a long position or at any point during the trade, you define a code snippet, e.g., $1. The initial code snippet is set by taking the current market price and subtracting the code snippet. 2. Price rises. Favorable as the market price increases, the code snippet is continuously updated to maintain the code snippet below the new highest price achieved since the stop was placed. The stop price effectively trails the market's upward movement. 3. Price falls. Unfavorable if the market price falls, the code snippet remains unchanged. It only moves up, never down. 4. Activation. If the market price falls to or below the current code snippet, the trailing S top order is triggered, and a market sell order is typically submitted to close the long position. Numerical example, trailing sell stop. Assume you buy shares of XYZ at $100 and set a trailing stop with a code snippet of $2. Time market price, LTP, highest price achieved, HPA, trailing stop price, HPA, $2, action. T0 $100, $98 by XYZ at $100. Set initial trailing stop. T1 $101.50, $101.50, $99.50, HPA updated. Trailing stop price moves up. T2 $100.80, $101.50, $99.50 price fell, but not below stop. Stop price unchanged. T3 $103, $103, $101, HPA updated. Trailing stop price moves up. T4 $102.50, $103, $101 price fell, but not below stop. Stop price unchanged. T5 $100.90, $103, $101 market price, $100.90, fell below trailing stop price, $101. Triggered. Sell order submitted. In this example, the trailing stop successfully locked in a profit, as the position was closed at approximately $100.90, higher than the initial purchase price of $100, despite the market reversing from its peak of $103. Code implementation, trailing sell stop logic. We'll model the core logic for a trailing sell stop. This pseudocode like Python will demonstrate how the code snippet is dynamically managed. Download the code on one patch code Substack. This initial block ETS up the starting conditions for our trailing stop. We define the code snippet and the code snippet. The code snippet, HPA, is initialized to the current market price, and the code snippet is calculated based on this HPA and the code snippet. Download the code on one patch code Substack. This loop simulates market price changes. For each new price, it first checks if the code snippet has set a new code snippet. If so, both code snippet and code snippet are updated. If not, the code snippet remains unchanged. Finally, it checks if the code snippet has fallen to or below the code snippet, indicating that the stop should be triggered. The code snippet flag ensures that the stop is only activated once. Trailing by stop order for short positions. A trailing by stop order is used to protect a short position, an asset you've sold borrowed shares of, from a significant upturn. This is the reverse mechanism of the trailing sell stop. Mechanism for short positions. When you hold a short position, you profit when the price goes down. A trailing buy stop is placed above the current market price and moves downwards as the market price decreases, always maintaining the trailing amount above the new low. If the price then increases by the trailing amount from its trough, the buy stop is triggered. Let's illustrate the logic. 1. Initial placement. When you initiate a short position, you define a code snippet. The initial code snippet is set by taking the current market price and add ing the code snippet. 2. Price falls, favorable as the market price decreases. The code snippet is continuously updated to maintain the code snippet above the new lowest price achieved since the stop was placed. The stop price effectively trails the market's downward movement. 3. Price rises unfavorable. If the market price rises, the code snippet remains unchanged. It only moves down, never up. 4. Activation. If the market price rises to or above the current code snippet, the trailing stop order is triggered, and a market buy order is typically submitted to close the short position. Numerical example, trailing buy stop. Assume you short shares of XYZ at $100 and set a trailing stop with a code snippet of $2. Time market price, LTP, lowest price achieved, LPA, trailing stop price, LPA plus $2, action. T0 $100, $100, $102, short XYZ at $100. Set initial trailing stop. T1 $98.50, $98.50, $100.50, LPA updated. Trailing stop price moves down. T2 $99.20, $98.50, $100.50 price rose, but not above stop. Stop price unchanged. T3 $97, $97, $99, LPA updated. Trailing stop price moves down. T4 $97.50, $97, $99 price rose, but not above stop. Stop price unchanged. T5 $99.10, $97, $99 market price, $99.10, rose above trailing stop price, $99. Triggered. Buy order submit. TED. In this example, the trailing stop successfully limited losses or locked in some profit, depending on a market's movement relative to the initial short price, as the position was closed at approximately $99.10, despite the market reversing from its trough of $97. Code implementation, trailing by stop logic. Download the code on one patch code Substack. This setup is similar to the sell stop, but code snippet is tracked, and the code snippet is calculated by adding the code snippet. Download the code on one patch code Substack. The logic here mirrors the sell stop, but with conditions reversed. Code snippet is updated when the price decreases, and the stop triggers when the price rises to or above the code snippet. Choosing the trailing amount. The selection of the code snippet is crucial for the effectiveness of a trailing stop order. An amount that is too small can lead to premature triggering due to normal market fluctuations, whipsaws, while an amount that is too large may expose the position to excessive losses or give back too much profit. Factors to consider when choosing the code snippet. Volatility. In highly volatile markets, a larger code snippet, either fixed points or percentage, might be necessary to avoid being stopped out by normal price swings. For less volatile assets, a smaller amount might suffice. Measures like average true range, ATR, can be used to set dynamic trailing amounts based on recent volatility. Asset type, different asset class. Stocks, Forex, commodities, crypto, exhibit different volatility characteristics and typical price movements. Time frame, shorter-term trades, intraday, might use tighter trailing stops, while longer-term positions, swing, position trading, typically require wider ones to accommodate larger swings. Trading strategy. The overall strategy should dictate the risk tolerance. A trend-following strategy might use a wider trailing stop to ride long trends, whereas a mean reversion strategy might use tighter stops. Percentage versus fixed points. Percentage. A percentage-based trailing stop, e.g., 2% below the high, automatically adjusts to the asset's price level. This is often preferred for assets with varying prices, as a $2 move on a $10 stock is different from a $2 move on a $1,000 stock. Fixed points/dollars. A fixed dollar amount, e.g., $1, or fixed number of ticks is simpler, but may not scale well across different price levels. It is more suitable for assets with relatively stable price ranges or when trading a fixed number of shares. Practical applications and best practices. Trailing stop orders are powerful tools, but their effective use depends on understanding their limitations and integrating them wisely into a broader trading strategy. Trending markets, maximizing gains. In a strong, sustained trend, a trailing stop excels at allowing profits to run. As the price consistently moves in the favorable direction, the trailing stop price continues to adjust, locking in more gains. Should the trend reverse, the stop will eventually trigger, capturing a significant portion of the move without requiring constant manual intervention. This is a key advantage over fixed stop losses, which would either be too tight, stopping out prematurely, or too wide, giving back too much profit. Protecting capital in reversals. Consider a scenario where a stock you own has risen significantly, say from $50 to $70. A fixed stop loss at $49 would protect your initial capital, but would give back all the $20 profit. A trailing stop set at, for example, 5% of the highest price would move up with the price. If the stock peaks at $70, the trailing stop would be at $66.50, 70.95. If the stock then reverses and falls, hitting $66.50, your position is closed, securing most of the gains. Comparison with fixed stop loss. Feature fixed stop loss, trailing stop loss. Adjustment static. Set at a fixed price, rarely changes. Dynamic. Adjusts with favorable price movement. Profit protection limited. Only prevents loss below a certain point. Actively locks in profits as they accumulate. Trend riding poor. Requires manual adjustment to follow trends. Excellent. Automatically follows favorable trends. Complexity simpler to understand and implement. More complex due to dynamic nature and state management. Risk can give back significant gains and reversals. Can be prone to whipsaws if trailing amount is too tight. Common pitfalls. Whipsaws. If the code snippet is too small, normal market volatility, small, temporary pullbacks, can prematurely trigger the stop, causing you to exit a trade that eventually resumes its favorable movement. Illiquid markets. In markets with low liquidity, the spread between bid and ask prices can be wide, and executing a market order, triggered by the trailing stop, might result in significant slippage, meaning the actual execution price is far worse than the code snippet. Gaps. If the market gaps over your code snippet, e.g., a stock opens significantly lower than its previous close, bypassing your stop, the order will execute at the first available price, which could be much worse than anticipated. Integration with algorithmic systems. Trailing stops are inherently algorithmic. They require continuous monitoring of market prices and conditional logic to update the stop price and trigger orders. This makes them ideal candidates for implementation in automated trading systems. An algorithm can manage multiple trailing stops across various positions, ensuring consistent risk management and profit protection without manual oversight. When designing such systems, careful consideration must be given to latency, data feed reliability, and the precise execution logic for triggering the market order. Market if touched, MIT, order. The market if touched, MIT, order is a specialized conditional order type designed for specific entry and exit strategies, particularly those involving price reversals or the retouching of significant price levels. Unlike a standard limit order that rests on an order book or a stop order that triggers when a price moves unfavorably for loss limitation or favorably for breakout entry. An MIT order is triggered when the market price touches or crosses a specified level, and then converts into a market order for immediate execution. Understanding the MIT order mechanism. An MIT order operates in two distinct phases. 1. Held state. When an MIT order is placed, it is not immediately submitted to the public order book. Instead, it is held internally by the exchange or the brokerage system. It awaits a specific market condition to be met. 2. Trigger and conversion. The MIT order's trigger condition is met when the market's code snippet, or code snippet, depending on the specific exchange rules, reaches or crosses the predefined MIT trigger price. Once this condition is satisfied, the MIT order ceases to be a conditional order and instantaneously converts into a standard market order. 3. Market order execution. The newly generated market order is then sent to the market for immediate execution. As a market order, it prioritizes speed of execution over price certainty, aiming to fill at the best available price from the opposing SID. The order book. This mechanism makes MIT orders particularly useful for strategies that anticipate a price reversal or a bounce off a support/resistance level, or for taking profits at a predetermined target. Strategic rationale and common use cases. The primary strategic application of MIT orders lies in their ability to facilitate entries or exits when a security's price revisits a specific level, often against the immediate direction of the price movement leading up to the trigger. Buying on a pullback/dip by MIT, this is a common use case. If a stock is in an uptrend, but you anticipate a temporary dip to a support level before it continues its ascent, you can place a buy MIT order at that support level. For example, if a stock is trading at $100 and you expect it to pull back to $98, a strong support, a buy MIT at $98 would trigger a market order to buy if the price touches $98. This allows you to enter a long position on a perceived discount. Selling on a rally/resistance. Sell MIT conversely. If you want to enter a short position when a stock rallies to a resistance level before reversing, a sell MIT order can be placed at that resistance. For example, if a stock is at $100 and you expect it to rally to $102, a strong resistance, and then fall, a sell MIT at $102 would trigger a market order to sell if the price touches $102. Profit-taking, sell MIT for long positions. Buy MIT for short positions. MIT orders can also serve as effective profit targets. If you're long a stock at $50 and your target is $55, you can place a sell MIT order at $55. If the price reaches $55, your position will be closed via market order, ensuring you capture the profit. Similarly, for a short position, a buy MIT at a target price below your entry would close the position for profit. Reversal strategies. MIT orders are ideal for strategies based on the premise that when a security's price touches a significant technical level, like a moving average, Fibonacci retracement, or pivot point, it is likely to reverse or bounce. This contrasts with breakout strategies, which typically use stop orders to enter after a level has been decisively broken. MIT versus stop versus limit orders, a comparative analysis. Understanding the nuances between MIT, stop, and limit orders is crucial for effective order management. While all are conditional in some sense, their triggers, execution methods, and strategic intentions differ significantly. Feature limit order stop order market if touched, MIT order. Primary goal price control, buy sell at specific price or better. Loss limitation/breakout entry, reversal entry/profit, taking/entry at specific price. Trigger none, immediate placement on order book, fills when market reaches price, PRIC, and moves against desired direction for loss or pass level for breakout, price touches or crosses specified level. Order book visible on order book, adds liquidity hidden until triggered, exchange held, hidden until triggered, exchange held. Execution type limit order, may not fill, price guaranteed. Converts to market or limit, depending on stop type. Converts to market order, immediate execution, price not guaranteed. Slippage risk low, price guaranteed, but not fill, high. If converts to market, high, as it converts to market. Direction by below current market, Sell above current market by above current market. Sell below current market by below current market. Sell above current market. Common use: precise entry/exit, passive trading, risk management, trend following, reversal trading, catching dips/rallies, profit targets. Algorithmic implementation of MIT orders. The core programming concept behind an MIT order is conditional logic, specifically in code snippet statement that monitors a price condition. The order exists in a code snippet state until its trigger condition is met, at which point its state transitions to code snippet as a market order. Let's illustrate this with pseudocode, progressively building the logic. Download the code on OnePageCode Substack. This initial pseudocode outlines the conceptual placement of an MIT order. When an MIT order is placed, it doesn't immediately enter the public order book. Instead, it's held internally by the exchange or brokerage system, awaiting its trigger condition. The code snippet dictionary represents this internal held state. Download the code on OnePageCode Substack. The code snippet function simulates the continuous checking performed by the exchange's internal systems. It takes the code snippet MIT order and the latest market data. The core code snippet conditional logic determines if the trigger price has been reached or crossed. Once triggered, the order status is updated, and a code snippet is conceptually executed via the code snippet helper. The code snippet function represents the final step where the order is sent to the market for immediate fulfillment, also incorporating a conceptual slippage factor. Contrasting conditional logic, MIT versus stop versus limit. To further solidify the distinct behaviors, let's look at the core conditional logic for each order type in a unified function. Download the code on OnePageCode Substack. This code snippet function provides a side-by-side comparison of the core conditional logic for each order type. Notice how code snippet triggers when the price falls to a level, buying a dip, while code snippet triggers when the price rises above a level, buying a breakout. Conversely, code snippet triggers on a rise, selling a rally/taking profit, and code snippet triggers on a fall, limiting loss. Limit orders, in contrast, are placed on the order book and are filled only if the market reaches or surpasses their specified price. Download the code on OnePageCode Substack. This example usage demonstrates how the code snippet function can be called with different order types and current market prices to simulate their triggering behavior. Running these examples helps solidify the understanding of when each conditional order type activates and how their logic dictates their interaction with market price movements. Risks and considerations. Slippage. A significant risk associated with MIT orders is slippage. Since an MIT order converts into a market order upon being triggered, its execution price is not guaranteed. In volatile or illiquid markets, the actual fill price of the market order can deviate significantly from the MIT trigger price. This deviation is known as slippage. Impact. If a buy MIT order triggers at $98, but the market moves rapidly, the actual fill price might be $98.10 or even $98.50, leading to a worse entry price than anticipated. Conversely, a sell MIT at $102 might fill at $101.90 or $101.50. Order book interaction. When an MIT order triggers and becomes a market order, it immediately consumes liquidity from the opposing side of the order book. This means it will fill against existing limit orders. Its execution priority is determined by the standard rules for market orders, which are generally executed immediately at the best available prices. Mitigation. Limited. While slippage cannot be entirely eliminated for market orders, traders using MIT orders should be aware of market conditions, liquidity, and potential price gaps around their trigger levels. For very large orders, or in extremely fast-moving markets, the impact of slippage can be substantial. Practical scenarios and strategic application. Let's expand on the scenarios to provide clearer strategic context. Scenario 1. Buying a pullback to support by MIT. Context. Stock ABC is in a strong uptrend, currently trading at $288.70. Technical analysis indicates a significant support level at $288, e.g., a key moving average or previous low. You anticipate that if the price briefly dips to this support, it's likely to bounce and continue its upward trajectory. Objective: to enter a long position precisely when the stock touches $288, aiming to catch the falling knife, or by the dip before the price potentially reverses quickly. You want to be among the first to buy if it hits that level, implying a desire for immediate execution upon trigger rather than passive waiting for a fill. MIT order. Place a buy MIT order for 100 shares at $288. Mechanics. 1. The order is held internally by the exchange, not visible on the order book. 2. If ABC's last traded price, or bid price, depending on exchange rules, drops to $288, the MIT order triggers. 3. It immediately converts into a market order to buy 100 shares. For this market order will then execute against the best available sell orders on the order book. The fill price might be exact. TLY $288 or slightly above/below due to slippage, e.g., $288.05 or $287.95. YMIT versus limit/stop. Versus limit order. A limit order at $288 would sit on the order book, while it guarantees a price of $288 or better. If the market quickly flashes down to $288 and then immediately bounces a V-shaped recovery, a limit order might only get a partial fill or miss the fill entirely. The MIT, by converting to a market order, prioritizes getting into the trade as soon as the level is touched, even if it means slight slippage. The among the first to buy objective emphasizes this immediate execution to capture rapid reversals. Versus stop order. A stop buy order is typically placed above the current market price to enter on a breakout. An MIT buy is placed below the current market price to enter on a pullback. Their strategic intents are opposite. Scenario 2. Taking profits at resistance. Sell MIT. Context. You are currently long 200 shares of stock XYZ, bought at $50. The stock has rallied to $55, and you've identified a strong resistance level at $56, where you expect the rally to stall or reverse. Objective: to lock in profits if XYZ reaches $56, ensuring your position is closed before a potential reversal. MIT order. Place a sell MIT order for 200 shares at $56. Mechanics. 1. The order is held internally. 2. If XYZ's last traded price, or ask price, rises to $56, the MIT order triggers. 3. It converts into a market order to sell 200 shares. 4. This market order will execute against the best available buy orders on the order book, potentially filling at $56 or slightly above/below due to slippage, e.g., $55.95 or $56.05. YMIT versus limit/stop. Versus limit order. A limit order at $56 will be placed on the order book. If the market quickly touches $56 and then reverses sharply lower, a limit order might not get filled or only partially. An MIT order ensures that as soon as $56 is touched, you are exiting with a market order, prioritizing execution over a precise price, which is often desirable for profit-taking at critical reversal points. Versus stop order. A stop-sell order is typically placed below the current market price to limit losses or enter a short on a breakdown. An MIT sell is placed above the current market price to take profits or enter a short on a rally. Visualisierung mit Orders, konzeptual. Imagine a price chart displaying the asset's price over time. Current price. This is the continuously fluctuating price line on the chart. MIT trigger price. This can be visualized as a horizontal line on the chart, representing your specified trigger level. For a buy MIT, this line is placed below the current market price. The order triggers when the price line moves downwards and touches or crosses this horizontal trigger line. For a sell MIT, this line is placed above the current market price. The order triggers when the price line moves upwards and touches or crosses this horizontal trigger line. Upon trigger, conceptually, the MIT order disappears from its held state and a market order, appears, and is immediately executed at the prevailing market price. This clear visual distinction helps in understanding its application for catching specific price levels. Summarizing major types of orders. In the realm of electronic trading, a deep understanding of various order types is paramount. Each order type is engineered to offer a distinct balance between price control, execution certainty, and speed, enabling traders to precisely articulate their intentions to the market. This section serves as a comprehensive consolidation of the major order types, building upon the foundational concepts introduced in preceding chapters. It provides a detailed summary of their core attributes, operational mechanics, and strategic applications, crucial for both manual trading and the development of sophisticated algorithmic strategies. Core order attributes and life cycle. Before delving into specific order types, it's essential to understand the common attributes that define an order within a trading system. Programmatically, an order can be represented as an object encapsulating these details. The base order structure. At its most fundamental level, any order in an electronic market will carry several common attributes. These form the basis for how the exchange or broker identifies, processes, and tracks the order. Download the code on OnePageCode Substack. The code snippet and code snippet enumerations define common discrete choices for order parameters. Code snippet specifies whether the order is to buy or sell an asset. Code snippet, TIF, is a critical attribute that dictates the duration an order remains active in the market. A code snippet order expires at the end of the trading day, while a code snippet order persists until filled or explicitly canceled. Code snippet and code snippet are aggressive TIFs designed for immediate execution, with code snippet being more stringent, requiring a full fill or no fill at all. Download the code on OnePageCode Substack. The code snippet class serves as the blueprint for all specific order types. It assigns a unique code snippet and tracks essential details like code snippet, code snippet, code snippet, and code snippet. Importantly, it manages the order's code snippet through its life cycle, from code snippet to code snippet, code snippet, code snippet, or code snippet. The code snippet method demonstrates a basic state transition, adjusting the code snippet and code snippet upon partial or full execution, simulating the market environment. To illustrate the behavior of different order types programmatically, we will use a simplified code snippet. This simulator will provide real-time price information, bid, ask, last trade, against which our orders can be evaluated and conceptually executed. Download the code on OnePageCode Substack. The code snippet class allows us to represent the dynamic nature of an electronic market. It holds the current code snippet, and code snippet, which are crucial for determining how orders interact with the market. The code snippet method allows us to simulate market movements, enabling us to test the reactive behavior of certi. And order types. Comprehensive order type summary table. This table provides a quick reference to the major order types, detailing their characteristics, guarantees, and typical use cases in electronic markets. Order type description, key attributes. More order types, limit and cancellation. Beyond the basic market, limit, and stop orders, sophisticated trading strategies often require more precise control over execution conditions, particularly regarding time and quantity. This section delves into advanced conditional order types, fill or kill, FOK, immediate or cancel, IOC, and fill and kill, FAK. These orders are critical for managing market impact, seizing fleeting opportunities, and ensuring specific execution guarantees, especially in high-frequency trading, HFT, and large block transactions. Understanding the execution environment. What is immediate? Before delving into specific order types, it's crucial to understand what immediate execution truly means in the context of an exchange. It's not always instantaneous in the absolute sense, but rather within the fastest possible time frame, given the exchange's architecture. Latency windows. Immediate typically refers to execution within a single matching cycle or a very tight latency window, e.g., microseconds to milliseconds. If the order cannot be filled at that precise moment against existing liquidity, it's either canceled entirely or partially filled and the remainder canceled, depending on the order type. Market data snapshots. An order's immediacy is assessed against the current state of the order book at the time it arrives at the matching engine. This means evaluating available opposing orders, liquidity, at the specified price or better. Extra NG matching engines. These engines are designed for speed. When an immediate execution order arrives, the engine rapidly attempts to match it against resting limit orders. If a match is found, the trade occurs. If not, or if insufficient quantity is available, the order's specific kill or cancel instruction is instantly applied. Different exchanges may have slightly varied interpretations or processing speeds for immediate orders. It is always paramount to consult the specific exchange's documentation for precise definitions and behavior. Fill or kill FOK order. A fill or kill FOK order is an instruction to execute an entire order immediately and completely or cancel it entirely. There are no partial fills allowed, nor is any portion of the order allowed to remain on the order book. Mechanics and purpose. The core principle of a FOK order is all or nothing. If the entire specified quantity cannot be executed at the specified price, or better, for a limit FOK, at the moment the order reaches the market, the entire order is canceled. This makes FOK orders particularly useful for large block trades, institutional investors, or large traders who want to acquire or dispose of a significant block of shares without moving the market or signaling their intent. If the entire block cannot be filled at the desired price, they prefer no execution at all to avoid partial fills that might reveal their strategy or impact the price. Avoiding market impact by demanding AF. You'll fill. A FOK order prevents a situation where a large order gradually consumes liquidity, potentially pushing the price against the trader. Ensuring specific conditions. When a strategy requires a precise quantity to be filled at a specific price point, and a partial fill would compromise the strategy's integrity. Practical scenario: institutional block trade. Imagine an institutional investor wants to buy 100,000 shares of XYZ stock at a limit price of $50. They believe that buying a smaller quantity would not be worthwhile, or worse, could signal their interest and drive up the price before they complete their acquisition. They would place a buy FOK order for 100,000 shares at $50. If there are 100,000 or more shares available for sale at $50 or less, the entire order executes. If there are only 90,000 shares available at $50 or less, the entire 100,000 share order is canceled and no shares are bought. This ensures their capital isn't tied up in an incomplete trade and their market intent remains hidden. Conceptualizing FOK order logic. Let's consider how a simplified trading system or exchange might process a FOK order. We'll use pseudocode to illustrate the core decision-making. Download the code on OnePageCode Substack. This initial setup defines a simplified market state, code snippet, representing the available sell orders at various prices. We then define the parameters for our hypothetical FOK by order, its ID, side, desired quantity, and T. The maximum price it's willing to pay. Download the code on OnePageCode Substack. This Python snippet outlines the core logic. The code snippet function simulates the exchange's matching engine. For a buy FOK, it iterates through the code snippet, representing sell orders, to sum up all available quantity at or below the FOK's specified price. If this code snippet is less than the code snippet, the entire order is immediately canceled. Otherwise, it's considered fully filled. This clearly demonstrates the all or nothing principle. Immediate or cancel IOC order. An immediate or cancel IOC order demands immediate execution of any available quantity, with any unfilled portion of the order being immediately canceled. Unlike FOK, partial fills are accepted. Mechanics and purpose. The key characteristic of an IOC order is its willingness to accept a partial fill. If 100 shares are ordered and only 60 are available immediately at the specified price, or better, those 60 shares will be traded and the remaining 40 shares will be canceled. The order never rests on the book. IOC orders are commonly used for liquidity probing, high-frequency trading, HFT. Firms use IOC orders to quickly test the liquidity at various price levels without leaving residual orders that could be picked off if the market moves. Avoiding stale orders. In fast-moving markets, leaving a limit order on the book for too long can result in a stale order that is no longer at a desirable price. IOC orders prevent this by ensuring immediate action or cancellation. Opportunistic execution. To quickly capture available liquidity when a trading opportunity arises, without needing to fill the entire desired quantity. Minimizing market exposure. By ensuring no order remains pending, traders can maintain a neutral position or quickly reevaluate their strategy based on a partial fill. Practical scenario. HFT liquidity probe. An HFT firm wants to quickly acquire 5,000 shares of a stock if liquidity exists at their target price, but they are not committed to the full quantity and do not want to leave any lingering orders. They are constantly monitoring market conditions and need to react instantly. They would place a buy IOC order for 5,000 shares at a limit price of $25.50. If 3,000 shares are available at $25.50 or less, those 3,000 shares are bought, and the remaining 2,000 shares are canceled. If no shares are available at $25.50 or less, the entire 5,000 share order is canceled. If 5,000 or more shares are available, the entire 5,000 share order is filled. Conceptualizing IOC order logic. Let's adapt our simplified system to handle an IOC order. Download the code on one patch code Substack. We start with the same market setup. Notice the code snippet is set to 150,000, which is more than the 90,000 shares available at the target price in our code snippet example. This will demonstrate the partial fill behavior. Download the code on one patch code Substack. Here, the code snippet function attempts to fill the order iteratively. It consumes available liquidity at the target price or better, updating the code snippet and code snippet. Crucially, even if the code snippet is not zero after checking all relevant liquidity, the order is not left on the book. The remainder is simply canceled. This highlights the acceptance of partial fills and the immediate cancellation of the rest. Fill and kill, FAK, order. The term fill and kill, FAK, is often used interchangeably with immediate or cancel, IOC, across many exchanges and trading platforms, meaning that any available quantity is filled immediately and the remainder is canceled. However, in some contexts, FAK might imply a slightly different nuance or a stronger emphasis on filling as much as possible compared to an IOC, which might be used for smaller, more targeted liquidity probes. For the purpose of this discussion, and aligning with the professor's distinction, we will treat FAK as functionally equivalent to IOC. Accept any partial fill immediately and cancel the remainder. This is the most common interpretation in modern electronic trading. If an exchange defines FAK differently, e.g., as all or none, with immediate cancellation if not fully filled, which would make it identical to FOK, it is an exchange-specific variation that must be noted. Mechanics and purpose, common interpretation. Under the common interpretation, FAK behaves identically to IOC. Immediate partial or full FI. LL. The order attempts to fill against available liquidity immediately. Immediate cancellation of remainder. Any portion of the order that cannot be filled immediately is canceled. Never rests on book. No part of the FAK order is left in the order book as a resting limit order. The use cases are therefore the same as for IOC orders. Capturing fleeting arbitrage opportunities, probing liquidity, and ensuring no stale orders remain on the book. Practical scenario. Proprietary trader arbitrage. A proprietary trading firm identifies a brief arbitrage opportunity that requires them to buy 5,000 shares of stock A and sell 5,000 shares of stock B simultaneously. They want to execute as much of the stock A buy as possible immediately, but if they can't get the full amount, they'll adjust their strategy and don't want any residual buy orders on the book. They would place a buy FAK order for 5,000 shares of stock A at a limit price of $100. If 4,000 shares are available at $100 or less, those 4,000 shares are bought, and the remaining 1,000 shares are canceled. If 5,000 or more shares are available, the entire 5,000 share order is filled. If no shares are available, the entire order is canceled. Conceptualizing FAK order logic, identical to IOC in practice. Since FAK, in its common interpretation, behaves identically to IOC, the pseudocode for processing a FAK order would be the same as for an IOC order. Download the code on OnePatchCode Substack. This demonstrates the if an exchange implements FAK as fill as much as possible and kill the rest. The underlying logic is indistinguishable from an IOC order. This highlights the importance of clarifying terminology with specific exchange documentation. Comparison of FOK, IOC, and FAK orders. To solidify understanding, here's a comparative table summarizing the key characteristics of these three order types. Feature fill or kill, FOK. Immediate or cancel, IOC. Fill and kill, FAK. Partial fills allowed? No, yes, yes, commonly, functionally identical to IOC. Immediate execution? Yes. Entire quantity? Yes. Any available quantity? Yes. Any available quantity. Remains on order book? No. Cancellation condition if full quantity not available immediately, any unfilled portion immediately canceled, any unfilled portion immediately canceled, commonly. Primary use cases large block trades, ensuring complete fill, avoiding market impact. Liquidity probing, HFT, avoiding stale orders, opportunistic fills. Same as IOC, capturing fleeting opportunities, liquidity probing. Risk management prevents partial fills, ensures all or none. Prevents lingering orders, limits market exposure. Prevents lingering orders, limits market exposure. Strategic. Implications and market impact. These immediate or cancel order types are powerful tools for sophisticated traders, primarily for two reasons: managing market impact and reacting to fast-moving market conditions. Managing market impact. For large orders, simply placing a large limit order on the book, even at a favorable price, can signal intent and potentially move the market against the trader. This is known as market impact. FOK for zero market impact. On placement, a FOK order ensures that if the entire desired quantity isn't available at the desired price, the order is canceled. This means no partial fills that could signal intent. If it does fill, it does so entirely from existing liquidity without adding to the demand/supply side of the order book for any extended period, thus minimizing the signaling aspect of the order itself. Example: if a trader needs to buy 1 million shares and places a limit order for that quantity, it might sit on the book for minutes, hours, or even days, potentially influencing other participants. A FOK for the same quantity, if not filled immediately, disappears, leaving no trace of the large intent. IOC/FAK for control market impact. While IOC/FAK orders accept partial fills, they prevent the remaining quantity from sitting on the book. This means the trader only consumes existing liquidity and then retreats. They avoid the risk of their order resting on the book and becoming stale or being exploited by other traders who might anticipate their full intent. Example: an HFT firm uses IOCs to ping the market for liquidity. They might send many small IOC buy orders at different price levels. If a small quantity fills, they know there's liquidity. If nothing fills, they immediately cancel and move on. This allows them to gather real-time liquidity data without placing persistent orders that could be observed or acted upon by others. Role in high-frequency trading, HFT. HFT strategies heavily rely on these immediate or cancel orders due to their emphasis on speed, minimal market exposure, and precise execution control. Liquidity taking. HFT firms use IOC/FAK orders to aggressively take liquidity, i.e., fill against existing limit orders when a profitable opportunity is identified. The immediate cancellation of any remainder ensures that they don't hold unwanted positions or expose themselves to adverse price movements. Market making. With caution, while market makers primarily use resting limit orders, they might use IOCs defensively to quickly unwind a position or test liquidity before placing a larger, traditional limit order. Arbitrage. For very short-lived arbitrage opportunities, FOK, IOC, or FAK orders are essential. They ensure that if the opportunity cannot be fully or partially seized immediately, no lingering order remains to incur losses as the arbitrage window closes. These advanced order types provide traders with granular control over their execution, allowing them to navigate complex market dynamics, manage risk, and optimize their trading strategies. A deep understanding of their behavior is crucial for anyone engaging in professional or algorithmic trading. Price impact and slippage, the cost of immediacy. When executing trades in financial markets, especially large ones, it's crucial to understand the concept of price impact and price slippage. These phenomena represent the often unseen costs associated with trading, particularly when market liquidity is insufficient to absorb a large order without affecting the prevailing price. Price impact refers to the change in a security's price that is caused by the execution of a trade. When a large order is placed, it consumes available liquidity at various price levels within the limit order book, pushing the execution price away from the current best bid or offer. This temporary or permanent price movement is the direct consequence of the trade itself. Price slippage, on the other hand, is the difference between the expected price of a trade and the actual price at which the trade is executed. For market orders, the expected price is often considered the current best bid for a sell order or best offer for a buy order at the moment the order is placed. If the order is large enough to consume multiple price levels, the average execution price will deviate from this initial best price, resulting in slippage. Slippage is essentially the measurable outcome of price impact. Understanding price impact and slippage is fundamental for quantitative traders as it directly affects the profitability and risk management of trading strategies. Minimizing these costs is a core objective of advanced execution algorithms. The mechanics. How market orders consume liquidity. To grasp how price impact and slippage occur, we must revisit the structure of the limit order book, LOB. The LOB lists all outstanding limit orders for a given security at various price levels. On one side are bid orders by orders, with their respective prices and quantities, and on the other are ask orders, sell orders, with their prices and quantities. The difference between the best bid and best ask is the bid-ask spread. When a market order is placed, it seeks immediate execution. A market buy order will consume the cheapest available ask orders, starting from the best, lowest ask price and moving upwards through higher price levels until the entire order quantity is filled. Conversely, a market sell order will consume the most expensive available bid orders, starting from the best, highest bid price and moving downwards through lower price levels. If a market order size exceeds the available quantity at the best price level, it will eat through subsequent price levels, consuming liquidity at progressively worse prices. This consumption of multiple price levels is the direct cause of price impact and slippage. Let's simulate a simplified limit order book and demonstrate how a market order interacts with it. Download the code on OnePatchCode Substack. In this initial setup, we define a simplified limit order book. The code snippet represents the current offers to sell, sorted B. Why increasing price? Simulating the best offers available. Conversely, code snippet represents the current offers to buy, sorted by decreasing price. This structure is crucial for understanding how a market order will progressively consume liquidity. Calculating price slippage and volume-weighted average price, VWAP. When a market order executes across multiple price levels, its effective execution price is not a single value, but rather an average of all the prices at which its individual components were filled. This average is best represented by the volume-weighted average price, VWAP. VWAP is calculated as the total value of shares traded, sum of code snippet for each fill, divided by the total quantity traded. The slippage can then be quantified as the difference between the VWAP and the initial best price available at the time the market order was placed. Let's extend our simulation to execute a market by order and calculate its VWAP and slippage. Download the code on OnePageCode Substack. This function, code snippet, simulates the core logic of a market by order. It takes the desired code snippet and the code snippet, our code snippet, as input. It iterates through the LOB levels, starting from the lowest price, and fills the order using available volume at each level. It keeps track of the code snippet, price and quantity for each fill in the code snippet. Importantly, it captures the code snippet price to later calculate slippage. Download the code on OnePageCode Substack. The code snippet function takes the list of code snippet from the previous function, the code snippet, and the code snippet. It iterates through the executed trades to sum up the total value and total quantity, then computes the code snippet. Finally, it calculates both absolute and percentage code snippet by comparing the VWAP to the initial best price, providing a clear quantitative measure of the price impact. Download the code on OnePageCode Substack. This final section of code demonstrates the usage of the two functions with different order sizes. By running these examples, you can visually observe how a larger order, e.g., code snippet, results in a higher VWAP and greater slippage compared to a smaller order, e.g., code snippet, that might only consume the best price level. The third example shows what happens when an order exceeds the total available liquidity in a provided LOB. Types of price impact: temporary versus permanent. Price impact is not a monolithic concept. It can manifest in different forms with varying durations. Temporary price impact. This is the price deviation that occurs during the execution of a large order, but tends to revert shortly after the order is completed. It's primarily caused by the immediate demand/supply imbalance created by the order itself. Market makers and high-frequency traders, HFTs, play a crucial role here. They temporarily move their quotes in response to large incoming orders to avoid being picked off. Once the order is filled, they often return their quotes to near previous levels, causing the price to revert. This temporary impact represents a direct transaction cost. Permanent price impact. This refers to the portion of the price change that persists even after the large order has been fully executed. Permanent impact suggests that the trade conveyed new information to the market, or that the market structure itself adjusted in a lasting way. For instance, a very large institutional order might signal that a major investor has a strong conviction about the asset, leading other market participants to reevaluate its fair value. Permanent impact is less about transaction cost and more about the market's fundamental repricing. Distinguishing between these two types is important for strategies that aim to minimize trading costs versus those that try to profit from information signals. Factors influencing price impact. The magnitude of price impact is not solely determined by order size and liquidity. Several other factors contribute. Order size. As demonstrated, larger orders consume more liquidity levels, leading to greater impact. This relationship is often modeled nonlinearly, e.g., a square root or power law model, where impact increases disproportionately with order size. Market liquidity, depth, and spread. Market depth. A deeper LOB, more volume at each price level, can absorb larger orders with less price impact. Bid-ask spread. A wider spread indicates low immediate liquidity and often leads to higher impact, as there are fewer participants willing to trade at the current best prices. Volatility. In highly volatile markets, prices are already moving rapidly. Placing a large order in such an environment can exacerbate price movements, leading to greater and less predictable impact. Time of day. Liquidity often fluctuates throughout the trading day. The market open and close, as well as lunch hours, can exhibit different liquidity profiles, influencing impact. Trading during peak liquidity hours, e.g., mid-morning in major markets, can help reduce impact. Instrument characteristics. Highly liquid instruments, e.g., major currencies, large cap stocks, typically have lower price impact than less liquid instruments, e.g., small cap stocks, illiquid bonds, for the same order size. Market maker activity. The presence and activity of market makers and HFDs can significantly influence price impact. In healthy markets, they provide liquidity, absorbing smaller imbalances. However, in times of stress or large orders, they might widen spreads or withdraw liquidity, increasing impact. Strategies to mitigate price impact. Minimizing price impact is a critical aspect of trading, especially for institutional investors. Here are some basic and advanced strategies. 1. Using limit orders. The simplest way to avoid price impact from a market order is to use a limit order. A limit order specifies the maximum for buy or minimum for sell price at which you are willing to trade. By placing a limit order, you guarantee your execution price, or better, but you do not guarantee execution. Benefit: price certainty, no adverse price impact from your order, though existing market movements can still cause the price to move away. Drawback: no execution certainty. Your order may sit in the LOB and never be filled if the market moves away from your limit price. 2. Iceberg orders. An iceberg order is a large order that is split into smaller, visible tips that are displayed in the LOB, while the bulk of the order remains hidden. As each tip is filled, a new tip of the same size is automatically submitted until the entire order is executed. Benefit: reduces the signaling effect of a large order, minimizing immediate price impact. It allows a large order to be filled over time without revealing its full size to other market participants. Drawback: execution time is longer, and the order is still subject to market movements. There's also a risk that the market might move significantly against the order before it's fully filled. Some venues charge higher fees for iceberg orders. Let's consider a conceptual Python approach for an iceberg order. Download the code on OnePageCode Substack. The code snippet function conceptualizes how an iceberg order works. It takes a code snippet and a code snippet, the tip size. In a real trading system, this function would continuously monitor the market and submit new limit orders, the tips, as previous ones are filled, without revealing the full order size. The code snippet loop simulates this iterative process of revealing and filling portions of the order. The simplified fill logic demonstrates that the order attempts to execute at the code snippet. Download the code on OnePageCode Substack. This example shows how to use the code snippet function. It simulates placing a 1,000 share buy order with a 200 share display quantity. The output illustrates how the order is broken down and theoretically filled in chunks, aiming to minimize the immediate price impact that a single 1,000 share market order would cause. We then calculate the VWAP for the filled portions of the iceberg order. 3. Advanced execution algorithms. For very large institutional orders, manual management of limit and iceberg orders becomes impractical. This is where advanced execution algorithms come into play. These sophisticated algorithms are designed to slice large orders into smaller, dynamically managed child orders and execute them over time, balancing the trade-off between price impact and execution risk. Common types include VWAP, volume-weighted average price, algorithms. Aim to execute an order such that its average fill price is close to the market's VWAP over a specified period. TWAP, time-weighted average price, algorithms. Distribute an order evenly over a specified time period. POV, percentage of volume, algorithms. Execute a certain percentage of the mark. T's total volume, dynamically adjusting order size based on real-time market activity. While a deep dive into these algorithms is beyond the scope of this section, understanding price impact is a prerequisite for appreciating their necessity and design. Trade-off: immediacy versus price certainty. The choice of order type and execution strategy fundamentally revolves around a crucial trade-off: execution immediacy versus price certainty, and thus, impact minimization. Market orders offer maximum immediacy. They guarantee execution as long as there's liquidity, but provide no price certainty. They are most susceptible to price impact and slippage. Limit orders offer maximum price certainty. They guarantee that if executed, the price will be at or better than the specified limit. However, they offer no execution immediacy. They may never be filled. Advanced algorithms, including Iceberg, attempt to navigate this trade-off by achieving a balance. They provide a degree of execution certainty over time while striving to minimize price impact by intelligent order placement and timing. Professional traders and quantitative funds continuously analyze market conditions, order size, and specific instrument characteristics to choose the optimal execution strategy that balances these competing objectives. Market structure and price impact. Different market structures can also influence price impact. For example, dark pools, private exchanges where orders are matched anonymous. LY without being displayed publicly. Trading in dark pools can help institutional investors execute large orders with less price impact, as their intentions are not revealed to the broader market. However, dark pools often have less liquidity. Internalizers, broker-dealers that fill customer orders from their own inventory rather than sending them to an exchange. This can offer price improvement or reduced fees for smaller orders, but might not be suitable for very large orders that require deep liquidity. The fragmented nature of modern markets, with multiple exchanges, dark pools, and alternative trading systems, adds complexity to managing price impact, leading to the development of sophisticated smart order routing, SOR, systems. These systems automatically determine the best venue and order type for each part of a trade to optimize execution and minimize overall costs, including price impact. Order flow. Order flow is a fundamental concept in electronic markets, representing the continuous stream of buy and sell orders that interact with a limit order book. It provides a real-time pulse of supply and demand dynamics, reflecting the immediate intentions and aggressiveness of market participants. Unlike static metrics like bid-ask spread or volume, order flow captures the direction and intensity of trading pressure. Understanding order flow is crucial for quantitative traders because it offers insights into short-term price movements, liquidity imbalances, and potential shifts in market sentiment. It serves as a bridge between the microscopic view of individual order types and a macroscopic view of aggregate market behavior. Inferring trade direction, buyer-initiated versus seller-initiated trades. The foundation of order flow analysis lies in classifying individual trades as either buyer-initiated or seller-initiated. This distinction is vital because it tells us whether the trade occurred due to an aggressive buyer lifting the offer, i.e., buying at the ask price or higher, or an aggressive seller hitting the bid, i.e., selling at the bid price or lower. Consider a snapshot of the market with a best bid and best ask price. Bid price. The highest price a buyer is willing to pay. Ask price. Offer price the lowest price a seller is willing to accept. Bid-ask spread. The difference between the ask and bid prices. A trade occurs when a market order interacts with a limit order on the book. Buyer-initiated trade occurs when a market buy order is executed against a limit sell order on the ask side of the book. The trade price will typically be at or above the prevailing best ask price. This indicates an aggressive buyer willing to pay the current offer price to acquire shares immediately. Seller-initiated trade occurs when a market sell order is executed against a limit buy order on the bid side of the book. The trade price will typically be at or below the prevailing best bid price. This indicates an aggressive seller willing to accept the current bid price to dispose of shares immediately. Trades executed at prices between the bid and ask, or when bid/ask data is unavailable, can be more ambiguous. For robust analysis, it's essential to have accurate, synchronized tick-level data, including trade price, trade volume, and the prevailing best bid and ask prices at the precise moment of execution. Classifying trades with bid/ask data. Let's consider a practical approach to classify trades using the bid and ask prices recorded at the time of each trade. We'll represent each trade as a dictionary containing its code snippet, code snippet, code snippet, code snippet, and code snippet. Download the code on OnePatchCode Substack. This structure allows us to capture all necessary information for classification. Now, let's define a function to classify a single trade. Download the code on OnePageCode Substack. This function provides a clear and common method for classifying trades. It's important to note that this is a simplified rule. In real-world scenarios, especially with high-frequency data, more advanced algorithms like the Liquidity algorithm or the simple tick rule, comparing current trade price to previous trade price, are sometimes used to infer trade direction when bid/ask data is imperfect or for historical data, where only trade ticks are available. However, comparing directly to the prevailing bid/ask is generally the most accurate method. Measuring order flow, net trade sign, and net trade volume sign. Once individual trades are classified, we can aggregate them over a specific time window, e.g., 1 second, 1 minute, 5 minutes, to derive quantitative measures of order flow. The two most common metrics are net trade sign and net trade volume sign. Net trade sign. The net trade sign is calculated by assigning a value of code snippet to each buyer-initiated trade and code snippet to each seller-initiated trade, then summing these values over a given period. $\text net trade sign equals \sum I equals 1 and \text sign $, where $text sign I equals plus $1 for a buyer-initiated trade and $1 for a seller-initiated trade. A positive net trade sign indicates a prevalence of aggressive buying, while a negative sign suggests aggressive selling. Let's implement a function to calculate the net trade sign for a list of trade records. Download the code on OnePageCode Substack. This function takes a list of trades that have already been classified and sums up their signs. Net trade volume sign. The net trade volume sign is a more robust measure. Instead of just counting trades, it considers the volume associated with each buyer-initiated or seller-initiated trade. A buyer-initiated trade's volume contributes positively, and a seller-initiated trade's volume contributes negatively. $text net trade volume sign equals \sum I equals 1 and \text volume I times \text sign $, where $text volume $, is the volume of trade $I, and $text sign I equals plus $1 for a buyer-initiated trade and $1 for a seller-initiated trade. This metric is generally preferred because larger trades, higher volume, have a greater impact on market pressure and price. A single large buyer-initiated trade can exert more upward pressure than many small seller-initiated trades. Here's the implementation for calculating the net trade volume sign. Download the code on OnePageCode Substack. This function provides a more weighted view of market pressure by incorporating trade volume. Illustrative example of order flow calculation. Let's walk through a simplified sequence of trades to see how these metrics accumulate. Download the code on OnePageCode Substack. Output of the example. Download the code on OnePageCode Substack. In this example, despite a nearly balanced number of buyer and seller-initiated trades, 3 buys versus 2 sells, the code snippet is significantly positive, 205. This indicates that the volume associated with aggressive buying outweighed the volume associated with aggressive selling, suggesting an overall bullish pressure during this short period. Order flow and price movement. The relationship between order flow and price movement is intuitive and fundamental to market microstructure. Aggressive market orders, whether buy or sell, consume liquidity from the limit order book, thereby pushing prices in their favored direction. Positive net order flow, aggressive buying, when there is a sustained influx of buyer-initiated trades, it means aggressive buyers are absorbing all available limit sell orders at the current ask price. If this pressure continues, the ask price will rise as market makers and limit sellers adjust their prices upward, and eventually, the bid price will follow. This leads to an upward price movement. Negative net order flow, aggressive selling conversely. A prevalence of seller-initiated trades indicates aggressive sellers are hitting all available limit buy orders at the current bid price. If this pressure persists, the The bid price will fall as market makers and limit buyers adjust their prices downward, pulling the ask price along. This results in a downward price movement. This dynamic is a core driver of short-term price fluctuations. Many academic studies have shown that order flow has significant predictive power for future price movements, particularly over very short horizons, seconds to minutes. For instance, research often highlights that order flow imbalances can explain a substantial portion of price changes, even more so than just trade volume alone. Conceptually, imagine a balance scale where one side represents buy pressure and the other represents sell pressure. Order flow measures which side is currently heavier. When buy pressure accumulates, the scale tips up. When sell pressure accumulates, it tips down. Practical applications and trading signals. Order flow analysis is a powerful tool for quantitative traders to develop directional trading strategies, refine entry and exit points, and gain a deeper understanding of real-time market dynamics. Developing directional strategies. Traders can use order flow as a primary signal for anticipating short-term price movements. For example, a sudden surge in positive net trade volume sign could signal strong accumulation and a potential upward price trend or breakout confirmation. A significant negative net trade volume sign might indicate distribution or a potential downward reversal. Informing entry and exit points. Order flow can serve as a confirmation signal for other technical indicators. If a stock is approaching a resistance level, a decrease in positive order flow or an increase in negative order flow might suggest a failed breakout or reversal. If a stock is oversold, a shift from negative to positive order flow could signal a bounce. Generating simple trading signals, threshold-based. A common way to use order flow in an automated rating system is through threshold-based signals. This involved defining specific levels for the net trade volume sign or net trade sign that, when crossed, trigger a buy or sell signal. Download the code on OnePageCode Substack. This function illustrates a basic signal generation mechanism. The code snippet and code snippet are critical parameters. Their determination is typically done through historical backtesting and optimization, aiming to maximize profitability while controlling risk. These thresholds are often dynamic, adjusting to market volatility or liquidity conditions. A higher threshold implies a stronger conviction of market pressure is required before acting. Example scenario: confirming a breakout. Imagine a stock trading in a narrow range. A trader might be waiting for a breakout above a certain price level. Instead of just relying on price crossing the level, they could use order flow as confirmation. If the price breaks out and the net trade volume sign simultaneously surges positively, it provides stronger evidence that aggressive buyers are driving the move, increasing the probability of a sustained breakout. Conversely, a breakout on low or negative order flow might be a fakeout. Limitations and real-world considerations. While order flow analysis is powerful, it's not without its limitations and practical challenges, especially in today's complex market environment. 1. Data quality and granularity. Accurate order flow analysis requires high-quality tick-level data that includes not just trade prices and volumes, but also the prevailing best bid and ask prices at the exact moment of each trade. Obtaining and processing this real-time, high-frequency data can be technically challenging and expensive. 2. Hidden orders and dark pools. Not all trading activity is visible on the public limit order book. Hidden orders, iceberg orders, and trades executed in dark pools, private exchanges, do not immediately impact the visible order book or order flow metrics derived from public data. These hidden liquidity sources can mask true supply and demand, leading to incomplete order flow signals. 3. High-frequency trading. HFT firms contribute a significant portion of market volume. Their strategies, which include rapid quoting, spoofing, placing and quickly canceling orders, and arbitrage, can create noise in observed order flow. What appears as aggressive buying might just be an HFT firm quickly rebalancing positions or exploiting a fleeting price discrepancy, rather than a fundamental shift in market sentiment. 4. Threshold determination. As mentioned, setting appropriate thresholds for trading signals is crucial. These thresholds are rarely static and require continuous calibration. Over-optimization on historical data, curve fitting, is a common pitfall. 5. Context is key. Order flow is a short-term indicator. It performs best in liquid markets and should ideally be used in conjunction with other analysis techniques. E.G. Technical analysis, fundamental analysis, macro events, to provide a more holistic view. A strong surge in buying pressure might be quickly negated by a negative news announcement. 6. Forecasting order flow. While simple order flow analysis is retrospective, analyzing past trades, advanced quantitative strategies might attempt to forecast future order flow. This involves complex time series analysis, statistical modeling, or even machine learning techniques to predict the likelihood of future aggressive buying or selling based on current and past market microstructure data. However, this is a highly challenging endeavor due to the noisy and non-stationary nature of market data. Despite these challenges, understanding and applying order flow concepts remains an indispensable part of a quant trader's toolkit for navigating the intricacies of modern electronic markets. Working with LOB data. Working with limit order book, LOB, data is fundamental for quantitative traders, market microstructure researchers, and anyone building algorithmic trading strategies. Unlike simple historical price series, LOB data provides a granular, real-time snapshot of market depth, revealing the collective intentions of buyers and sellers at various price levels. This section will guide you through the practical steps of loading, inspecting, and structuring a real-world, high-frequency LOB dataset using Python, laying the groundwork for advanced analysis. 1. Loading high-frequency LOB data. High-frequency LOB data is typically massive, often recorded tick by tick, capturing every change in the order book. These datasets are frequently stored in efficient, raw text formats to minimize file size and maximize loading speed. For numerical data, CodeSnippet is an excellent tool for quick and efficient loading from such files. First, we need to import the necessary libraries. CodeSnippet is essential for numerical operations and array manipulation, while CodeSnippet provides powerful data structures like data frames for tabular data analysis. CodeSnippet will be used for basic data visualization later. Download the code on OnePageCode Substack. The CodeSnippet statements bring in the core libraries we'll use. CodeSnippet is aliased as CodeSnippet and CodeSnippet as CodeSnippet by convention, making the code more concise. CodeSnippet is a Jupyter-specific AJIT command that configures Matplotlib to render plots directly within the notebook output. Next, we load the LOB dataset. For this example, we assume the dataset is named CodeSnippet and is located in the same directory as your script or notebook. This dataset is a benchmark often used in financial machine learning research. Download the code on OnePageCode Substack. Here, CodeSnippet reads the entire numerical content of CodeSnippet into a number-py array called CodeSnippet. The CodeSnippet argument tells number-py that the values in the file are separated by spaces. If your data uses commas or tabs, you would adjust this parameter accordingly, e.g., CodeSnippet or CodeSnippet. This function is highly optimized for loading large numerical datasets quickly. 2. Inspecting the raw data structure. Understanding the initial dimensions and structure of your loaded data is crucial before any processing. The CodeSnippet attribute of a number-py array provides its dimensions as a tuple code snippet. Download the code on OnePageCode Substack. When you execute this code with the provided benchmark dataset, you might observe an output similar to CodeSnippet. This indicates that our CodeSnippet array has 149 rows and 200,000 columns. Crucial insight into this dataset structure. It's important to note that for this specific high-frequency LOB benchmark dataset and some other specialized financial datasets, the original file format stores features as rows and timestamps as columns. This is often done for computational efficiency in certain research contexts. Rows, 149 each row, represents a distinct feature or variable extracted from the order book or market. Columns, 200,000, each column represents a different timestamp, meaning we have 200,000 snapshots of the order book and its associated features. This orientation is unconventional for standard data analysis in pandas or machine learning frameworks, where rows typically represent observations, e.g., timestamps, and columns represent features. This discrepancy necessitates a transposition step, which we will perform shortly. 3. Understanding the LOB features, the 40 core entries. The code snippet array contains 149 features per timestamp. The most critical part for building an order book snapshot are the first 40 features. These 40 features represent the prices and volumes for the 10 best bid and 10 best ask levels of the limit order book. This structured encoding allows for a compact representation of the order book depth. Let's break down the typical mapping for these 40 entries, which follow a consistent pattern for each level. Index range feature description example, level 1. 0 to 3 ask price 1, ask volume 1, bid price 1, bid volume 1 best ask best bid. 4 to 7 ask price 2, ask volume 2, bid price 2, bid volume 2 second best ask bid. 36 to 39 ask price 10, ask volume E10 bid price 10, bid volume 10 10th best ask bid. More specifically, for each level code snippet from 1 to 10, the features are ordered as code snippet, code snippet, code snippet, code snippet. So, the full sequence of the first 40 features is code snippet. The remaining 109 rows, from index 40 to 148, typically contain other derived features or raw market data that are part of the benchmark dataset. These can include mid-price/spread, derived from the best bid/ask prices, order imbalance, metrics indicating buying or selling pressure within the order book, trade data, information about executed trades, e.g., last trade price, volume, other market microstructure features, such as order arrival rates, cancellation rates, or features designed for specific prediction tasks. For the scope of this section, we will focus primarily on the core 40 LOB depth features, as they form the fundamental structure of the order book. Let's examine the first 40 feature values for the very first timestamp, column 0, to confirm this structure. This allows us to see a raw snapshot of the LOB depth at a single point in time. Download the code on one patch code Substack. The output of this code will be an array of 40 numbers. By referencing the table above, you can interpret that the first value is ask price 1, the second is ask volume 1, the third is bid price 1, and so on. This confirms the features as rows, timestamps as columns structure for the original raw data. Bon data. Exposing and structuring data with pandas. For most data analysis tasks, especially time series analysis and machine learning, it's conventional to have each row represent an independent observation, in our case, a timestamp, and each column represent a distinct feature or variable. Since our code snippet has features as rows and timestamps as columns, we need to transpose it to align with this standard convention. The code snippet attribute in number py in pandas allows for a quick and efficient matrix transposition. After transposing, we will convert the relevant LOB data, the first 40 features, into a pandas data frame. Data frames offer much richer capabilities for data manipulation, cleaning, filtering, and analysis compared to raw number py arrays, making them the preferred structure for structured data. Download the code on one patch code Substack. The code snippet output will now be code snippet. This signifies that we successfully transformed the data to have 200,000 timestamps, observations, and 40 features, which is the desired format for most analytical workflows. The code snippet output will show the first few timestamps, with the 40 raw feature values now organized as columns, though still unnamed. 5. Naming columns for clarity. While the code snippet now has the correct orientation, the columns are simply numbered, 0 to 39. For practical analysis and readability, it's absolutely essential to assign meaningful names to these columns. This makes accessing specific PRI C and volume levels intuitive, and prevents errors that can arise from relying on numerical indices. We'll create a list of column names that precisely follow the structure we identified earlier. Ask price 1, ask volume 1, bid price 1, bid volume 1, etc. This systematic naming is critical for maintainability and collaboration. Download the code on OnePageCode Substack. Now, Code Snippet will display clear, self-explanatory column headers like code snippet, and so on. This transformation is crucial as it makes the data frame immediately understandable and significantly simplifies any subsequent data manipulation or analysis. For instance, to access the best bid price, you can now simply use code snippet instead of code snippet. 6. Calculating key LOB metrics. With our LOB data structured and its columns meaningfully named, we can easily derive common market microstructure metrics. These metrics provide immediate insights into market conditions and are often used as direct features in trading algorithms, risk management systems, or predictive models. 6.1. Bid-ask spread. The bid-ask spread is the difference between the best ask price, the lowest price a seller is willing to accept, and the best bid price, the highest price a buyer is willing to pay. It's a fundamental indicator of market liquidity and the implicit transaction costs for immediate execution. A narrower spread generally indicates higher liquidity and lower transaction costs. Download the code on OnePageCode Substack. The code snippet column now contains the spread for each timestamp. This calculation highlights how straightforward it is to perform column-wise operations in pandas, applying a formula across all observations efficiently. 6.2. Mid-price. The mid-price is the average of the best bid and best ask prices. It's often used as a proxy for the true market price, especially in high-frequency trading, as it represents the theoretical equilibrium point between immediate buy and sell orders. The mid-price is a common target variable in mid-price prediction models, where the goal is to forecast its movement. Download the code on OnePageCode Substack. The code snippet column is now available, representing the estimated fair value of the asset at each moment in time. This metric is less susceptible to temporary order book imbalances than just looking at the last trade price. 6.3. Cumulative volume at depth. Liquidity isn't just about the best bid/ask prices. It's also about the volume available at various price levels. Cumulative volume at specific depths, e.g., the sum of volumes at the top 5 bid or ask levels, can indicate the robustness and depth of the order book, reflecting the market's capacity to absorb large orders without significant price impact. Let's calculate the cumulative bid and ask volumes for the top 5 levels. This involves summing the code snippet and code snippet columns for n from 1 to 5. Download the code on OnePageCode Substack. These EW columns provide immediate insights into the total buy and sell interest within the immediate vicinity of the best prices. High cumulative volume suggests greater liquidity, meaning larger orders can be filled with less price impact. These are excellent features for models predicting price movements or liquidity shocks. 7. Basic visualization of LOB data. Visualizing LOB data helps in understanding its dynamics and identifying patterns that might not be obvious from raw numbers. We can plot the best bid, best ask, and mid-price over a segment of time to observe price movements, spread fluctuations, and overall market behavior. Download the code on OnePageCode Substack. This plot visually confirms that the best bid is always below the best ask, and the mid-price lies precisely between them, typically following the overall price movement. Observing these lines over time helps identify trends, periods of increased volatility, and fluctuations in the bid-ask spread. This kind of visualization is a crucial first step in exploratory data analysis for LOB data, helping to validate data processing and gain initial insights into market behavior. This section has equipped you with the foundational skills to load, structure, and derive initial insights from raw limit order book data. These practical steps are essential prerequisites for more advanced quantitative analysis, building sophisticated trading strategies, and developing machine learning models based on market microstructure. Understanding label distribution. In quantitative finance, especially when developing machine learning models for market prediction, defining and understanding your target variable, or label, is paramount. Building on our previous discussions about working with limit order book, LOB, data, this section delves into the critical process of defining and analyzing the distribution of these labels. Labels transform raw market data into a format suitable for predictive modeling, indicating the direction of future price movements, up, down, or stationary. Analyzing their distribution provides crucial insights into market predictability, potential biases, and informs the design of robust trading strategies and machine learning models. Deriving labels from mid-price movements. The most common approach to generating price movement labels from LOB data involves the mid-price. The mid-price represents the theoretical equilibrium price between the best available bid and ask prices. Calculating mid-price. The mid-price is simply the average of the best bid price, BBP, and the best ask price, BAP, at any given moment. Download the code on OnePageCode Substack. This fundamental calculation provides a single, representative price point for the asset at any given moment, smoothing out the bid-ask spread. Defining price movement labels. Once we have a time series of mid-prices, we can define our labels based on how the mid-price changes over a future look-ahead window. A look-ahead Y, DAO, often denoted as code snippet, refers to a specific number of future events or timestamps, e.g., 10, 20, 30, 50, 100 events. For each current timestamp code snippet, we look at the mid-price at code snippet and compare it to the mid-price at code snippet. The labels up, down, and stationary are typically defined using a small threshold to account for minor fluctuations or market microstructure noise. Download the code on OnePageCode Substack. The code snippet parameter is crucial. Without it, almost any tiny price fluctuation would be labeled up or down, leading to an extremely noisy target variable. A common approach is to set the threshold as a small multiple of the asset's tick size or a percentage of the mid-price. The choice of code snippet and code snippet significantly impacts the resulting label distribution and, consequently, the performance of any predictive model. Why analyze label distribution? Analyzing the distribution of your target labels is a critical step in exploratory data analysis, EDA, before developing any quantitative trading model. It offers several vital insights. Understanding market characteristics. The distribution reveals the inherent tendencies of the asset's price movements over different horizons. Is it mostly stationary, or does it exhibit strong, trending behavior? Assessing predictability. A highly skewed distribution, e.g., 90% stationary, suggests that predicting significant price movements might be very challenging, as most of the time the price doesn't move much. Conversely, a more balanced distribution might indicate more predictable opportunities. Identifying class imbalance. If one label, e.g., stationary, heavily dominates the others, you face a class imbalance problem. This is a common pitfall in machine learning, where models tend to perform poorly on minority classes because they are optimized for overall accuracy, which is biased towards the majority class. Addressing this might require techniques like resampling, synthetic data generation, or using specialized loss functions. Informing model selection and hyperparameters. The distribution can guide your choice of model and its hyperparameters. For instance, if stationary movements are prevalent for short look-ahead windows, a mean reversion strategy might be suitable. If up or down movements become more prominent for longer windows, a trend-following approach could be considered. Optimizing look-ahead window. Code snippet. By observing how the label distribution changes with code snippet, you can select an optimal look-ahead window that maximizes the signal, meaningful up/down movements, for your specific trading strategy or predictive model. Too small code snippet might capture noise. Too large code snippet might dilute the signal or introduce too much lag. Visualizing label distributions with Plotly. To effectively analyze label distributions, especially across multiple look-ahead windows, visualization is key. We will use Plotly, a powerful interactive plotting library, to create multi-subplot histograms showing the percentage distribution of up, stationary, and down labels. For this example, we assume our pre-processed dataset, loaded as a number py array, contains the pre-calculated labels for various look-ahead windows. Specifically, rows 144 to 148 of the code snippet array are assumed to contain the label data for code snippet respectively. In a real-world scenario, this mapping would be documented or derived from your data processing pipeline. Initial setup and data loading. First, we import the necessary libraries and load our dataset. Download the code on one patch code substack. Here, code snippet is used to load the pre-processed data. The code snippet is specified because our labels are integer categories. The code snippet list helps in mapping the numerical labels 1, 2, 3 to human-readable strings on the plot. Structuring the plotly figure. We'll create a function code snippet to encapsulate the plotting logic. This function will set up a figure with multiple subplots, one for each look-ahead window. Download the code on one patch code substack. The code snippet dictionary is a crucial enhancement. Instead of hard-coding row indices, e.g., code snippet, we map the code snippet value to its corresponding row index. This makes the code more robust, readable, and easier to modify if the data structure changes. Code snippet sets up our grid, and code snippet ensures that. All histograms use the same percentage scale, facilitating direct comparison. Adding histograms to subplots. Now, we iterate through our code snippet and add a histogram trace for each look-ahead window. Download the code on one patch code substack. The code snippet argument is vital. It converts the raw counts of each label into percentages of the total observations for that look-ahead window. This normalization allows for direct comparison of the proportions of up, stationary, and down movements across different code snippet values, even if the total number of observations for each code snippet were different, though in this pre-processed dataset, they are likely the same. Without code snippet, comparing raw counts would be misleading. Customizing the plot layout. Finally, we apply comprehensive layout and axis customizations to make the plot informative and visually appealing. Download the code on one patch code substack. These code snippet, and code snippet calls are critical for creating a professional-looking and readable plot. Setting code snippet and code snippet on the x-axis ensures that our numerical labels 1, 2, 3 are displayed as up, stationary, and down. The code snippet in code snippet means we only need to set the code snippet and other properties for the y-axis once, e.g., for code snippet, and they will apply to all subplots. Interpreting the observed trends. When you execute the code, you will observe a plot similar to Figure 2, 3, as referenced in the professor's analysis, showing how the distribution of up, stationary, and down labels changes across different look-ahead windows, code snippet. Typically, you'll see the following trends. Short look-ahead windows, e.g., k equals 10, 20, a significant majority of movements are stationary. This reflects the high frequency of micro-price movements and the general efficiency of markets over very short horizons, where the bid-ask spread often contains the price. Small code snippet values are highly susceptible to market microstructure noise. Increasing look-ahead windows, e.g., k equals 30, 50, 100 as code snippet increases, the percentage of stationary movements tends to decrease, while the percentages of up and down movements generally increase. This indicates that over longer horizons, the mid-price is more likely to have moved beyond the initial stationary threshold. Implications for trading strategies and model design. This observed trend has profound implications. 1. Market efficiency and predictability. The prevalence of stationary movements at short code snippet reinforces the concept of market efficiency at very high frequencies. It's difficult to predict the exact direction of tiny, short-term price fluctuations. As code snippet increases, larger, more meaningful price changes emerge, potentially offering more predictable signals. 2. The lagging effect. Longer look-ahead windows introduce a lagging effect. While they might show clear trends, the prediction is for a future point further away in time. A model predicting code snippet events ahead might be accurate for that horizon, but the actual trading signal might arrive too late to capture the immediate opportunity. 3. Strategy alignment. Mean reversion. Strategies looking for prices to revert to a mean might focus on shorter code snippet values where stationary movements are dominant, or where small up/down movements quickly reverse. Trend following. Strategies that aim to capture larger price moves would find more potential in longer code snippet values, where up and down movements are more pronounced. 4. Optimal look-ahead window selection. This analysis directly informs the selection of code snippet for your predictive model. You might choose code snippet where the ratio of up/down movements to stationary movements is optimal, balancing predictability with the actionability of the signal. If up or down movements are too rare, even a highly accurate model might not generate enough trading opportunities. 5. Class imbalance mitigation. The analysis highlights potential class imbalance. If, for instance, up movements are consistently much rarer than down movements for a given code snippet, your machine learning model might struggle to learn to predict up movements effectively. This necessitates using techniques like weighted loss functions, oversampling, SMOT, or undersampling to balance the training data. Best practice. And further enhancements. Saving figures for documentation or sharing. Saving the plotly figure to a static image file, e.g., PNG, JPEG, SVG, is often necessary. Download the code on one Pagecode Substack. The code snippet package is required for exporting static images. Exporting to HTML, code snippet preserves the interactivity of plotly plots, which would be very useful for detailed exploration. Dynamic row mapping. The code snippet dictionary already implemented in our code snippet function is a great example of making the code more robust and configurable. Instead of hard-coding code snippet, this mapping clearly associates a code snippet value with its corresponding data row, making the code easier to understand and maintain. Contextualizing data. Always accompany such analyses with a clear understanding of the dataset structure, what each row/column represents, and how it was pre-processed. This prevents misinterpretation and ensures reproducibility. Understanding label distribution is not just a visualization exercise. It's a deep dive into the fundamental characteristics of the market you are trying to model. It helps you set realistic expectations for your predictive models and design more robust and effective quantitative trading strategies. Understanding price volume data. This section focuses on transforming raw limit order book (LOB) data, typically stored in a flat array format, into a structured and visually interpretable representation of price and volume information. This process is fundamental for quantitative analysis and the development of algorithmic trading strategies, as it allows us to observe market dynamics such as liquidity, price movements, and order imbalances. Deconstructing raw LOB data. Raw LOB data, as loaded from a file, often comes in a compact, multidimensional array format. For the dataset we are working with, each row represents a timestamp, and the columns contain interleaved price and volume information from multiple bid and ask levels. To make this data usable, we must first separate it into distinct components: ask prices, ask volumes, bid prices, and bid volumes. Let's assume code snippet is a pandas data frame containing the transposed LOB data from a previous step, where rows are timestamps and columns represent the LOB levels. Download the code on one Pagecode Substack. The output code snippet indicates that code snippet has 100 timestamps, rows, and 40 features, columns. These 40 columns represent 10 levels of bid and ask data, where each level comprises a price and a volume. Specifically, for each level code snippet, from 1 to 10, the data is typically arranged as level N ask price, level N ask volume, level N bid price, level N bid volume. This pattern repeats for all 1-0 levels. Therefore, column 0 is level 1 ask price, column 1 is level 1 ask volume, column 2 is level 1 bid price, column 3 is level 1 bid volume, and so on. To clarify this structure, consider the following mapping. Column index, LOB, component description. 0 level 1, ask price best ask price, closest to mid price. 1 level 1, ask volume at best ask price. 2 level 1, bid price best bid price, closest to mid price. 3 level 1, bid volume at best bid price. 4 level 2, ask price second best ask price, further from mid. 5 level 2, ask volume at second best ask price. 6 level 2, bid price second best bid price, further from mid. 7 level 2, bid volume at second best bid price. 36 level 10, ask price 10th best ask price. 37 level 10, ask volume at 10th best ask price. 38 level 10, bid price 10th best bid price. 39 level 10, bid volume at 10th best bid price. This consistent pattern of code snippet, code snippet, code snippet, code snippet repeating every 4 columns allows us to extract each component using simple slicing techniques. Separating price and volume data frames. We can leverage Python's code snippet function with a step to select columns based on their pattern. Download the code on one Pagecode Substack. Next, we extract the bid side data using a similar approach. Download the code on one Pagecode Substack. At this point, we have 4 separate data frames, each containing either prices or volumes for the ask or bid side. Each data frame has 10 columns, corresponding to the 10 LOB levels, ensuring consistent price ordering, reversing bid sides. A crucial step for consistent analysis and visualization is to ensure that all price levels are ordered logically, typically from lowest to highest. While ask prices naturally increase as we move from level 1, best ask, to level 10, further away from the mid price, bid prices are typically presented in decreasing order from level 1, best bid, to level 10, further away. This is because level 1 bid is the highest bid price, and subsequent levels offer progressively lower prices. To make the bid prices align with the ascending order of ask prices, allowing for a seamless price ladder visualization, we need to reverse the column order of the bid price and bid volume data frames. Let's inspect the first row of our newly created data frames to observe the current order. Download the code on one Pagecode Substack. You will observe that code snippet shows prices generally increasing from left to right, column 0 to column 36, while code snippet shows prices generally decreasing from left to right, column 2 to column 38. Reversing the bid columns will arrange them from the lowest bid price, level 10, to the highest bid price, level 1, making them visually consistent W. At the ask side, this reordering is essential because when we combine bid and ask prices for visualization, we want a continuous spectrum of prices from the lowest bid to the highest ask. If bid prices remain in decreasing order, plotting them alongside ascending ask prices would create a fragmented or confusing visual. Reversing them ensures that the combined price ladder reads from the lowest price to the highest price across the entire order book depth. We can reverse the order of columns in a pandas data frame by using Python's slice notation code snippet on the data frame's code snippet attribute. Download the code on one Pagecode Substack. Now, both code snippet and code snippet have their columns ordered such that prices generally increase from left to right, preparing them for concatenation. Unifying the order book, joining price and volume data frames. With the individual components extracted and correctly ordered, the next step is to combine them into unified data frames for all prices and all volumes across the entire LOB. This provides a holistic view of the market depth. We use the code snippet method in pandas to combine data frames. Since all our data frames, code snippet, code snippet, code snippet, code snippet, share the same index, timestamps, a simple join will align them correctly. We use code snippet for robustness, although in this specific case, an code snippet join would yield identical results because all data frames have the exact same index and no m. Missing values. Code snippet join ensures that if any index values were not present in one data frame, which is not the case here, they would still be included with code snippet for missing data. Download the code on one Pagecode Substack. For better readability and clarity in analysis and visualization, it's good practice to rename the columns of the combined data frames to reflect their actual meaning. We can use a list comprehension to generate meaningful names like code snippet, code snippet, code snippet, code snippet, etc. Download the code on OnePageCode Substack. Inspecting the first row of code snippet now clearly shows the progression from the lowest bid price, level 10, to the highest ask price, level 10. You will also observe the big gap in the middle. This is the bid-ask spread, the difference between the best bid price, the highest price a buyer is willing to pay, and the best ask price, the lowest price a seller is willing to accept. This spread represents the cost of immediate execution and is a key indicator of market liquidity. A narrower spread implies higher liquidity and lower transaction costs. Visualizing price level evolution over time. Understanding how different price levels move over time can provide insights into the market's dynamics. Plotly's code snippet trace type is ideal for visualizing time series data. We can plot each of the 20 price levels as a separate line. Download the code on OnePageCode Substack. In this plot, code snip ET is used because plotting 20 separate lines would create an overly crowded legend, making the plot difficult to interpret. By suppressing the legend, we focus on the visual patterns. Observing the plot, you'll see a distinct band of lines representing bid prices and another for ask prices, separated by the bid-ask spread. A critical observation is that the price curves should never intersect. If a bid price were to rise above an ask price, or an ask price fall below a bid price, it would immediately create an arbitrage opportunity, the ability to buy low and sell high instantly. Such opportunities are typically exploited by high-frequency traders within microseconds, causing the prices to adjust and the crossed order book to disappear almost instantaneously. The persistence of the bid-ask spread reflects the market's natural friction and the compensation required for market makers to provide liquidity. Sudden jumps or drops in these price levels can indicate significant market events, large order executions, or shifts in supply and demand. Understanding market depth, volume distribution snapshots. While price movements are crucial, understanding the volume distribution at different price levels, known as market depth, provides insights into liquidity and potential support or resistance areas. Large volumes at specific price levels can act as liquidity walls, indicating strong buying or selling interest that might temporarily halt or reverse price movements. A quick why to visualize volume distribution for a few timestamps using Plotly Express. Download the code on OnePageCode Substack. This plot provides a stacked bar chart of volumes, showing how the total volume across all levels changes over the first 5 timestamps. However, it doesn't clearly distinguish between bid and ask volumes or align them with specific prices. For a more detailed snapshot of market depth at a specific point in time, we can create a horizontal bar chart that explicitly shows volumes at their corresponding price levels, distinguishing between bid and ask sides. Download the code on OnePageCode Substack. In this detailed market depth snapshot, code snippet bars represent bid volumes, and code snippet bars represent ask volumes. Large bars indicate significant liquidity at those price levels. A cluster of large bid volumes below the current price might suggest a support level, where strong buying interest could prevent further price declines. Conversely, large ask volumes above the current price could indicate a resistance level, where selling pressure might impede price increases. These visual cues are invaluable for identifying potential turning points or areas of strong interest in the market. Comprehensive view, combining price evolution and market depth. For a truly holistic understanding, it's often beneficial to view both the time evolution of prices and a detailed market depth snapshot side by side. Plotly's code snippet function allows us to create multi-panel figures. Download the code on OnePageCode Substack. This combined visualization provides a powerful tool for market microstructure analysis. You can observe the overall trend and volatility of prices on the left, while simultaneously drilling down into the specific liquidity profile at a chosen point in time on the right. For instance, a sudden drop in price on the left might correlate with a large cluster of ask volumes, sell orders, being hit on the right, or a depletion of bid volumes by orders. Derived metrics and advanced analysis. Beyond raw price and volume visualization, deriving key metrics from the LOB data offers deeper insights into market conditions. Encapsulating data preparation. To promote modularity and reusability, it's good practice to encapsulate the data extraction and reordering logic into a single function. Download the code on OnePageCode Substack. Bid-ask spread and mid-price. The bid-ask spread is the difference between the best ask price, lowest selling price, and the best bid price, highest buying price. It represents the cost of executing an immediate trade. The mid-price is often calculated as the average of the best bid and best ask, serving as a proxy for the true market price at any given moment. Download the code on OnePageCode Substack. This plot allows for simultaneous observation of price trends, mid-price, and market liquidity spread. A widening spread can indicate decreasing liquidity or increased market uncertainty, while a narrowing spread often suggests improving liquidity. Cumulative volume, market depth profile. Cumulative volume, also known as the market depth profile, shows the total volume available at or beyond a given price level. It provides a clearer picture of the aggregate supply and demand at different price points. Download the code on OnePageCode Substack. The cumulative market depth profile helps identify liquidity walls, price levels where a large amount of volume is concentrated, potentially indicating strong support or resistance. These can be strategic points for traders to place limit orders or to anticipate price reversals. Focusing on specific LOB levels. For many trading strategies, only the best bid and ask, level 1, are critical. You can easily extract and analyze these specific levels. Download the code on OnePageCode Substack. This allows for focused analysis on the most active part of the order book, which directly influences immediate trade execution. Saving Plotly figures. For reporting or sharing, saving Plotly figures to static files, HTML, PNG, JPEG, SVG, is often necessary. Download the code on OnePageCode Substack. Saving to HTML preserves interactivity, allowing viewers to zoom, pan, and hover over data points. Saving to image formats is useful for static reports or presentations. Practical applications and insights. The ability to structure and visualize LOB price volume data is not just an academic exercise. It forms the backbone of quantitative trading and market microstructure research. 1. Identifying liquidity walls. As discussed, large volume clusters in the market depth profile, figures 2, 5 and 2, 6, and cumulative depth can act as significant support or resistance levels. A quant trader might use this information to place limit orders just above a strong bid wall for a buy, or just below a strong ask wall for a sell, anticipating that the price might bounce off these levels. 2. Input for machine learning models. The structured code snippet and code snippet data frames are precisely the kind of input features required for machine learning models in quantitative finance. For example, the volumes at different levels, the bid-ask spread, and the mid-price can be used as features to predict future price movements, e.g., mid-price direction prediction, volatility, or even the probability of a large order execution. This directly links the data preparation steps to the ultimate goal of building predictive models. 3. Market imbalance analysis. By comparing the total bid volume to total ask volume within a certain range of the mid-price, traders can infer market imbalances. A higher bid volume might suggest more buying pressure, while higher ask volume indicates selling pressure. This can be derived from the code snippet data frame and plotted over time. 4. Backtesting trading strategies. Before deploying any algorithmic trading strategy, it must be rigorously backtested on historical data. The structure. Price volume data created in this section serves as the perfect foundation for simulating market conditions and testing how a strategy would have performed. This includes strategies based on order book dynamics, such as liquidity provision or order book imbalance strategies. By mastering the techniques presented in this section, You gain the fundamental skills to transform raw market data into actionable intelligence, a crucial step for any aspiring quantitative trader or market analyst. Visualizing price movement. Dynamic visualization of high-frequency limit order book, LOB, data is crucial for understanding the intricate dance of supply and demand in modern electronic markets. While static visualizations provide snapshots, animating price and volume movements over time reveals the continuous evolution of market microstructure, allowing quantitative traders and researchers to identify patterns, gauge liquidity, and observe the real-time impact of trading activity. This section delves into advanced visualization techniques using Plotly, building upon the foundational concepts of LOB data structure and static price volume analysis covered previously. We will animate key aspects of the LOB, specifically the movement of individual price levels and the dynamic shifts in volume across multiple bid and ask levels, using rolling windows to manage data granularity. Plotly's animation architecture. Plotly's animation framework is powerful, allowing for the creation of rich, interactive time series visualizations. Understanding its core components is key to building effective dynamic plots. Code snippet, the main container for your plot. It holds the initial code snippet, traces, code snippet, static properties like titles, axes, and interactive menus, and the code snippet, the sequence of data snapshots that make up the animation. Code snippet, a list of code snippet objects, e.g., code snippet, that define the initial state of the plot. When animation starts, this code snippet is dynamically updated by the code snippet. Code snippet, a code snippet object that defines the static appearance of the plot, titles, axis labels, ranges. Critically, it also contains the code snippet attribute, which configures the animation controls, e.g., play/pause buttons, sliders. Code snippet, a list of code snippet objects. Each code snippet represents a single snapshot in the animation. A frame typically contains a code snippet attribute, a list of traces with the data for that specific time point, and can also include a code snippet attribute if you want to change layout properties dynamically per frame, though less common for simple animations. Code snippet. Located within the code snippet, this attribute is a list of dictionaries that define interactive buttons or drop-downs. For animation, we use code snippet with a code snippet to trigger the playback of code snippet. The general flow is define an initial plot state, code snippet, and code snippet. Then precompute a sequence of code snippet that represent how the data should change over time. Plotly then interpolates between these frames to create a smooth animation when the play button is pressed. Animating single price level movement, rolling window. Visualizing the movement of a single price level, such as the best bid or best ask, provides insight into the general trend and volatility of the market. Using a rolling window approach helps manage the high freak NCY of LOB data by showing a fixed time slice of price history that moves forward rather than trying to display every single tick from the start. For this example, we assume code snippet is a pandas data frame where each column represents a specific bid or ask price level, e.g., best bid, second best bid, best ask, etc., and the index is time or sequence number. If bid prices were reversed and concatenated with ask prices during pre-processing, code snippet might represent the 10th best bid, code snippet the best bid, code snippet the best ask, and so on. For simplicity, we'll select code snippet, which corresponds to the second column of code snippet. The exact financial meaning of this column depends on your data's specific column ordering. Let's begin by importing the necessary libraries and preparing a dummy data frame for demonstration purposes. In a real scenario, code snippet would be loaded from your pre-processed LOB data. Download the code on one patch code substack. This initial code block sets up our environment. We import code snippet, and code snippet, aliased as code snippet, which are fundamental for data manipulation and visualization. We also set the default Plotly template for a cleaner look. Crucially, we include a section for dummy data generation. In a real application, you would replace this with your actual LOB data loading and pre-processing steps, ensuring code snippet is a data frame with price levels as columns and timestamp/sequence in. Numbers as the index. We then define code snippet, which controls the size of our rolling window, and code snippet, which specifies which price level column we want to visualize. Next, we initialize the plotly figure with its first trace and layout. This sets up the static components and the initial view of the animation. Download the code on one patch code substack. This segment creates the code snippet object. Code snippet defines what the plot looks like at code snippet, showing the first code snippet data points. We use code snippet because we are visualizing a continuous time series of price. The code snippet sets up static elements like the title, axis ranges, and the crucial code snippet. The code snippet contains a play button. When clicked, code snippet tells Plotly to start iterating through the defined code snippet. Code snippet is a useful interactive feature that makes it easier for users to see data points by highlighting the closest data point on hover, even if the mouse isn't exactly over it. Now, we construct the code snippet list. This is where the animation's dynamic data resides. Each code snippet will contain the data for a specific rolling window. Download the code on one patch code substack. This is the core of the animation. We define code snippet to limit the animation length for performance and demonstration purposes, e.g., animating 1,000 points out of 2,000. A list comprehension efficiently generates each code snippet. For each code snippet, represent ing the starting index of the rolling window. A new code snippet trace is created with code snippet and code snippet data corresponding to the code snippet to code snippet slice of code snippet. This creates the illusion of the plot rolling forward in time. Finally, we display the figure. Download the code on one patch code substack. Calling code snippet renders the plotly figure in your environment, e.g., Jupyter Notebook browser. You will see the initial static plot, and then you can click the play button to start the animation. Enhancing price animation, mid-price overlay, and dynamic window size. To provide richer context, we can overlay the mid-price on the animated chart. The mid-price, calculated as code snippet, is a common proxy for the true market price. We can also add a slider to dynamically adjust the code snippet, rolling window size, offering more interactive control. First, let's assume code snippet also contains the best bid and best ask prices. For our dummy data, we'll create them. Download the code on one patch code substack. In this extended setup, we first ensure code snippet has code snippet, and code snippet columns. We then define two initial traces, one for the selected code snippet and another for the code snippet. The code snippet is enhanced with both play and pause buttons for better control. A code snippet attribute is added, which defines a slider to select different code snippet values. Each step of the slider triggers an animation method, code snippet, to update the frames, dynamically changing the rolling window size. The code snippet for the slider are crucial. Code snippet specifies the names of the frames to load, which we will generate next. Now, the frame generation needs to account for the different window sizes from the slider. Download the code on one patch code substack. This refined frame generation loop now iterates through each code snippet value, 50, 100, etc., and then through each time index code snippet. For each combination, it creates a code snippet containing both the selected price level and the mid-price data for that specific rolling window. Crucially, each frame is given a unique code snippet in the format code snippet. This allows the slider to correctly reference and load the appropriate frames when new window size is selected. Interpreting price movement animations. Observing the animated price movement provides several insights. Volatility. Rapid, jag movements indicate high volatility. Trend. Sustained upward or downward movement indicates a trend. Liquidity impact. If the price jumps significantly with small movements in the rolling window, it might suggest low liquidity, where even small orders can cause disproportionate price changes. Mid-price relationship. How closely the selected price level tracks the mid-price can indicate the bid-ask spread stability or changes in market pressure. a widening gap between a bid/ask level and the mid-price cowl. D signal increasing spread or one-sided pressure. The code snippet parameter allows you to change your perspective. A smaller code snippet, e.g., 50, provides a more granular, zoomed-in view of immediate price action, useful for high-frequency analysis. A larger code snippet, e.g., 250, offers a smoother, zoomed-out view, helping to identify broader trends and filter out high-frequency noise. Animating order book volume dynamics. Beyond price, the volume distribution across different bid and ask levels is a key indicator of liquidity and market depth. An animated horizontal bar chart can effectively illustrate how volumes at various price levels change over time, revealing shifts in supply and demand. For this visualization, we assume code snippet is a pandas data frame where each column represents the volume at a specific bid or ask price level, and the index is time or sequence number. Similar to code snippet, the column order is critical for interpretation, e.g., code snippet, code snippet, code snippet, code snippet. Download the code on one patch code Substack. This block sets up dummy code snippet data, similar to code snippet but for volumes. Each column represents the volume at a specific bid/ask level. We then set code snippet to define the animation's length. Next, we define the initial state of a volume bar chart. Download the code on one patch code Substack. Here, code snippet are derived from code snippet. The code snippet list is crucial. It assigns a specific color, e.g., blue for bids, red for asks, to each bar based on its position, visually separating the two sides of the order book. Code snippet is chosen for the code snippet trace because horizontal bars are generally more readable when you have many categories, price levels, on the y-axis, allowing for easier comparison of volumes across levels. The code snippet and code snippet ensure that the price levels are displayed in the desired sequence, e.g., best bid to best ask. Next, we generate the frames for the volume animation. Download the code on one patch code Substack. Similar to the price animation, a list comprehension generates code snippet objects. Each frame contains a code snippet trace where the code snippet data is the volume at a specific timestamp code snippet. The code snippet data, code snippet, and code snippet colors remain constant as we are animating the magnitudes of the bars over time. Finally, display the volume animation. Download the code on one patch code Substack. This will render the animated horizontal bar chart, showing how the volume distribution across bid and ask levels changes over time. Interpreting volume dynamics animations. Animated volume charts are powerful for understanding market depth and liquidity. Liquidity depth, a fat order book, many long bars, indicates high liquidity and depth, meaning large orders can be absorbed without significant price impact. A thin order book, many short bars or gaps, suggests low liquidity, where even small orders can cause rapid price movements. Imbalance. A noticeable skew in volume towards the bid side, more blue bars, suggests buying pressure, while a skew towards the ask side, more red bars, indicates selling pressure. This imbalance can precede price movements. Iceberg orders/hidden liquidity. While not directly visible, sudden large increases in volume at specific levels without a corresponding large price movement might hint at large hidden orders being revealed. Order book churn. Rapid appearance and disappearance of bars indicate active quoting and cancellation, common in high-frequency trading environments. Advanced animation, combining price and volume views. For a comprehensive view of market dynamics, it's often beneficial to see price movements and volume distribution simultaneously. Plotly's code snippet function allows us to create multiple plots within a single figure and animate them synchronously. Download the code on one patch code Substack. This code block initializes the combined figure using code snippet. We define two subplots, the left one for price and the right for volume, giving the price chart more width. Initial traces for both the price, selected level and mid-price, and volume, current snapshot, are added to their respective subplots. The code snippet call configures titles, axis labels, and the animation controls for the entire figure. Note how code snippet, Code snippet refer to the first subplot's axis and code. Snippet. Code snippet refer to the second subplot's axis. Finally, we generate the frames for the combined animation. Each frame will contain updated data for both subplots. Download the code on one PageCode Substack. The code snippet list is constructed similarly, but each code snippet now contains 3 code snippet objects, 2 for price, 1 for volume. Plotly intelligently maps these traces to their respective subplots based on the order in code snippet and how they were initially added to the subplots using code snippet. This creates a synchronized animation where you can observe how price changes coincide with shifts in order book depth and liquidity. Saving animations. While interactive animations in a notebook are great for exploration, you might need to save them for presentations, reports, or sharing. Plotly supports saving figures as static images, PNG, JPEG, SVG, PDF, interactive HTML files, or even animated GIFs/videos. To save as GIF or video, you typically need to install Code Snippet or Code Snippet for older Plotly versions and Code Snippet. Download the code on one PageCode Substack. Download the code on one PageCode Substack. Saving to HTML is usually the most practical option, as it retains full interactivity and can be easily shared and viewed in any web browser. Saving as GIF or MP4 provide a non-interactive, shareable video format, but consider the file size and processing time, especially for long animations. The code snippet and code snippet. Parameters are important for controlling the GIF/video playback quality. Performance considerations for large datasets. Animating extremely high-frequency LOB data can quickly become computationally intensive and slow, especially if you have millions of data points or many price levels. Here are strategies to optimize performance. 1. Downsampling. Time-based. Aggregate data over fixed time intervals, e.g. 100 milliseconds, 1 second, by taking the last observed price or summing volumes. Tick-based. Only animate every nth tick, effectively reducing the number of frames. Event-based. Focus animation on significant market events, e.g. large trades, order book imbalances, rather than every single tick. 2. Limit animation range. As demonstrated, animate only a subset of your data, e.g. code snippet, rather than the entire dataset. This keeps the number of frames manageable. 3. Optimize data structures. Ensure your pandas data frames are optimized for memory and access, e.g., using appropriate code snippet. Converting to native Python lists, code snippet, before passing to Plotly is generally efficient, as Plotly works with these lists. 4. Simplify plot elements. Each trace and complex layout element adds rendering overhead. If performance is critical, consider simplifying colors, markers, and annotations. 5. Pre-render frames. For very complex animations, you might pre-render all frames and save them as individual images, then stitch them into a video using code snippet outside of Plotly. This offers maximum control and potentially better performance, but sacrifices interactivity. 6. Hardware acceleration. For local viewing, ensure your browser and graphics drivers are up to date to leverage hardware acceleration for rendering. Interpreting dynamic LOB visualizations for trading insights. The true value of these animations lies in their ability to reveal patterns and dynamics that are difficult to discern from static data or raw numbers. Identifying liquidity regimes. Thin order books, characterized by short bars on the volume chart and potentially volatile, jerky price movements. This indicates low liquidity, where large orders can easily move the price. Algorithmic traders might use this to identify opportunities for large market orders to create significant price impact. Fat order books, characterized by long, numerous bars on the volume chart and smoother price movements. This indicates high liquidity, where large orders are absorbed with less price impact. Traders might use this to execute large orders without fear of significant slippage. Observing order book imbalances. Watch for sustained periods where bid volumes significantly outweigh ask volumes, or vice versa. This indicates an imbalance in supply and demand that can predict short-term price direction. For example, a heavy bid side might suggest impending upward price movement as buyers are eager. Observe how these imbalances correct themselves. Do large orders arrive to rebalance? See the book, or does price move to find new liquidity? Impact of large market orders. Animate price and volume simultaneously. If a large market order hits the book, you might see a sudden hole appear in the volume chart, bars disappearing on one side, followed by a rapid price jump or slide as the order consumes multiple price levels. This is critical for understanding market impact. Quoting behavior and spoofing advanced. Rapid flashing of bars, volumes appearing and disappearing quickly, can indicate high-frequency quoting activity. While difficult to definitively prove from visualization alone, patterns of large orders appearing and then being canceled just before being hit could indicate spoofing. Volatility and price discovery. Observe periods of high volatility, erratic price movements, rapid changes in volume distribution, versus periods of low volatility, stable price, consistent order book. This helps in understanding the market's current mood and adapting trading strategies accordingly. By combining the visual cues from both price and volume animations, traders can develop an intuitive feel for market microstructure, identify emerging trends, and validate the real-world behavior of their trading algorithms. This section consolidates the fundamental concepts and practical skills essential for navigating and analyzing electronic markets. It serves as a comprehensive recap of the journey from understanding market microstructure to hands-on data visualization, reinforcing the crucial link between theoretical knowledge and data-driven quantitative trading. Electronic market fundamentals, the core mechanics. Electronic markets, at their heart, are sophisticated ecosystems designed for efficient price discovery and transaction execution. The central components include the limit order book. LOB. This dynamic ledger is the market's memory, listing all outstanding buy, bid, and sell, ask, orders at various price levels. It provides a real-time snapshot of market depth and liquidity. The LOB is critical for understanding immediate supply and demand dynamics. Order matching engine. This is the core logic of an exchange, responsible for pairing compatible buy and sell orders. Its efficiency and fairness are paramount to market integrity. Market participants, traders, institutions, and algorithms interact directly with the LOB, placing orders that contribute to its constant evolution. Understanding these fundamentals is the bedrock upon which all subsequent market analysis and trading strategy development is built. Diverse order types and their strategic application. The specific type of order chosen by a trader dictates its behavior and interaction with the LOB. Each order type serves a distinct strategic purpose, balancing execution certainty, price control, and timing. Market orders, designed for immediate execution at the best available price. Why use them? When speed and guaranteed execution are paramount, and the trader is willing to accept the prevailing market price, regardless of minor slippage. This is often used for urgent entries or exits. Pitfall: lack of price control. Large market orders can walk the book, executing against multiple price levels and incurring significant slippage, especially in illiquid markets. Limit orders, placed at a specific price or better, waiting on the LOB until a matching order arrives. Why use them? For precise price control. Traders use limit orders to buy below the current ask or sell above the current bid, aiming for a better price or to provide liquidity. Pitfall: no guarantee of execution. The market may move away from the specified limit price, leaving the order unfilled. Stop orders, stop loss, stop limit contingent orders that become active only when a specified trigger price is hit. Why use them? Primarily for risk management, to cap potential losses or protect profits. A stop loss order becomes a market order when triggered, while a stop limit becomes a limit order. Pitfall: stop loss orders can suffer from slippage in fast-moving markets, executing at a worse price than the stop level. Stop limit orders, while offering price control, may not fill if the market moves quickly past the Lee. MIT price after being triggered. Beyond these fundamental types, advanced orders like pegged orders, which track a reference price, trailing stops, which adjust based on price movement, and time and force modifiers, e.g., fill or kill, FOK, immediate or cancel, IOC, all or none, AON, offer sophisticated control for specific trading scenarios. The choice of order type is a critical decision in execution management, directly impacting profitability and risk. Order matching and execution, the rules of the game. Once placed, orders interact within the exchange's matching engine according to predefined rules. The most common precedence rules, designed to ensure fairness and efficiency, are 1. Price priority. The highest bid for buy orders and the lowest ask for sell orders receive priority. This ensures that the best prices are always matched first. 2. Time priority. Among orders at the same best price level, the order that arrived first, earliest timestamp, gets priority. This rewards speed of submission. 3. Size/display priority. Less common, but exists in some markets. Larger orders or displayed orders might receive secondary priority after price and time. This hierarchical matching process ensures that the LOB accurately reflects the current supply and demand and that trades are executed systematically. Practical data analysis. Unveiling market dynamics with LOB data. The theoretical understanding of electronic markets truly comes alive when applied to real-world. LOB data. The ability to load, process, and visualize high-frequency market data is a foundational skill for any quantitative trader. Loading and initial inspection of LOB data. LOB data often comes in formats that represent snapshots or events. A common approach is to load it into a powerful data structure like a pandas data frame. Download the code on one page code Substack. This initial step demonstrates how to load LOB data, typically from a CSV file. We've included a fallback to generate dummy data, which is useful for testing or if real data isn't immediately available. The code snippet method provides a quick glance at the data frame structure, showing columns for timestamps, bid/ask prices, and volumes at different levels. Interpreting key LOB metrics. From the raw LOB data, we can derive crucial market microstructure metrics. The most fundamental are the best bid, best ask, and the spread. Download the code on one page code Substack. Calculating the code snippet, average of the best bid and ask, and the code snippet, difference between best ask and best bid, provides immediate insights into market consensus and liquidity. A tighter spread generally indicates higher liquidity and lower transaction costs. These calculations are fundamental for further analysis. Visualizing LOB dynamics. Visualizing LOB data brings its dynamic nature to life, allowing for intuitive understanding of market depth, price movement, and order flow imbalances. While advanced animations covered previously, a static snapshot visualization is crucial for understanding the LOB structure at a given moment. Download the code on one page code Substack. This code snippet illustrates how to create a static visualization of the LOB at a specific moment. Bid volumes are plotted negatively to extend to the left of the price axis, creating the classic LOB butterfly shape. This visual representation immediately conveys where liquidity is concentrated on both the buy and sell sides, helping to infer potential support and resistance levels and identify large orders that could influence price movement. Analyzing these visualizations allows traders to assess market liquidity and depth, identify imbalances between buying and selling pressure, order flow, spot, iceberg orders, or large hidden liquidity if combined with level 3 data. Anticipate potential price movements based on order book dynamics. From data analysis to quantitative trading strategy development, the ultimate purpose of understanding electronic markets and mastering LOB data analysis is to inform and develop robust quantitative trading strategies. The process typically follows a pipeline. 1. Data acquisition and pre-processing, obtaining clean, high-quality market data. 2. Exploratory data analysis, EDA using tools like Python with pandas and Plotly to visualize and understand data characteristics, identify patterns, and detect anomalies, as demonstrated in this chapter. 3. Feature engineering. Transforming raw data into predictive signals or features relevant for a trading model. 4. Strategy formulation. Developing hypotheses about market behavior and designing a trading logic based on these insights and engineered features. 5. Backtesting and optimization. Testing the strategy against historical data to evaluate its performance and robustness. 6. Risk management and execution. Implementing safeguards and optimizing order execution based on the chosen order types and market conditions. This chapter has provided a solid foundation in the initial critical steps of this pipeline, understanding the market environment and performing hands-on data exploration and visualization. Recognizing the importance of data analysis as a foundational step is key to successful quantitative trading.